at taxman.com/budget. This webinar is being broadcasted live on Zoom as well as taxman.com, Facebook, YouTube, X, and LinkedIn. Please submit your questions via the chat box or the comment box, and our team will respond. Our speakers will also address selected questions at the end of each session. So we are now commencing the budget marathon with the focus on direct tax laws, which includes amendment close to 100 provisions. The keynote and overview of Budget 2024 will be delivered by none other than our esteemed visiting speaker, Daksha Baxi, founder, SI Solutions. Sure. No problem. I'll do that. So 1 second, I guess we can restart. No worries, I guess because of some network, I'll restart, no problem. So very warm welcome to all again. This week, our Finance Minister Nirmala Sitharaman delivered her 7th consecutive budget in Parliament. So as we aim for Viksit Bharat, developed India by 2047, marking 100 years of independence, the Finance Minister continues to build on the foundations laid in the interim budget. This year's budget reinforces the 4 pillars of the interim budget, that is Mahilaएं, Yuva, Garib, Annadata. The theme for this year's budget aligns with the strategic vision set forth earlier and focuses on 9 key priorities for generating extensive opportunities. I, C. Ridhima Bhatia, is delighted to welcome you all to the 3rd edition of a budget marathon. This event, now a tradition hosted by Taxmen, consists of series of back-to-back webinars exploring the intricacies of the budget. The marathon features renowned industry leaders who provide detailed and comprehensive analysis of the corporate and tax changes introduced in the budget. So what better way to learn from the experts themselves? Sarvai Nama Gyani Nanam. Salutations to all the learned ones. So as the moderator for today, I would like to inform you that the 8-hour budget marathon will feature 12 sessions, each addressing unique changes in the different areas of the budget, presented by our elite speakers. So you can find the full schedule and agenda at taxman.com/budget. This webinar is being broadcast live on Zoom as well as taxman.com, Facebook, YouTube, X, and LinkedIn. So please submit your questions via the chat box or the comment box, and our team will respond. Our speakers will also address selected questions at the end of each session. So we are now commencing the budget marathon with a focus on direct tax laws, which has close to 100 provisions and amendments. So the keynote and overview of Budget 2024 will be delivered by none other than our esteemed visiting speaker, Daksha Baxi, founder, SRI Solutions. So ma'am is a highly recognized tax advisor in India, acclaimed by global ranking agencies such as Euromoney, International Tax Review, Who's Legal, Legal 500, Chambers and Partners. So she was named among Asia Business Law Journal's top 100 professionals. Beyond her professional expertise, ma'am has promoted global peace through meditation and spiritual education worldwide. Her professional mantra is to help clients achieve their goals efficiently and legally. So with an extensive experience in domestic and international transactions, ma'am has co-authored India's first ready reckoner on international taxation and cross-border transactions published by Taxman Publications in April 23, serving as a guide for understanding taxation in cross-border transactions. So very warm welcome, ma'am. The platform is all yours to begin.
Good morning, all. Very welcome. Thank you very much, Ridhima, and very warm welcome to everyone who is joining this fantastic initiative taken by Taxman. It is amazing. In my old days, we never had such a wonderful, insightful webinar available to us, but I am so glad that today it is possible. Along with all the digitalization that is happening, this is something, and sharing of knowledge. As you share it, it increases. So this is wonderful. And I am really delighted to welcome everyone. I'm just going to share my presentation today. And there we go. And we will start the session. It is amazing that you all are going to be listening to more than 12 speakers, having special knowledge and understanding in their own areas of expertise, and analyzing in detail the budget provisions to give you an insight into how those provisions are going to work so that you can implement in your life, advise your friends and clients, and take it all forward. And hopefully we will all together be able to do something really nice with this budget. I will break down my introduction in preview, introduction, overview of major direct and indirect taxation. I'm not going to go into the details of any of the tax provisions. This is going to be taken on by the people who are going to be taking the sessions later on. So as Ridhima said, on 23rd July 2024, the Finance Minister, Mrs. Nirmala Sitharaman, presented the Modi 3.0's first budget, 7th of hers in a row, which is a history on its own. This budget is in the backdrop of the results of the closely fought elections recently. Though the people have returned Mr. Modi to lead the country as their prime minister again, since his own party is not an absolute majority and the majority is that of the pre-poll alliance partners and that partnership called NDA, it was expected that there will be coalition pressures and it will be a populist budget. It is a great relief and immensely commendable fact that the finance minister in the leadership of Mr. Modi has stayed clear of populist measure and given a well-balanced budget. Having said that, I must add that I do believe that Mr. Modi really, really is a socialist at heart, though he knows how to balance it. And he knows that there is no growth of a country without having large, huge industrial establishments, and that can only come through private investment. So he really knows how to balance, and he therefore guides his entire cabinet to work in that direction. It can be said that it is a budget with elements for continuity of the policies of the Modi 2.0 government to build on what has been done in the past 10 years. This budget needs to be evaluated in the backdrop of other following aspects. One, the global economy, though has performed better than expected, is still in the grip of uncertainties. Many countries are still struggling to come out of the pandemic shocks. We have 2 wars going on, which have polarized the world and have created disruptions not only in supply chain, but also impacted the ability of countries to contain inflation, which results in reduction in purchasing power. And this consequently impacts the export growth negatively. The determination of the government to become Atmanirbhar is showing shoots of good results, but there is a long way to go. The plan to make India a preferred China plus hub for manufacturing and other economic activities faces huge headwinds resulting both from domestic and global challenges. Fortunately, Indian economy is a bright spot in the midst of the global concerns, as it is the fastest growing economy with buoyancy, both in terms of the gross domestic product and net revenues of the government. As stated by the finance minister, the budget proposals aim at sustained efforts on the following 9 priorities for generating ample opportunities for all. And these 9, though already stated in the budget speech, I would like to recount them as a backdrop for all of us to understand the policies that the government has put out, both in terms of how they are going to spend their revenue and how they want to fund their spending through collection of taxes and, of course, other revenues that they expect from dividends, for example, from the Reserve Bank of India. These 9 elements are productivity and resilience in agriculture, employment and skilling, inclusive human resource development and social justice, manufacturing and services, urban development, energy security, infrastructure, innovation, research and development, and next generation reforms. To my mind, these are very well thought out priorities in terms of taking India forward to the next stage in its march to development. The government is focused on the long-term goal of making India a developed economy. While there is a long way to go, the work must be done on several fronts, and it can be said that the beginning has been made. If we review what has been done in the last 10 years of Modi administration, it has strived to do a lot of groundwork. The basic groundwork involved providing the roti, kapda or makan, basic sanitation, water, and power to the bottom of pyramid. Without lifting these people out of abject poverty, no progress can be made on the goal of becoming developed. And to a great extent, all of this has been achieved. The government statistics show that 25 crore people have been brought above the poverty line. Perhaps a lot of it can be witnessed by us all to some extent when we just look around. The programs and allocations made to various schemes in this budget strive to build on what has been achieved over the past years and attempt to accept and incorporate several of the suggestions made by stakeholders. The public spending on building infrastructure has been kept sustainable, since that is the backbone of any economy to grow. Unless we have proper infrastructure, unless we have the ability for our manufacturers, for the producers, whether small scale, large scale, or even cottage industries, to be able to send their ware quickly to the marketplace, there is no way we can grow. There is no way they can carry on business at a sustained level. So this is something which is extremely, extremely important and actually a backbone. Likewise, a whole host of welfare measures for the bottom of the pyramid have been proposed. The budget has a significant focus on employment, skilling, and support for medium, small, and micro enterprises. A slew of measures have been announced to implement schemes for industry to create more jobs, for making youth employable by skilling them. Just because we have demographic dividend, the only way we can reap the dividend is by ensuring that the youth of the people of the country is able to deliver the skill set that is required for them to be productive. And that requires a lot of skilling education, which at the moment, unfortunately, is not provided by neither by our schooling system nor by our universities at the level that it is required. So therefore, the youth which is already out in the job market and is more or less unemployable needs to be skilled. And therefore, several projects have been announced, several measures have been announced. These include both financial and policy-based support. And this is, as I said, critical step towards addressing unemployment and underemployment, ensuring that the workforce is equipped with the necessary skills for the future. There is clear commitment to policy continuity, economic reform, and addressing pressing socio-economic issues such as employment generation, rural and farm distress, and overall economic growth. The finance minister needs to be lauded for remaining and having allocated all of these things without being lured into giving populist measures. She needs to be lauded for remaining on the path of fiscal prudence, despite a lot of pressure on including populist measures. The commitment to reducing the fiscal deficit to 4.9% from 5.1% in the interim budget, with a few further target of 4.5% for the next year, reflects a prudent approach to fiscal management. I will now walk everyone through some of the major direct tax propositions, which I'm only going to mention for everyone to be prepared to receive more detailed discussions on them in the subsequent sessions, which you all will enjoy. There is a commitment to make tax administration simpler and expand tax base. To this end, it has been promised that the current Income Tax Act will be replaced with a new tax code. This new tax code is intended to make it simpler to understand, apply, and implement, and reduce tax litigation, as well as provide tax certainty. While the promised simplified tax code is at least 6 months away, the finance minister has spearheaded some direct and indirect tax measures, which will be discussed today, as I said, in the subsequent sessions. And I would just like to give an overview of what is proposed. First and foremost, and a very glaring one, is an overhauling of capital gains tax regime. Let me assure everyone here that this was an ask from all stakeholders for a long, long time. The new regime becomes effective immediately, that is from 23rd July 2024. FAQs to clarify what these changes are and how they work have been issued. The change in capital gains tax regime is explained by the FAQs as follows. And these are the major aspects of this policy change, regime change. Holding period has been simplified. Now there are only 2 sets of holding periods. One, more than 12 months for all listed securities to qualify as long-term capital asset, and more than 24 months for all other assets to qualify as long-term capital assets. This replaces the maze of different holding periods for different classes of assets. When I was writing my ready reckoner, and I was listing down the various holding periods required for various assets, I was just thinking that having practiced this for such a long time, if I find this to be such a maze, I don't know how the taxpayer himself, especially a person who is investing in India, would be looking at it. It gives me a great joy to know that this has been streamlined to bring just to 2 holding periods with just the 2 sets of classes of assets. Rates have also been rationalized and made uniform for majority of assets. Indexation has been done away with ostensibly for ease of computation, but there is simultaneous reduction in the rate of capital gain, long-term capital gains tax from 20% to 12.5% for all long-term capital assets. Now, there is a debate about whether the indexation on real estate having gone is something which is fair or not. But as far as the financial assets are concerned, it would seem that that would more or less take care of by reduction from 20% to 12.5%. Of course, it's going to be a touch and go situation, but at least we now have only one capital gains tax rate. Resident and easier computation. Resident and non-residents are all at par, both in terms of holding period and the rates of tax. Rollover benefits, as were available for long-term capital gains, is still remaining, and it will continue to be available. And this must be noted that almost all developed countries in the world do not have anything like a rollover benefit. India is probably the only one of the world which has this benefit, and this needs to be recognized. There's going to be a huge reduction in the withholding tax rates for e-commerce participants from 1% to 0.1%. This is a big ask that e-commerce participants had, because their cash flow, which is not a huge one, was really getting impacted by the 1% withholding tax, because not only their cash flow was being impacted, but their tax rate itself may not be all that large, because e-commerce participants today could be a very, very small participant whose turnover is no more than 5 lakhs in a year or something like that, but with the potential to be able to grow. So this puts a significant amount of cash back in their hands and increases their ability to participate and grow more. Removal of equalization levy on e-commerce operators. This is something which is not under the Income Tax Act. It is under the Finance Act. And for those e-commerce operators who did not have a permanent establishment in India and whose income was not otherwise characterized as royalty or fees for technical services, were not paying any taxes in India, despite the fact that they were conducting a lot of transactions in India. And so therefore, the income from their operation it was felt that India lost the ability to tax them for income from their operations, their income which accrued to them from India. So as you may all be aware, that this has been India's complaint for more than 20 years. And in the last 8 years, India gathered together with G20, spearheaded this movement, and the OECD also joined in, which is called Base Erosion Profit Shift Initiative. And Action 2 of that has been looking into removing this complaint of the developing countries, which are called market economies. A global consensus by the G20 and the OECD is more or less there for Pillar 1 solution, which allocates some tax to market economies earned for the revenues earned from the market economies. While that was being put in place, the developing economies, many of them, were permitted to have their own measures to try and protect their tax revenues. And this included imposition of equalization levy, which India did 2 years ago, I believe 3 years ago, at 2%. This is now being removed with the hope and expectation that Pillar 1 proposals will be implemented fairly soon, and India will get its tax dues under Pillar 1 as will be available to it, being a market economy. There are also several reductions in TDS rates from 5% to 2%, putting significant amount of cash flow back in the hands of those people. And these, if you will go through the list, you will realize that they are not necessarily large players who were being subjected to 5% TDS rate. So this is going to really boost their cash flow. A large chunk of government's tax revenue is blocked in tax litigation. We all know that all tax litigation is not necessarily resulting in favor of the revenue department, but quite some amount of it is, and we all also know that a lot of times the tax officers tend to keep going into appeal for something which is extremely clear that the law is in favor of the assessee, and this all clogs up the tax revenue in litigation. So in order to remove this backlog, again, the government has taken 2 measures. One, it has brought in another 𝐊𝐴𝐳-𝐵𝐻 scheme 2. I'm sure people will talk about it later in the sessions. And the second one is that there is an increase in threshold of disputed tax for the department to appeal to the higher forums. Lower taxes are sort of, given to salaried people. Salaried people have been asking, salaried people, quote unquote, middle class, have been asking for some relief measures. And this has been done by lowering the taxes on them through the new tax system. The slabs have been changed. There is an increase in standard deduction and increase in the deduction available for contribution to NPS. One of the other things which is also very important for putting cash back in the hands of salaried people is that if the salaried person has been subjected to TCS, then that TCS will be available as a credit against the salary, the TDS of the salary of the salaried person. This should really put some amount of cash back in the hands of the salaried person. With the intention to provide more impetus to domestic tourism, especially through waterways, a new presumptive taxation regime has been provided for the non-resident shipping companies operating in domestic cruises. Another loophole that the government has tried to plug is that it is with respect to what is popularly being called the buyback tax. Now, when the system of taxing dividend changed from dividend distribution tax on the company to a tax being levied on the shareholder at the applicable rate to the shareholder, the provision for buyback under Section 46A did not change. And this was used, and in the language of the Revenue Department, misused. What I would call it was arbitrage. the large shareholders did not take dividends, especially this especially applied to closely held companies and companies which were held by non-residents, and most of those companies which had large promoter holdings, etc. Not too much for the purposes of taxation by listed companies, though also by them sometimes, but mostly by large unlisted companies. And what happened is that the company was buying back the shares from the shareholders, and whatever consideration was being paid to them was characterized as capital gains. That is, the consideration minus their cost of acquisition was characterized as capital gains. In most cases, it would have been long-term capital gains, and therefore the tax being paid was much lower. At the same time, what the company was actually doing is using its accumulated profit to distribute to the shareholders. That is what actually was happening in reality. That was the factual thing. So this is now being changed. Now the entire consideration being paid by the company will be taxed as deemed dividend in the hands of the shareholder. Shareholder will be given a reduction, a set-off for capital loss that has been incurred for the surrender of the shares. So this is something which is a new provision and a very, very far-reaching provision. Now it is also proposed to have withholding tax of 10% for any payments being made by a partnership firm to partners. This includes their salary, remuneration, interest, commission, etc. payments. Now, that there is going to be some issue with regard to salary, especially, which is normally treated as part of the profit distribution to the partner. So how this credit will come in their hands is something that the speakers who deal with this provision through the day will be dealing with. Another provision which is very interesting is, as we all know, Section 56(2)(10), we all call it introduction of gift tax from the back door. What it really means is that only when the gift is received from a relative or it is a transfer to a trust, a private trust set up by a person for the benefit of his or her relatives, then the recipient was not taxed on the asset being received, on the value of the asset being received. In all other cases, any person receiving gift of any nature would be taxed if the value of that gift was more than 50,000, including a transfer to a private trust by any person for anyone else. This was there in Section 56(2)(10), or it has been there in Section 56(2)(10) ever since this section has been expanded in its operation. However, the exemption that was available in Section 47(3), Roman 3, was not changed. That exemption was that any person making that when a person makes a gift or transfers any asset to an irrevocable trust, which is not a private trust, as I said, for the purposes of the person's relatives, then that transaction was not treated as a transaction which was subject to capital gains tax. It has now been, both these sections, Section 56(2)(10) and Section 47 Roman 3, have been aligned. Now Section 47 Roman 3 says that gift or will or inheritance own or transferred to an irrevocable private trust are only exempt from being treated as transfer for capital gains if that is made by individual or HUF. All other parties will be subjected to being treated as having transferred, and capital gains tax provision will be attracted. This could result in taxation being levied both on the transferor under Section 45 of the Income Tax Act and on the transferee under Section 56(2)(10) of the Income Tax Act. Double taxation. I'm not entirely sure whether this is with intention, but it seems to be that this is something that the government wants to discourage. An important amendment also is made in respect of charitable trust, in that a merger between two charitable trusts where both of them are charitable will no longer be considered to be converting that conversion of the transferor charitable trust into a for-profit entity, and hence it would not attract the exit tax on the assets transferred in the hands of the transferor trust. I now briefly talk about the indirect tax provisions, which are large in number, but these changes are mainly focused on promoting domestic value addition, reducing trade bottlenecks, curbing litigation, and improving the ease of doing business. A key proposal is to comprehensively revamp the customs duty rate structure over the next 6 months. And the proposed amendments to the GST laws are largely based on the recommendations from the recent GST Council meeting. I am happy now to hand over to Ridhima, who will introduce the next speaker and take you through all the finer details of direct and indirect taxation.
Thank you so much, ma'am. You actually set the tone right with all the comprehensive analysis at one stage. Thanks a lot. Before we let you go, just one couple of questions we had. Can I take that?
Yes, please, go ahead.
So I just wanted to know, since we are talking about an overview of the budget, and we saw that Finance Minister clearly told that she will be simplifying the income tax provisions further in the next 6 months. What major change you see coming specifically in income tax when she says simplification of the income tax?
Well, this is like gazing in a crystal ball. To be very honest, everyone is very tight-lipped about it. And it would be preposterous on my side to try and understand it. But what I would expect is that currently the Income Tax Act is extremely patchy. If
Right.
you want to figure out what is the tax provision in relation to any particular transaction, situation, or person, you have to, refer to so many provisions. Even the section itself says so and so as referred to in another section. So you have to go to that section. That section takes you to another section. Then there is a proviso somewhere. And then there is a rule somewhere. Then there is a
Correct.
CBDT notification somewhere. Then there is a CBDT circular somewhere. So that whole maze is making it extremely complicated. And what happens is a lot of times in their desire, the taxpayer in their desire not to pay up more than what they should be paying, and the tax advisors in their desire to help the clients to achieve that, end up advising something which may be missing out on something. And then again, you have Supreme Court ruling on certain aspects, which may be very, very different from the interpretations that everyone else has had, and an interpretation also from the plain reading of the provision. So there is a huge lot of complexities, which and what happens is, as soon as Supreme Court rules in favor of, on a particular provision, interpreting a particular provision of law in favor of a taxpayer, then the tax department feels like they have been cheated. They really wanted to tax that, so they want to make the change. And in the next budget, they bring in that small little change to overturn that Supreme Court decision. And what happens? That creates a lot of complexities or anomalies or contradictions. So this is the kind of one case that I would like to mention here is 𝐊𝐶𝐲𝐻𝐼𝐴, where the fees for technical services, it was an amazing decision, to my mind, with all due respect to the Supreme Court. Maybe they weren't pointed it out properly. They actually referred to the wrong subclause of that section 9(1)(6). Okay. And what happened? The tax department immediately changed it in the next budget to say that whether you have a presence in the country or not, you will be taxed on such and such a thing. Now that doesn't happen. That doesn't get translated into to non-residents being taxed, because non-residents are eligible to double taxation avoidance agreements also. Okay, so they won't go by the Income Tax Act, but that's what happens. But that has made the Income Tax Act more complicated. So this is what has happened. So I am assuming and hoping that those kinds of situations don't arise. The drafting is done in a well thought out manner, and the rules are also made which are consistent and not contradictory. If you see the valuation rules, there are valuation rules all over the place. For one type of section, you have one valuation rule. Another type of section, you have another type of valuation rule. And, when is that rule to be used?
Right.
It's a very complex. That is one of the things where the indexation benefit is being removed, because that was also causing a lot of
the very controversial one. I guess it would be a hot topic today throughout each session. Great. Thank you so much, ma'am. It was a pleasure having you.
Thank you. All of you, goodbye, and have a great learning session ahead. Enjoy. Bye-bye.
Bye-bye. Thank you. Great. That was a pleasure having her. So now we'll proceed to the next session, focusing on the changes in personal taxation. Joining us, we have Tarun Garg as subject matter expert. So Tarun brings over 13 years of extensive experience in compliance and advisory work, including assigning taxation, representation before income tax authorities, appellate authorities, TDS authorities, and provident fund authorities. So he specializes in expatriate taxation, social security matters, managing diverse portfolio of clients, including both multinational and Indian corporations with globally mobile workforce. Greeting, Tarun. It's a pleasure to have you here.
Thank you so much, Ridhima, and I look forward for an interesting conversation. And I hope I'm able to kind of answer some of the questions that the team and the joiners have.
Yeah, the personal taxation is everyone's favorite topic, so I can see a lot of questions coming. All yours now.
Thank you so much. So let me just try and present my screen.
Yeah.
Just let me know, please, once the screen is visible.
Sure. It is. You can share it on the slide share mode.
Yeah. I hope it is visible now.
The slide share isn't. Just one moment.
Is it visible now?
No. We had the PPT on the screen, but the slides, the slideshow, the show mode is not there.
Has it come now? Still no?
Better. Yeah, that perfect.
Okay. So good morning, everyone. And Ridhima has already kind of introduced me. So now and then in the interest of time, let me just quickly take you through the personal taxation provisions that have kind of come up in the budget. We will start with the individual tax rates and deductions, and then we'll go to some of the income tax scenarios. Here, I'll present a few examples to kind of explain to the audience that how the tax sort of savings will arise, what is there in the old tax regime, and what is there in the current or the new tax regime. Then certain provisions relating to the TDS TCS matters for the employers, while my co-panelist has already kind of explained, but we'll have some deep dive into it. Then other certain key announcements which are relevant for the personal from a personal tax perspective. We'll also look some bit of analysis on the capital gains, what are the holding period, how it has been rationalized, and then a few interesting aspects on the employment linked incentive schemes and the internship scheme that the budget has kind of focused. So let's just move towards the individual kind of tax rates. Okay. So, what the budget has done is, so anyone who is opting for the new tax regime only is basically getting benefited. So there are no specific changes in the old tax regime. So old tax regime, the rates therein remains the same. But what the budget has done is certain changes are there in the new tax regime. So what we are seeing is that the base threshold is basically remaining the same. It is up to 3 lakh, there is no tax. Now, what the finance minister has done is in the next slab of 3 to 6 lakh, which is kind of there as of now, she has increased 1 lakh therein. So now up to from an income of 3 lakh to 7 lakh, there is a tax rate of 5% which is applicable. So clearly there is a tax saving of 5,000 rupees in this. Now, when we see for financial year 23-24, the next slab starts from 6 lakh to 9 lakh. So how it has been changed again is from 7 lakh to 10 lakh. So there is again 1 lakh addition to that. So that has again will attract a 10% tax rate. So which clearly means on 1 lakh, 5% benefit, which is 5,000 rupees, which is coming from here. Then the remaining broadly the slabs are same. So earlier it was 9 lakh to 12 lakh, which was 15%. So currently for financial year 24-25, it will be from an income level of 10 lakh to 12 lakh, the tax rate of 15% will be applicable. Then the rest of the slabs are exactly the same as the current slab structure, which is 12 lakh to 15 lakh of an income will attract 20%, and the above income of 15 lakh will continue to attract a 30% tax. Now, what additional change that has kind of done in the new tax regime is the standard deduction. So currently, when we see financial year 23-24, there were slew of changes that had been made in the new tax regime. Introduction of standard deduction had happened in 23-24. Then the surcharge rate for high income group people was kind of drastically reduced from 37% to 25%. So that those changes had already been made. Now, with that intent in mind and to further promote the new tax regime, a standard deduction has been further enhanced from 50,000 to 75,000. What we also see is that for any taxpayer who is kind of having a family pension income, there is a slight enhancement in the family pension deduction from 15,000 to 25,000. So what it overall means, the enhancements of standard deduction results in another tax benefit of say 7,500. So how does it is basically arriving on a enhancement of 25,000. If we apply a 30% rate, it comes out to be 7,500. So in net 10,000 plus 7,500 is 17,500 is the overall tax benefit that will go in the pocket of a salaried individual. Now, if we add a cess to it, education cess, it comes down to 18,200. Now, I would also like to basically add one more thing, the change that has happened in the new personal tax regime, which is enhancement of the employer's contribution towards the new pension scheme from 10% to 14%. Now, that benefit basically comes to the individual taxpayers under Section 80 CCD, subsection 2. So the corresponding changes also happened under Section 36, subsection 1, clause 4A. So which means that the employers who are kind of contributing this 14% of basic salary as contribution for national pension scheme for an employee, there also they'll be eligible for a deduction. Now, what it overall means is that definitely from a tax standpoint, additional tax savings in the hands of the individual. Now, one thing that I would just like to call that out is, look, the overall intent of the government has been that people kind of chooses or shifts towards the new tax regime. Now, the current data that the government was sharing in the budget was that almost two-thirds, which is 66.66%, people have already migrated from the old tax regime to a new tax regime. So again, only changes has kind of come into the new tax regime. Now, moving forward towards some of the other changes that are important is that from a salaried individual, this TCS and TDS, this credit can be set off. My co-panelist had already kind of shared some perspective around it, but let me just tell you how it is kind of happening. Now, look at a situation where an individual is having a minor child. He travels for education towards to an overseas country, say US, UK. There, he has to pay TCS if he's kind of traveling abroad. There, that TCS was also not kind of eligible against the TDS credits for the employee. Now the employee can very well declare that TCS that has been withheld in his minor child's name, and then he can claim that credit against the taxes on the salary income. Again, very welcome step. The reason for this is that the credit for TCS was earlier available only by virtue of filing the return of income, which typically meant that a person has to wait for around, say, 14 to 16 months to avail that. So again, a very welcome kind of a change. Now, and one more important aspect on the NPS that I just wanted to call out is employers will certainly need to watch out for the fact that supposedly, if the employee declares that he's opting for a new tax regime at the payroll stage, and consequently the employer has contributed 14% of basic salary towards the NPS, but finally at the return filing stage, if he switches back to the old tax regime, then that 4% deduction will be reversed. So that's how the changes are, and one has to kind of look out for that, how it will span out. Now, moving to the one example that I just wanted to call out, how the new tax regime is beneficial. So let's just take some examples. So here I've just taken an income of 7 lakh, 20 lakh, 35 lakh, and 55 lakh. So overall, what we see under the current new tax regime, at an income of 7 lakh, there is a zero tax. So for financial year 24-25, that tax will continue to be zero. But under the old tax regime, that tax comes out to be 40,040 rupees. So this is just an example that we are talking about. Here we have just considered a small amount of deductions under the old tax regime. Now, similarly, if we look at a salary number of 20 lakh and 35 lakh, what we see is an overall sort of a tax benefit that is kind of flowing of around 18,200 to the taxpayer. Obviously, the old tax regime is not preferable because it is leading to a higher income tax payout, which is in the range of say 3,66,600 and 7,87,800 at an income level of 20 lakh and 35 lakh respectively. Similarly, for senior citizens also, we see the old tax regime is not at all beneficial, and only the concessional or the new tax regime is giving the desired tax benefits. So clear intent has been that people kind of migrate towards the new tax regime. Now, one important question, and that has been coming up in the newspapers, are that and there are lots of questions that have been asked to the CBDT director, Mr. Ravi Agarwal as well, that whether this old tax regime will be phased out. While the government has been tight-lipped around about it, but then obviously they are saying that if majority of the people sort of migrates towards the new tax regime, then definitely they will kind of see for a kind of a phased out approach of the old tax regime. But definitely it will not be an immediate phased out that is going to happen. The old tax regime payers, generally what we see are the ones who are availing a big amount of HRA benefit, a housing loan benefit, or say ATC, ATD, they have invested a big time into that amount. So there we see that people still opt for the old tax regime. Now, in terms of an interesting statistics or a data point that I would want to share to the audience is that what is the inflection point? How to decide that whether a person should continue to remain in an old tax regime or should migrate to a new tax regime? Well, let's just assume if you have an income of 15 lakh or more and ignoring, say, standard deduction, because under the new tax regime, it is 75,000. Under the old tax regime, it is 50,000. But the inflection point is broadly 4,33,333. And it will continue up till the income level of 5 crores, because the surcharge and the cesses are basically the same under at that point in time under the old tax regime and the new tax regime. So if you are having an income sort of exemptions or deductions greater than 4,33,333, if you are having an income of say 15 lakh, more than 15 lakh, there you can continue to stay in the old tax regime. But if the investment deductions limits are lesser than that, then the new tax regime will give you the beneficial tax. Let's just move to the next slide. Of some rationalization of the TDS TCS provisions for the employers. What we see is that TDS TCS provisions are being rationalized, and this is basically with an intent to relax the compounding provision. I'll give you one example under section 276B, which basically talks about say launch of prosecution if the employer has say withheld taxes on the salary, but he's not deposited that by the due date. Even a 1 day delay could have kind of attracted those prosecution provisions. So with that intent of rationalization and sort of kind of benefiting the taxpayers, this provision has been kind of come up. Now, in certain cases, what I have seen is that there was a 1 day delay. Instead of a 7th of the subsequent month, the taxes were kind of deposited on 8th or 9th of that month, maybe because of some payroll software change, or that person who was managing the overall salary payments was on leave, or because of some emergencies also that was there. While there were certain safe harbor provisions, but then it it still kind of had called for a launching of prosecution proceedings on the employer. So that has been kind of changed. And then what the new this budget has kind of called out, that if the taxes or the TDS deducted is paid within the due date of filing the TDS return, then the prosecution provisions will not apply. And this change is effective from 1st of October 2024. Again, a very welcome step. Now, if we look at the standard operating procedures for TDS on defaults, that will be notified in times to come. And the government and the finance minister has already said that in next further 6 months, there will be a slew of changes and slew of rationalization, simplification measures that is going to happen. And in this budget, we have seen certain provisions already being kind of simplified with, say, for example, TDS provisions also, and in terms of capital gain provisions as well. Now, this budget also has kind of provided a time limit for correcting the TDS TCS statement. So earlier in there is no provision which basically kind of limits that up till when these TDS TCS statements can be corrected. Now the default timeline has been put for 6 years from the end of the financial year. Another one more important change under section 271 capital H is that, like, for non-levy of penalty for basically not filing of TDS TCS statement, the current provisions provided for a 12-month time frame post the due date of furnishing such statement. Now that time limit has been reduced from 12 months to 1 month. Another important change that we see from an individual tax standpoint is that interest rate for delayed payment of TCS is now in line with the TDS provisions, which is 1.5%. So what we see is that if one has deducted the TDS not deposited, it used to attract 1.5%, but same provision was not there for TCS. So similar provision will now be applicable for TCS as well. Okay, so now let's basically have some deep dive onto other key announcements that the budget is making from a personal tax perspective. This is very important. The first point is very, really interesting and important, is that say what we see is that, like, people who are working in MNCs, the foreign parent, they used to kind of allot ESOPs under their stock option plan, and these shares are typically held in the overseas demat accounts. So what the finance minister had said, and it is also very evidently kind of written into the memorandum to that budget, is that sometimes these taxpayers, not with a malified intent, just forgets to report these overseas assets, and these are not very huge value, which is say up to 20 lakh. There she does not want to penalize such taxpayers under the Black Money Act, because the penalty under Black Money Act is really, really substantial, which is 10 lakh rupees. So that's how she has said that if there is a non-reporting of these small value of foreign assets, that will not attract penalty under BMA. Now, the current provision of under the BMA had already had one provision that if the aggregate balances in the foreign bank account is up to 5 lakh rupees, then also that penalty of 10 lakh will not be kind of is not leviable. That limit has been enhanced from 5 lakh to 20 lakh. Now, this next provision is in regards to the purchase of immovable property. What we have seen is that many of the buyers they used to apply that per transaction wise, and there were multiple sort of buyers in a property. Now, the budget has clarified that, look, this limit will be applicable on the total value of or total value of that property, and not just you just split that transaction wise or buyer wise. So if a property is say worth of say 80 lakhs, and there are sort of two buyers therein, so currently some of the buyers were taking that plea that I am paying 40 lakh, the other buyer is paying 40 lakh, so this TDS provision is not applicable. So this budget has clarified that it is on the purchase or the value of that immovable property, and if it exceeds 50 lakh, then this TDS provision under 194 IA will be applicable. And this change is again effective from 1st of October 24. One another important point that I just wanted to highlight is purchase of certain luxury goods will now attract a TCS. So what used to happen is, obviously, on say cars value exceeding say 10 lakh, this provision is already there of 1%. Now they have said that the luxury goods, if you're say purchasing very expensive bags, very expensive perfumes. Obviously, that list of luxury items shall kind of come out shortly. But as of now, the government has not prescribed it, but the government is specifying that these luxury items will also attract a TCS. This change is also very welcome. The fourth point on the reduction of the TDS rates from 5% to 2% on the rent payouts. So what we see is that people they take property on rent, and then the overall rental amount is say in excess of 50,000 per month. Then they were required to deduct 5% of the total value of the annual value of the rent and the last installment. And then this was supposed to be deposited by, say, 30th of April of the subsequent financial year. Now, that rate has been changed, brought down from 5% to 2%. And this change is again effective 1st of October 2024. So this change has happened under Section 194 IB. The fifth point is basically in regards to a tax clearance certificate. Now, the budget has specified that if you're obtaining a tax clearance certificate, it will also require clearances under the Black Money Act. So, to give a background that, say, foreign expats who come to India for work, they are basically required under the Income Tax Act to file a Form 30A and obtain a clearance under Form 30B from the income tax authorities that, well, I have paid all my taxes to the authorities, and then now I am finally leaving the country for good. So that basically, even at the immigration and airports and all, while clearances, the authorities can ask them that, hey, have you obtained a tax clearance certificate? While it is not being insistent upon, and in some cases, we see that there, like say at some airports at Hyderabad, Bangalore, we have seen certain cases that the authorities asking the expats whether they have taken a tax clearance certificate or not. But now the government has prescribed that you have to obtain a clearance under Black Money Act as well. So this is the last point is again very consequential. They are saying that Aadhaar enrollment ID is now getting discontinued. The reason for that is now most of the people, they've already have Aadhaar numbers. So they are saying that either you quote your PAN numbers or you basically quote Aadhaar numbers in your ITR. So, and yeah, and this Aadhaar enrollment ID shall be discontinued. Okay, so moving on, these are basically capital gain provisions that has been substantially rationalized, and my co-panelist has already kind of clarified how, as a measure of simplification, the capital gain structure, the government has tried to simplify it. Now, the holding period is broadly, say only a two holding period, which is say up to 12 months and then up to 24 months for short term. And then for long term, it is greater than 12 months and greater than 24 months to be categorized as an asset to be a long term asset. The only exception is in case of the slump sale. My other panelist will take it up. But broadly, they have kind of kept it as a holding period only two, which is 12 and 24 months. So this is a big relief for unit holders of REITs and InvITs also, because currently it is 36 months and it has been brought at par with, say, other listed securities, which is 12 months or more. Similarly, the holding period for, say, gold or bonds debentures has been kind of reduced to 24 months from a 36-month current period. Now, what are the other changes that we see under the capital gain structure is that the section under section 111A, the tax rate has been enhanced from 15% to 20%, even if you have paid a securities transaction tax, it is levied. So clearly the government is kind of enhancing some tax over it. And eventually on the long-term capital gains also, say, obviously the indexation benefit has been taken away now, and the tax rate has been enhanced from, say, 10% to 12.5%. So there also we see a 2.5% increase in the tax rate. One benefit that the government is giving is that under 112A, the limit for exemption was 1 lakh. That has been enhanced for listed financial assets if the person is selling them from 1 lakh to 1.25 lakh. So broadly, indexation benefit has been withdrawn. What we also see is that non-resident investors on unlisted securities, now they will have to pay a higher capital gain. So earlier it was say 10%. Now they have to pay a 12.5% capital gain tax on it. But one important point that I would want to call out over here is that on unlisted securities, there is no securities transaction tax. And there is an enhancement in the securities transaction tax rates also for FNOs and all. So there is still a scope for some change. Probably that will be addressed in the subsequent budget. Okay, so now moving on, this is just a I just tried to present in a tabular form that prior to 23rd of July 24, what is the holding period and tax rates under the capital gains, and what is the tax rates post 23rd of July 24 for resident and non-resident. So what we see for listed securities, units of business, trusts, and equity-oriented fund, the tax rate for resident, non-resident was 10%, and it has been enhanced to 12.5%. So for unlisted shares of a closely held company, 20% basically with indexation, 10% is available to a non-resident because non-resident cannot avail the benefit of indexation. So that has been now enhanced to 12.5%. Listed debentures, the tax rate applicable for resident, non-resident is 10%. That has again been enhanced to 12.5%. Unlisted debentures, what we see for resident, the tax rate is 20%, and for non-resident, it is 10%. So broadly, what the budget has called out that now normal tax rate shall be applicable as the asset is now deemed to be a short-term capital asset. So there is a corresponding change under Section 50AA that they have mentioned, and these assets are now being categorized as a short-term capital asset. And there is also a change under 242A. So slump sale of an undertaking, it is 20% earlier. Now it is again 12.5%. So there we see a benefit to overall business taxpayers and all. For immovable property, again, a very interesting point. What we see is that, and that's how what we are seeing a lot of hue and cries being kind of made, that they were eligible for an indexation benefit on the property. So, and the tax rate with indexation was 20%. So obviously that rate is now 12.5% and indexation benefit has taken away. So just consider an example that Mr. A, he has purchased a property in say 2008 or 2010, and it was for say 50 lakh. Now, if he's selling that property, say 3x at 1.5 crore. So by virtue of indexation, typically the entire enhancement in that property value was taken away if we'd applied that cost inflation index. So eventually the tax that was kind of coming out in this situation was almost or closer to zero. But now there will be no indexation, so which means on 1.5 crore less, which is the sale consideration less the purchase cost, which is 50 lakh, 1 crore, you have to pay a tax of 12.5%, which is coming out to be 12 lakh 50,000. So that is the change, and that's why people have kind of raised that, look, there is an enhancement in the tax overall or outflow that is coming up. Other changes are in terms of short-term capital assets. Also, what we see is that the tax rate has been enhanced from 15% to 20%. And again, one important change is in terms of listed debentures. Earlier, the normal tax rates were applicable. Now that has been limited to 20%. Broadly, this is the overall kind of a tax structure in terms of capital gains. Okay, now we'll just move forward and this while this is not tax, but now there are couple of other important announcements that was made in the budget. It is in terms of ELI, which we call it's employment linked incentives. So previous few budgets has talked about PLI, production linked incentive schemes. So now they have shifted their focus towards ELI as well. Uh, Obviously, what we were seeing in the current macroeconomic scenario, there were unemployment rates that was kind of increasing, and in order to address that, there are three schemes that the government has unveiled. Obviously, the detailed fine prints are yet to be notified, but in the annexure to the budget speech, the government, the finance minister has briefly touched upon what these schemes are all about. So broadly, first scheme, what we see is it's a subsidy to the employees. The second scheme is subsidy to both the employer and the employee. And the third scheme is basically a subsidy or a reimbursement to the employers. So talking about the first scheme, the government is, and one important call out over here is that when we look at the deeper analysis of all these three schemes, these are applicable and targeted to employees who are drawing monthly salary up to 1 lakh rupees. So this is a commonality across all the schemes. And so under like let's just look at the first scheme. So first time employers, what the government is kind of saying that if you have not at all registered with the EPFO, so the government is giving them a 15,000 1 month wage, because the threshold limit under the Employees Provident Fund Act is 15,000. So that's how the government is saying that this 15,000 amount shall be given by the government to the employees, and that will be given in 3 equal installments. So one question that may arise is that, like, look, the employers have to keep these first timer or new employees with them for 12 months, and the subsidy will be need to be refunded if the employer uh, uh, sacks or fires these employees, or their employment ends within 12 months. So whether why the employer is basically being forced to give back that amount. So see, the broad contours have been kind of mentioned. As of now, the detailed provisions will be unveiled very shortly. But broadly, what we see is that it is for the focus of the scheme is towards generation of more employment and all. And can the employer reduce or take back that subsidy, because it is over and above, and the employer cannot just reduce whatever 1 lakh wages that they are supposed to do. But can, if the employee himself or voluntarily leaves the company, can that be reduced from the full and final settlement of the employee? That is something to be kind of seen. Now, the second scheme, what we see is targeted towards the manufacturing sector. It is applicable for 4 years. And so what the government has saying that 24% of the wages, which is split between employer and employee equally, which is 12% and 12% of 25,000, which comes out to be 3,000 per month, will rather 3,000 per year, will be given to the employer and the employee. And in the second year, that subsidy is 16%. And yeah, and in the third year, rather in the fourth year, it is 8%. And in the first 2 years, it is 24%. So that's how they have framed up the overall provision. So how the rationale, the calculation comes out to be that in the first year, 3,000 rupees will be given both to the employer and the employee. In the second year, again, that calculation comes out to be 3,000. In the third year, it is 2,000 rupees. And in the subsequent last year, it is 1,000 rupees that will be given to the employer and employee by the government of India. The broad conditions around this is that, again, you have to generate additional employment, and it is specifically for those corporate entities or who are already kind of registered with the EPFO, and for the non-corporate, say LLPs and all, they should have a 3-year track record with the EPFO. So you have to increase your headcount by a specific threshold which are there in the scheme. Now, Scheme C is basically in relation to reimbursement to the employers. So I'll give you an example why the rationale was kind of given, and I was even hearing the interview of the finance secretary. There, he was basically trying to clarify that why the Scheme C is also kind of brought out. The Scheme C is targeted to those employers who can sort of hire employees additionally, but then they have to choose between either to get that work done via machines, or they can get that work via labor and all. So there, that in order to kind of take that financial decisions, if that 3,000 per month for 2 years, that kind of a subsidy is being given by the government of India, then it may change to an extent that financial decision, that instead of you getting that thing done via machines, or say through capital incentive sectors and all, but you hire further employers and generate more employment. So that was the overall intent. So now employers who are catering more than 1,000 jobs, they will be eligible for reimbursement every quarter for an additional period of 2 years. And again, there is no requirement as such that the employees need to be a new entrant to an EPFO. There can be an old or already registered person as well. But the baseline hiring has been, or the threshold has been prescribed, that for an organization who is having a headcount of 50 employees, or up to 50 employees, they need to have increased their headcount by 2 employees. And for those organizations having a headcount of 50 or more employees, they need to increase their headcount by 5 employees. So that's how the schemes provisions are there. And corresponding benefits can also be clubbed. But one important point to note is that Scheme B is only for the manufacturing sector, and Scheme A and Scheme C are sector agnostic. So one can choose between which schemes that they want to kind of go with. And broadly, all schemes are for 2 years, and some of the schemes it is mentioned that will be enhanced. That is, a Scheme B shall be further enhanced for a period of 2 years. Now, moving to the scheme of internship, again, the target of the government is that people who are within the age of 21 years to 24 years, they are eligible. And from tier 3 or tier 4 cities, they can apply for internship program under this scheme. And there are list of ineligible candidates that they have specified. But the broad intent of the government is that uh, to increase the employability of these interns and the youth. Because what we see in our tier 3 cities or tier 4 cities, there is a problem of employability because of lack of skills and all. So that is why the government has unveiled this scheme. So overall, the focus is that 1 crore youth will be skilled for an internship program with top 500 companies. And the condition for that is that it is applicable for those employees who are not employed in their full-time education. They're not doing any courses and all. Age criteria is there. Then the stipend that the government has mentioned is that they will give a 5,000 per month of stipend, which comes out to be 60,000 rupees. And one-time payout has to be given by the corporate, which is 6,000 rupees from their CSR fund. So overall training cost of 10%, say that is 10% of 60,000, which comes out to be 6,000, shall be borne by the company out of their CSR funds. Application has to basically mandatorily flow through the online portal, and companies, they can select who are the eligible candidates who can be trained via this internship program over the online portal itself. One important condition that this schemes calls out is that there is a mandatory requirement that 50% of the time for these new interns needs to be in the live environment, live sort of working environment, and it can't be just sort of a dummy environment, or they just are basically trained in a classroom training. They have to have that proper 50% of the time the work experience. Now, the overall this scheme is basically being phased in a two-way structure. So phase one and phase two. So phase one is initially for 2 years, followed by phase two, which is for 3 years. Now, list of ineligible candidates: somebody who's already doing a professional course, CAs, CMA, or if they're already basically enrolled with other professional courses, IITs and all, they are ineligible under this program. And this will be supported by the state government as applicable. So with this, I sort of end my presentation, but I'm happy to address any questions that the audience may have.
Thank you so much, Tarun. I think it was a much needed topic, especially for all of us individuals. And special thanks for covering all those detailed calculations and the employment scheme and the internship schemes. It will help a lot of young population doing it. So before we let you go, I have few couple of queries. Just a quick, since we are running very tight on time, just a quick thing. So do you think, as I asked Daksha also, so do you think in the coming next 6 months, we can see old regime totally scrapped off?
So very interesting, Ridhima. So what we are seeing is that, well, they may come out with disincentivizing the old tax regime, maybe say by virtue of increased scrutiny, and a slow processing of the income tax returns and all. But immediately, I don't see an immediate phase out. The reason for this is the old tax regime has been in the system for so long, and they cannot just immediately phase it out. And we are seeing the interviews, conversations with the finance minister, with the CBDT chairman also. There, they have also clarified that there is no as such plan to immediately phase out the old tax regime. But yes, as the government will continue to promote the new tax regime, which means there will be a further migration from old tax regime to new tax regime. We have already seen around two-third population has already opted for the new tax regime. So that trend will continue with them.
But do you think this will discourage people making tax saving investments ultimately? Will that have a domino effect?
It will, but Ridhima, I want to kind of clarify and bring to your attention that when the finance minister took charge and this 2020-21, the new tax regime was basically announced. The
Right.
moot point was that tax should not be, or tax saving should not be the criteria for your investments. So that was a clear indication that the government was making. You continue to make your tax savings. People do invest into, say, financial securities, they gain out of it. But the overall intent has been the tax saving cannot be the criteria for investments. But I somehow agree that it will, like, still many salaried class individuals still think of a tax angle before making any investment decisions.
Correct. Right. Absolutely. Even they are being sold in that name itself.
Yes, yes.
See, okay, so let's see what the budget holds in the next 6 months. But thank you so much, Tarun, for your time. And I am very delighted to see all those detailed calculations you did. Thank you so much.
Thank you, and my pleasure. Thank you, Rhythm.
Thanks a lot. So now we'll transition to our next highly anticipated session on the changes in corporate taxation. It's a pleasure to welcome Mr. Mukesh Butani. Hi, sir. So, Mukesh is the founder and managing partner of BMR Legal Advocates, specializing in corporate international tax, transfer pricing, and indirect tax. With over 30 years of experience, he advises multinational and Indian conglomerates on FDI policies, business reorganization, cross-border tax structuring, and tax controversies. An expert in international tax policy, Mukesh has contributed to landmark judicial pronouncements and served as an expert witness on cross-border tax treaties and transfer pricing matters. His publication include Transfer Pricing, the Indian Landscape, 2 decades on, Taxpayer Rights, Deciphering the Indian Charter, and co-editing credits to the General Anti-Avoidance Rules, The Final Tax Frontier. Mukesh is recognized by national and international forums, including the IBGA list, Legal 500, and Chambers and Partners. A warm welcome to you, sir. The session is now yours.
Thank you very much, Ridhima and Taxman, for inviting me. May I request you to put on the slides because that will be more efficient. I have what, 25 minutes to speak
So yeah, you have good 30 minutes to speak. Please don't worry about that.
Okay, fine. So if you can put up the slides in the meantime, I will. Do you have the slides? Okay.
Yeah, so it is being shared.
Yeah.
Yeah.
I will just keep on saying next slide. That would be more efficient. So what I intend covering, good afternoon, everyone. What I intend covering in the next half an hour or so, some of the key changes that have occurred by way of Finance Bill 2 2024 proposals and how they will translate and what kind of impact it will have on businesses and corporates. Please go ahead with the slides. The first issue that I wanted to cover is on buyback of shares. But next slide, please. On buyback of shares, I just wanted to take you briefly through the history because there have been many amendments that have occurred in the Companies Act. The Companies Act 1956 got transitioned into Companies Act 2013. Then we had a host of changes in the Income Tax Act. In fact, in the slides, I have not forgotten to capture one more change, which I discovered in the morning also, which was 2016 that occurred in the Income Tax Act. And I'll talk very briefly about that. But to understand the change that is impacting the changes that have been carried out in the Finance Bill of 2024, it's important to understand all these changes that have occurred. Some of them are directly linked, some of them are not linked, but there is a consistent effort that has been put in by the government to stop buyback of shares, as an avenue for shareholders to earn tax-free income. That's the overarching public policy objective. And I support it by saying that the buyback provisions were introduced in the Companies Act by way of an amendment in 1999. This is the amendment to the 1956 Companies Act, wherein Section 46A was introduced. And by virtue of that section, the tax on income on buyback in the hands of the shareholders was proposed to be exempt. Thereafter, if you may recall, the dividend distribution tax regime was introduced in Finance Act of 2003. And as a result of that, the taxation of buyback of shares, which was more in the area of characterized as capital gains, did not get impacted. So there was an avenue for companies that was inbuilt into the Companies Act, into the Income Tax Act, and now with the 2003 DDT introduction, a mechanism by which you could take profits through the buyback route with appropriate tax planning. Clearly, in 2013, the loophole was plugged. The government, with an endeavor to curb tax avoidance, and this initially was applicable to unlisted companies, brought buyback on shares on par with dividend distribution tax, recognizing that buyback is nothing but shareholders are benefiting, and there is DDT, so there should be BBT, BBT being buyback tax, exactly at the same limit. 20% was introduced, slightly at a higher rate, because the highest slab on dividend distribution tax really was 15%, and with surcharges it was coming to 18% or so. This tax was a tax in the hands of the company that was implementing the buyback. So shareholders were exempt. Specific provisions were there in the law to exempt the shareholders. In 2016, by the way, when this 2013 law came, the 2013 law specifically provided that buyback has under the Companies Act. Thereafter, many cases went to high courts where buybacks were being undertaken not under the buyback scheme of the Companies Act, Section 75, but under other provisions of the Companies Act. For example, reorganization, and hence the law was amended in 2016 again to say all forms of buyback, whether undertaken under the buyback provisions under the Companies Act or any other provisions of the Companies Act, or rather any act. As a result of which 2016 amendment came in. 2019 was a big amendment. In 2019, the buyback provisions, unlike the 2013 law, was extended from unlisted to listed companies. And then in 2020, when we saw abolition of dividend distribution tax, which was with a larger intent as to how should the dividend be taxed, did impact many forms of buyback, but buyback continued. Now, another important development that took place, which is neither Companies Act nor Income Tax Act, was in 2022, when SEBI released a consultation paper. And in the SEBI's consultation paper, while reviewing the buyback of securities regulations, which applies to listed companies, they proposed that the buyback burden of buyback tax under the Income Tax Act should move from the company into the hands of the shareholders. So what we are seeing now in 2024, and please move the slides, next slide please, is nothing but the shift from the individuals, from the company into individuals. Now, this was the reason. If you look at the recent trends of buyback, and now these are listed companies, this is publicly stated information, you see a steady increase, even in the COVID year, the quantum of buybacks was 36,000 crores for 55 companies. 21, it slowed down a little bit, not in terms of numbers of buyback, but quantums of buyback. Then it picked up again in the post-COVID recovery in 22, 23, and in 24 so far, we've also seen buyback. So if you look at these figures, what is the temptation? Temptation for any tax administration is, wow, this tax is now going out. There is buyback tax being paid because buyback tax applies to listed companies. Now let's look it in a wholesome manner, take into consideration what SEBI has to say, take into consideration the historical evolution of the law from an income tax point of view, and now we have the buyback tax. So next slide, please. Now, if you look at this slide essentially explains what the current scheme is, and that scheme applies until 30th of September 2024. How is a buyback tax, which I explained to you, the incidence at 20% plus surcharges, income is exempt in the hands of the shareholders, no deduction is allowed to the company, and buybacks before July 21 for listed companies were taxed as cost, the buyback minus the cost of acquisition on capital gains in the hands of the shareholders. And now the proposed amendments shift the burden from the company to the shareholders, which means buyback tax as it stands repealed. A deeming fiction has been created that buyback will be treated on par with dividends. So 222, after 222E, 222F has been added to include buyback as a deemed dividend, which is income under Section 2. It will be taxed as income from other sources in the hands of the shareholder. There is prohibition that the shareholder will not be able to claim any deduction. Now, in order for the shareholder to compute or in order for the shareholder to take into consideration the value at which the shares were acquired, these are the shares that have been bought back, that value will be deemed as a capital loss, which means that you're taxing the entire consideration. You're not giving a deduction for the value you paid for those shares which are getting cancelled as a result of the buyback, which would have happened had the income being taxed as a capital asset, but instead you're treating it as a capital loss. So this could be detrimental to some of the individual shareholders because they may not have capital gains. Of course, if they have capital gains, then they can set it off. The procedural part of the law is simple now. There is an obligation on the companies to withhold tax. So Section 194 now thrusts an obligation of withholding tax at the rate of 10% from residents, and then from non-residents, it will be 20% or the rate applicable under the treaties. So this is in a nutshell explaining what the buyback tax would mean. Now the next slide please. I've just drawn a very simple illustration. I'm not going to labor anything further on this, but this is just to be able to explain the last point I mentioned. How would the income be taxed in a buyback situation? This is a simple example where 100 shares are acquired at 40 rupees per share. So 4,000 is the cost. In 2025, assuming that the new provision triggers in, 20 of those 100 shares are bought back at a value of 60. So you bought 100 shares at 40, 20 shares are being sold at 60. The entire consideration of buyback, which is 20 shares at 60, is taxed as income from other sources. But what you paid for those 20 shares in 2020 at rupees 40, that 800 rupee is now your capital loss. In 2026, assuming you sold 50 shares out of the remaining 80 shares you had, and assuming you sold it at 70 per share, so you made capital gains on those shares. Those long-term capital gains are translated into 1,500 rupees. Now, this is the time you will be able to set off that. Of course, the set off of brought forward capital loss is not vis-a-vis only those shares. If you have any form of long-term capital gains from financial assets or non-financial assets, you can set off. In this example, we have taken that the SSC, that the individual SSC has no other capital gain in the future year after it has made income from the buyback. So what happens is that you're essentially deferring what would have been a cost of acquisition had the buyback being taxed as capital gain, and you're deferring it to the time you make the next long-term capital gain in the future. So that's really the larger message. Now, what does this mean? Next slide. By way of impact on various businesses. Now, this could be any form of impact on various businesses, but based on our experience, based on serving clients, we just plotted this chart. So barring the first bullet and the last bullet, which are negative consequences for taxpayers, you would see largely the 6 bullets in the middle are positive for the taxpayers. Now, I'll just take a few minutes to explain why what are the positives and negatives. As I had mentioned, the first bullet and the last bullet are negative for the taxpayers, and the 6 bullets in the middle are positive to the taxpayers. Now, clearly, and the first bullet is really from a foreign investor standpoint. Now, what happens is that when you compute income of a non-resident, there is income computation mechanism in India on the source-based taxation. And there is an income computation mechanism of the non-resident in his home country, assuming that's the country with which India has a double tax treaty. So India has now created a deeming fiction for this income arising out of buyback of shares to be characterized as dividend income, which is fine. But in substance, it is capital gain because there is an extinguishment of the shares which have been bought out. So in this situation, the non-resident, while offering that income for tax in his home country, assuming his home country taxes this income, would characterize it as capital gains. So this will create a dissonance on characterization. The same taxpayer in India as a source country, his income will be characterized as dividend income, and at the home country, it will be capital gains. Now, and when I say it is capital gains, I'm saying ordinarily it will be capital gains because it invested in a shares in India. Now those shares cease to exist as a result of buyback. So it is capital gain ordinarily. This dissonance of characterization could create challenges for claiming foreign tax credits because this withholding tax that the Indian company has implemented. It is obviously going to claim foreign tax credit in its home jurisdiction. So there are many treaties. That India has with countries where the domestic laws of those treaty partners put restrictions on foreign tax credits vis-a-vis the income. A classic example is France treaty. There are other examples of Dutch treaty. There are examples of Swiss treaty. Now, many of these treaty partners in their domestic law have very strict foreign tax credit rules, which says that you can claim foreign tax credit provided it is aligned with the interpretation under the treaty. So if the treaty classifies such buyback as income arising from transfer of a capital asset, that's where the friction occurs. That's just one example. We saw examples of that coming up in the context of how countries such as Switzerland, Netherlands, France have interpreted the most favored nation treatment clause, which, as you know, the taxpayers in India lost the battle in the Supreme Court. So that's just to be able to explain. The second one is the benefits under the new scheme, which I explained in the example earlier, would be high to a large investor who have capital gains as a recurring income. So, for example, if you look at the treasury income of large corporates, or if you look at how foreign portfolio investors are taxed, they constantly have income taxed under the head capital gains, but they also have losses under capital gains as well. So for them to be able to set off this deemed capital loss on buyback of shares is far more easier, far more flexible than, say, to an individual taxpayer whose example that I gave. The new regime is clearly beneficial for secondary acquisitions. I will just take a minute to explain. Rule 40 BB helps compute the cost of acquisitions in situations of buyback. I'm told that since the entire proceeds now are taxed as dividends, the erstwhile Rule 40 BB provided for deduction from the cost of acquisition of the original value. The original value was viewed as cost of acquisition for the purposes of computing the buyback tax. Now, it is the indexed cost of acquisition that would be considered. So that's the change. So Rule 40 BB gets amended to that extent to be able to take into consideration new buyback provision. The fourth is that the buyback now covers buybacks under Section 68 of the Companies Act, and which means that if there is redemption of preference shares, that redemption of preference shares will continue to be taxed as capital gains because of specific provisions under Section 55 of the Companies Act. So buybacks now would cover only buybacks under Section 68 of the Companies Act. There is clearly higher incidence of tax on all forms of taxpayers depending on which slab rates they come in. So let's assume that the person whose shares are being bought back is an individual, and that individual has income, say, above 5 crore rupees, then the buyback of shares will be taxed at the highest slab rate because the highest surcharge will apply to those individuals because his overall income is above 5 crores of rupees. We believe that this is also positive when it comes to cash flows for corporates because the tax is now no longer being borne by the company. It is borne by the shareholders, and the corporates, while implementing the buyback scheme, is withholding taxes. So from a cash flow standpoint, the corporate doesn't have to execute the buyback and then pay the buyback tax of 20%. over and above on that. Clearly, the last point is more got to do with obligations that will be thrust upon the company that is doing the buyback, because the company will have all forms of shareholders, residents, non-residents, trust companies, individuals with non-residents, and non-residents will have treaties, and hence it will have a withholding obligation. But I would feel that in a very scattered shareholder group, for the non-resident, the company would simply follow the process of withholding tax at the rate of 20%, and then leave it to the individual shareholders to be able to claim the treaty benefits. So that essentially is on buyback. I'm now going to move to the second segment, which is the abolition of angel tax. This is again a very reformative move. We are going to look at the implications as well. Next slide, please. The abolition of angel tax also has a history, and I just wanted to talk very briefly about that history as well. Have you moved the slides, please? Can you move the slide, please? Yes, next slide. Yeah. The abolition of, angel tax is also, kind of important. But before that, let's look into the history of the angel tax. The angel tax was first introduced in Finance Act 2012 by way of insertion of 5627B. 5627B was initially applicable to issuance of shares by Indian companies, and it was introduced for issuance to non-residents. At that point in time, the stated objective was that this is like an anti-avoidance provision, primarily to deal with situations of money laundering, and circulation of black money. This was the time when the 2G scam was at the peak of its debate, and there was a widespread, perception that many of the investments that came into Indian companies from outside India came at a super premium, and that shares of the company should be valued. This triggered off also introduction of the famous Rule 11UA. Rule 11UA essentially is the fair market value for valuation of shares. And the law simply provided that if there is a difference between the price at which investment is made with the fair market value, then the difference between the two would be deemed as income from other sources and taxable under 56(2), which is the charging provision. Obviously, there were many changes that occurred after 5627B. We had the government coming out with its famous, startup plan, and in the startup space, it was, the Department of Industrial Policy and Promotion that started giving accreditation to startups, but many startups did not find the recognition of DPIIT, as a result of which in 2019, there were many startup ventures which got themselves caught into the 5627B. This was choking up investments in the startup space, because in the startup space, essentially it's an idea, and it's that idea which mushrooms into entrepreneurial organization, so on and so forth. So obviously the shares are priced much higher, and no valuation methodology was really able to support it. The CBDT notification in 2019, carving out an exception for startups approved by the Department of Industrial Policy and Promotion, obviously did not cover the other startups. So since 2019, many of the startups that did not get that recognition found themselves, many assessments had taken place. In fact, we had cases where valuation reports were not accepted by the department. Department was thrusting an alternate valuation, so on and so forth. So despite a long list of carve-outs that the angel tax the rigors of 56 to 7B shall not apply to certain forms of businesses, whether they are by sovereign funds or by startups approved. There was still a whole lot of noise that was made by the industry, and that led the government to review that decision. But before it reviewed the decision in 2024, in 2023, the section was amended to cover all investments done by residents and non-residents. So they essentially, by deleting the word other than residents, they covered all forms of taxpayer, which created another fresh set of uproar by the entrepreneurs, because there were a lot of investments that many startups were mobilizing out of resident investors. So the originally stated objective of Finance Act 2012, that this is to address concerns relating to money laundering and round tripping and circulation of black money, no longer held true in 2023 when we extended that law to residents as well. Now, this was introduced in 2023 budget as a rationalization measure, and hence many assumptions under the erstwhile Rule 11UA, which had the fair market value, were not fitting into the scheme of investments made by residents. And hence, after 2023 Finance Act, they prescribed 5 additional methodologies. So the fair market value methodology under Rule 11UA was now added 5 other methodologies, like a comparable company multiple method, probability weighted expected return method, option pricing method. I can tell you, despite practicing as a chartered accountant for all these years, I have also not heard many of these methods. So you really need to be a valuation guru to be able to do valuation under these 5 methodologies. But the larger message was that it was choking the entrepreneurial spirit for new businesses to raise money, and rightly so. Finance Act 2024 repealed it. Now, as a result of this repeal, the impact is largely positive, but I wish they had addressed, more of these issues. So if you can go to the next slide, we will talk about the impact and consensus of, where we stand. So clearly, there are many positives. The first 3 are really positives that we are talking about, because now there is no longer valuation required. Companies are free to issue shares at a premium. So there is complete discretion that has been given. If there is an investment that is made by the non-resident for which it will require valuation under the Foreign Exchange Management Act, it need not worry about aligning the valuation under erstwhile Rule 11UA and the FEMA valuations. So the FEMA valuation will stand the test in case the investment is made by the non-resident. It's also convenient now to obtain capital for not just startups, for even companies that are not startups. We believe that the department's scrutiny under Section 68, particularly the explanation that got added to Section 68 by Finance Act 2022, will continue, will be over and above. So you may have taken out the angel tax provision, but scrutiny will continue under Section 68. So if you recall, Finance Act 2022 provided that Section 68, which creates a deeming fiction to add to the income, unexplained credits that are coming in. It added an explanation which says that this is not just about verifying the person who is the giving loan, but also the person who's taking the loan, And there was a deeming fiction that got created in Section 68, which says that if in the opinion of the assessing officer, he's not satisfied with the explanation given by either of the parties, then this could be added as an unexplained investment. So that provision continues. I would have thought that if there was some rationalization in Section 68, particularly the explanation that got added in 2022, it would have meant more positive for bringing in more money into the entrepreneurial ecosystem or into the funding ecosystem. Clearly, the GAR provisions will apply. Tax authorities will have right to look into a transaction, recharacterize a transaction. So you can assume, you can say that 56.210 was a SAR, specific anti-avoidance provision, but there was a SAR and a GAR. Now the GAR is there, but the SAR has gone away. We also felt that there is another section which kind of invites an angel tax kind of an implication. It is 56.27B. Pardon my slide, it is not 50CA, it's 56.27B. We'll correct the slides over there, which could have been addressed along with the angel tax issue. So that seems to have got missed out. And on an overall basis, clearly, this is a big boost to the entrepreneurial ecosystem. So overall, very, very positive change. Next slide, please. Let's come to another important change on amendment to Section 37. Just to give you a background, explanation 1 and 3 of Section 37 disallows expenditure for any purpose which is an offense or it is prohibited by law in or outside India. I'm not going to go into the history of Section 37(1), but this section also settled down after many, many amendments. And there was one issue which was very litigative, which was that if there is a settlement of any proceedings, let's say, for instance, any of the regulatory authorities, pollution or capital markets regulator or anyone with whom we have you have a settlement wherein there is no wrongdoing, you admit, and there is nothing that is proven by the regulator, and you are in that settlement, you make a payment. This was viewed as expenses incurred solely and exclusively for business purposes. It was clearly an expense that was not incurred for any offense or anything that is prohibited by law because you settled it. In those situations, this was claimed as a deduction. The two landmark decisions that stood out, confirming that these amounts are allowable under Section 37(1), despite the explanation 1 and explanation 3, which prohibited the expense being taken for anything which is in the nature of an offense or prohibition by law. One was the Prakash Cotton Mills case, where the Supreme Court took a view that expenses are allowed purely because it's compensatory in nature and not in penal in nature. So, it brought out a very fine distinction between expenses that could be penal in nature versus expenses that could be compensatory in nature. This was a very, very, broad ratio that the Supreme Court had laid down, and consequently, many of the tribunals and high courts then also, followed this decision. Thereafter, the Delhi High Court came out with another landmark decision where they came out with a fine distinction that where a payment is not in the nature of penalty for an offense, but it's it's a settlement of a lengthy trial. I mean, normally businesses get into settlement. Just to give you a common example, based on my experience as a board member in large listed companies, after the GST law came, many of the state governments came out with a scheme to settle the erstwhile state VAT disputes. Even before VAT law came in 2003, many states had sales taxes. So they came out with a scheme to settle sales tax dispute, and many, many large corporates went and settled these old disputes. So in relation to that, many judgments came following the ratio laid down by the Delhi High Court in the Desiccant Rotos case, where it says that if you settle a lengthy trial, then that is allowed as a deduction. Now, the not so good news is that these decisions stand overridden with the new law. Now, let's look at what the new law is. If you can flip the slide, please. The new law simply says that any expenditure incurred to settle proceedings initiated in relation to contravention under such law as may be notified. So we need to see what the notification is, because there is obviously going to be a CBDT issuing notification as a part of the official gazette. But before it issues notification, the concern is, what do you mean by saying settling proceedings? So the Delhi example that I just gave, that was in order to settle proceeding, not for a violation of law, but to avoid long-drawn litigation. So there is a long-drawn litigation that is taking place. And as a result of that, you settle proceedings. At least based on the first part of the explanation, it doesn't seem that that would get covered unless there is something notified by the central government. Now, we don't know what that notification would be. Would the notification cover statutes, or would the notification cover nuances within those statutes? Because to me, it seems the manner in which it has been worded, it seems that they would specifically cover a statute. So, for example, they may say that such law will include SEBI law of 1993, which means that any settlement that you have with SEBI under SEBI law would not get covered. Or there are many offenses under SEBI. They may say that offenses committed by listed company in relation to IPO, or which means that that would be notified. So if there are any violations that SEBI notices and you settle that with SEBI, then that would get covered. But similarly, if SEBI initiates proceedings for not reporting related party transactions, that may not get covered. So I think we need to wait and see how this thing pans out. At the bottom of this slide, I have mentioned that on one hand, the government has taken a lot of positive steps to decriminalize many of the provisions under statutory laws, SEBI, FEMA, and Companies Act being some of the examples. Now, decriminalization means that the government is saying that don't worry about about criminal proceedings, you can settle these proceedings. But the fact remains that many of these are in the nature of economic offenses. Many of these are veering on the side of proceedings for breach of law or violation of law. I think if you settle those proceedings, until and unless it is notified, it would get covered. It would not get covered under the exception. My last two issues that I wanted to cover was, next slide, please. One is on a gift by companies. This has been a topic of debate in many transactions. Just to give you explain the context to this provision. Under the extant law today, if you transfer a capital asset under a gift or a will or an irrevocable trust, it does not attract tax. Now, the debatable issue was that can a corporate gift, will, or create an irrevocable trust, or can it be done by human beings? But leave that debate on the side. Under the common law, there was an exception that was provided that shares or debentures or warrants allotted under ESOP scheme by companies to its employees was carved out as an exception. And as a result of that, many taxpayers argue that if there is a transaction for gift of shares by a company, it will not be liable for capital gains tax. In other words, it will get covered under the extant law. This clearly came of a challenge by the tax authorities, because the tax authorities took a simple argument that if there is a gift, it has to be out of natural love and affection. That element was missing. in a corporate gift, because the natural love and affection can be expressed only by human beings and not by companies. But whatever may be the debate, there was a lot of pronouncements that were made. These pronouncements, some of them were in favor of the taxpayer, some of them were against the taxpayer. So I've listed down all those cases, but the pronouncements that were made in the favor of the taxpayers, the views of the High Court, which is Bombay and Gujarat High Court, had been that when you transfer a share without consideration, it constituted a valid and genuine gift, and hence it fell in the exception. And the ones that were in favor of the revenue, it said that it cannot be automatically exempt, and you need to look into the intention of the taxpayer at the time of the transaction. And this has to be examined by the tax department to see whether all the conditions for a valid gift or a will or creation of a irrevocable trust was satisfied or not. There is also a decision of the advanced ruling authority which clearly says that you cannot have an intercorporate gift, and that's not eligible for an exemption. So this is the current framework of law. Now, what does this amendment mean? And what are the questions that are arising? If you can flip to the next slide. The amendment is very simple. Clause 3 of Section 47 has been substituted, and it says any transfer of a capital asset by an individual or an HUF under a gift or a will or an irrevocable trust. Now, Section 47 is an exception, which means that it is clearly identifying that it's only if it is by an individual or an HUF, it would be viewed as a gift or a will or an irrevocable trust. So this is 47.3 is a host of clauses that carve out the exception to basically, this is the definition of the term what will not constitute as a transfer, which means that anything which does not fall in this exception will be viewed as a transfer and hence liable. Now, this, in our view, puts an end to the entire controversy because the amendment speaks for itself. The amendment essentially takes away the argument that taxpayers were giving that in a corporate environment, you could have a natural love and affection. It overrides all the judgments of the Bombay High Court and the Gujarat High Court. Now, this would impact a whole lot of family settlements because in a classic family settlement, it was very common that as a part of the settlement, as a part of the succession planning, as a part of planning that could occur before the estates are getting transferred, that it was very common for families to be able to transfer many forms of assets, and those transfers which were not viewed as a transfer would get impacted. Now, the question is that, can you still take an argument that there is an individual that is transferring it, there is an HUF that is transferring it, and hence exception applies. But in a family structure, you may not have an individual or an HUF. You can very well have a property that is already in a trust. And if many of those trusts are getting reorganized, or the impact of the beneficiaries are getting impacted, or the beneficiaries are, changing over a period of time because of death or succession, then how does it impact these? So I think there is a whole lot of changes that will be impacted. It could also impact past transactions as well, because, family succession planning and others are put in place historically, and they move over a period of time. It is also possible that interest of some of the family members who have been beneficiaries of the past family settlements could get impacted in the future as well. because this is effective from assessment year 24-25. Next slide, please. Now, we just wanted to discuss the withdrawal of the equalization levy. The withdrawal of equalization levy is simple, reformative on the face of it, but I just wanted to give you a background on the equalization levy. Equalization levy was introduced in the law in 2016. In 2020, it was expanded to cover transactions other than B2B transactions, and that's the time 2% levy was introduced. The impact is significant because India and US, as a part of 301 settlement, and this is a 301 settlement, and the US trade representative agreed to not expand the levy, not increase the tax, remain neutral up until the time India signs the multilateral convention. There is a host of changes that are likely to be expected. So you should expect more development in the area of digital taxation, with India being a part of the Pillar 2. We saw the finance minister's statement, revenue secretary's statement, expressing unstinted support to OECD two-pillar solution, but it also equally qualified that support by saying India has put out the objections for Amount A and Amount B under Pillar 1 as part of the process. So this is a development that you should closely watch. Right now, the 2% equalization levy has gone away, but I think there is more to come. Next slide, please. I'm not going to discuss the next slide on changes of tax rates because they are fairly self-explanatory, and the implications are also given. What does this mean by way of tax rates? And there's some procedural changes that are impacting gift city operations. Hence, I would stop over here in the interest of time because that's the only last slide I have. With that, Ridhima, over to you.
Thank you. Thank you so much, Mukesh. I think this was extremely useful, and hearing it from you made it even more valuable. Thank you for covering the background and all the loopholes and details. Just since we already are short of time, just 2 minutes more. One query which has been coming up very regularly on this buyback thing is now that what if these shares which I am holding as stock in trade are bought back? What would be the impact?
If you're holding the shares as stock in trade, it's no longer going to be taxed as a capital asset. So I would say that the business income provisions will apply. So these changes will not impact those forms of transactions. So there is a CBDT circular which lays down broadly all the guidelines that in case you're holding a security, under what situation it would be classified as business income, under what situation it would be classified as capital gains. So what changes we discussed today apply only to income characterized as capital gains. If the income is characterized as business income, these changes have no impact. You need to bear in mind that that circular does not apply to foreign portfolio investors, because for foreign portfolio investors, there is a special provision that governs taxability, and there is a deeming fiction that has been created in the law which says foreign portfolio investors on sale of securities will always be deemed to have characterized as income as capital gains.
Right. Great. And one last thing on the dividend part, when we're taxing now that income as dividend, what would be the point of taxation? Will it be the announcing date, recording date, payment date received? What would be that?
I would imagine that all buybacks implemented on or after September 1 would get impacted. So, there is a provision laid down under the Companies Act on buyback, and as soon as the buyback, it will be deemed as a dividend on the date when the payment is made. So, because the law also is very clear, it says after subclause E and before the long line, the following subclause, any payment by a company, which means it will be the date of the payment that will be
Right.
as the date of declaration of dividend.
Right.
So
Perfect.
you need to read this word payment along with 222F, which creates the dimming fiction for such buybacks being characterized as dividends.
Correct. Thank you. Thank you so much, Mukesh. It was a pleasure having you.
Thank you very much, Ridhima, and good luck with the rest of the conference.
Thanks a lot.
Okay, bye.
So let's proceed to our fourth session, focusing on the key topic of this budget, capital gains. So the capital gain topic is divided into two parts. First, we'll explore changes in financial securities, followed by the next session, which will be exploring the changes on non-financial assets. So to begin with changes proposed for capital gains on financial securities, we're excited to welcome Brenden Saldanha, partner at EY LLP Financial Service Tax Practice in Mumbai. With over 20 years in financial services and banking industry, Brenden specializes in tax and regulatory advisory, fund structuring, and compliance. He has worked with global investment banks, asset managers, and Indian private banks, and has an experience at the India Tax Desk in New York. He holds a bachelor degree in commerce from the University of Mumbai and is a chartered accountant. The stage is all yours, Brenden, and I'm so sorry for the running delay.
Not a problem, Ridhima. Can you hear me?
Yeah, definitely.
Right. Thanks, Ridhima. And not only I have the misfortune of following such a great session by Mr. Butani, but I also have the post-lunch session or during lunch session. So I hope that people will be enthused to listen to me on these changes that have come in the budget. But good afternoon to everyone. And thank you, Taxman, for this opportunity to present on this budget, especially on some of these great changes that have come by the finance minister, trying to simplify matters and in some manners complicating them, if one may look at. So I'll quickly, and I know we are running short of time, so I'll quickly go through some of these changes in the context of capital gains on financial assets. This is the first time that the finance minister has introduced this concept of deeming some assets to be financial and non-financial. And what I'll be covering is financial, which covers shares, stocks, bonds, NCDs, all those types of investments, wherein the intention of the government is to streamline the taxation and the period of holding across all of these assets. And I'll first start with really because there's a lot of cross linkages between different types of assets. And last year, if you recall, for the first time, the finance minister had introduced the concept of a specified mutual fund by which any specified transfer of any asset of a specified mutual fund, the gains would be deemed to be arising from a short-term capital asset. And the manner in which this was done, which was effective April 1, 2023, was to state that an SMF would be a mutual fund where not more than 35% of its total investments were invested in the equity shares of domestic companies. Now, this gave rise to a lot of confusion, as one can imagine, over the last couple of years, wherein even assets like gold bonds, ETFs, some of these which were not intentionally debt assets were falling within the purview of this specified mutual fund because it's said by whatever name called. And so there was a lot of confusion on whether this would apply to even investments in international funds, for that matter. You know, under the LRS, you can invest in international funds because those were not 35% in domestic companies, whether those also were subject to a short-term capital gains tax. Obviously, a lot of feedback has gone to the government, including the fact of fund of funds investments. And so this time they've sought to clarify that and amended that budget, that provision, wherein now it's pretty clear to state that any mutual fund, by whatever name called, investing more than 65% of its investments in debt securities or money market instruments. And these will be as defined by SEBI, or a fund of fund which is investing in such mutual fund schemes or such securities. Now, let's look at why these provisions were introduced. Obviously, you had interest income, which is taxed at the slab rates or the highest rate, whereas investments in mutual funds, which were investing in these very securities, you got the benefit of indexation or a lower or long-term capital gains tax rate, which effectively reduced your outgoings on tax, which was essentially interest, but obviously coming to you by virtue of growth schemes that were issued by mutual fund schemes. So the intention is very clear that if there is investments in equity or equity-like instruments, then those will be taxed in one manner. But if there's intention is to invest in debt securities, then even going through the mutual fund route is not going to allow you to get that benefit. So to that extent, now you've got a very clear message which says that any investments more than 65% in debt instruments or money market instruments, these will be taxed at as a short-term capital gain. The only interesting thing, and I know whether interesting or more cute thing that has been done by the finance minister this time, is that this is effective 1 April 2025. Therefore, the ambiguity that has risen by virtue of this provision last year continues from last year into this year and will continue up till March 31 of this year. So that's something that one will have to see, and what's the impact of that one will have to look at in terms of how they are being treated for these current years in terms of the investments made. Along with this, the other asset that has been deemed for the first time, this time as a short-term capital asset, is unlisted debentures and bonds. But this has been made effective from 23rd July 2024. So any redemption, maturity, transfer of any security after 23rd July 2024 in unlisted debentures and bonds, these as well would be now be regarded as short-term capital assets. So now once we've seen those definitions, I thought it may be simpler then to look at where we stand today in terms of the rates of tax, the period of holding for the various securities that we have right now. So listed securities, equity-oriented mutual funds, zero-coupon bonds, nothing changes. 12 months remains 12 months. That is not sought to be tampered with. The intention of removing the 36 months period comes to light with the listed units of business trust, which are the biggest beneficiary really of this, wherein now listed units of a business trust, the period of holding more than 12 months will be regarded as long-term capital gains. The unique one now, this hybrid mutual funds, which are more than 35% equity, but less than 65%. Obviously, if it's more than 65%, then it becomes an equity-oriented mutual fund. But these ones which straddle in between, they will now enjoy a 24-month period of holding if it is to qualify as a long-term capital gain. Unlisted market-linked debentures, debt mutual funds, money market mutual funds, all were deemed to be short-term capital assets last year, and they continue to be deemed to be short-term capital assets now. The unlisted bond that I spoke of just now, those are now deemed to be short-term capital assets, whereas unlisted shares now continue to be 24-month as a period of holding. By virtue of this, what you see is that you only now the 36-month period of holding is completely done away with, and you only have a 24-month period as a long-term capital asset if that were to be entitled to be treatment to a long-term capital asset. Now, the one thing that we thought was a little bit unique is what happens to assets like gold ETFs, international funds, because it's very clear that these are effectively long-term capital assets post 1 April 2025. So now you've got this unique situation where for gains up to or investments up to April 1, 2023, these will be long-term if they are held for more than 36 months. For the period April 1, 2023 up till 31st March 2025, effectively by virtue of this anomaly in the provision, these are likely to be regarded as short-term capital assets if they were transferred in these 2 years. But with effect from 1 April 2025, these now become long-term capital assets if they are held for more than 24 months. So again, this becomes a little bit of an anomaly in terms of how these are to be treated. In obviously the intention by the finance minister to make these simplified. Obviously, there are some loopholes that are let out, but that's something that will need to be seen. Moving on here, I mean, I've been a practicing chartered accountant for over 20 years, but if someone has to ask me what is the capital gains tax rate, it sometimes leaves me dumbfounded, because obviously the tax rates are varied, and for different periods of holding of time, it's very difficult to explain that. And obviously that's coming out in this slide, and obviously you can see this at a later point of time if this is too small, and I apologize for that. But I thought it would be necessary to see what are the real changes and if anything is left out. The first part, if you look at it, and this is bifurcated into three parts, really broad aspects of investors that we see. One is the FPIs, which are investing under the foreign portfolio investment route. You have foreign investors investing under the foreign direct investment route. And obviously, you've got the resident individuals at the end. What is clearly changed is obviously an increase in the tax rate for both long-term and short-term capital assets on the equities and equity-oriented mutual funds. Long-term capital gains have increased from 10 to 12.5%, and short-term from 15 to 20%. The indexation benefit obviously wasn't applicable to this for most of these investors. So that's a big impact for those investing in these kind of securities. If you recall, the STT was introduced way back in 2004 under the guise that on the basis of payment of securities transaction tax, long-term capital gains was deemed to be exempt. That obviously changed back in 2018. And now where that rate was 10%, this increase to 12.5% will impact investors further. Again, equity capital gains on equities used to be 30% or slab rates. That would come down to 10%, 15%, and now it's increased to 20%. So that's a big change for those investing in capital markets, but that's something that the government believes that they've taken in their stride. What has also changed is the exemption for long-term capital gains on these investments on equities. Earlier, there was a deduction or an exemption for 100,000. That's been increased to 125,000. That's a marginal relief that's been given to small investors. Moving on, if you look at unlisted equity shares, there's no change. Obviously, from an FPI perspective, it's still 10 and 30. What has changed is from an FDI perspective. Earlier, there was 112C3, which taxed rather capital gains earned by a foreign investor in unlisted securities to be taxed at 10% without giving FX benefit. There was always a confusion in terms of how this would be computed, because one would normally, before reaching 112, you do a computation with regard to the FX benefit under the indexation benefit really under 48. And then if that gave you a gain or a loss, if it gave you a loss, you would take that loss. But if it gave you a gain, once you come to 112C3, you need to take out that benefit and really tax it at 10% without an FX benefit. But now this is very clear now that indexation has been taken away. The FX benefit will be available to investments in unlisted securities. So that's one thing that's very clear in this budget, that increased rate of 12.5% will apply, but the FX benefit that will be available to foreign investors that comes in. So that's brought about some cheer. I mean, depending on how you look at it in terms of how the FX moves. But given how FX has moved in the past, this should bring about a significant cheer to foreign investors in unlisted securities. The benefit is really in terms on the resident side, where that rate has gone down from 20% to 12.5%. Obviously, many people took the benefit of indexation and applied a 10% rate earlier, but now with that gone away, all capital gains taxed at a nominal at the straight rate of 12.5%. Again, on business trusts, those rates increase from 10 to 12.5% to all for long-term capital gains, and from 15 to 20% for short-term capital gains. The benefit here, as I pointed out earlier, is that now the period of holding is only 12 months. Unlisted business trusts, these now enjoy a lower threshold period of 24 months for qualifying as long-term capital gains. I'll come to the FPI part later on, but on FDI, these rates have increased to 12.5% for long-term and 30 to 35%. The 35% being the reduction in the foreign tax rate for foreign companies. Again, moving on to NCDs, again, these increase from 10 to 12.5%, 12.5% for residents without indexation. NCDs, again, now these are deemed to be short-term capital assets. So these will apply at the prevailing rates, at the slab rates, and that will be applicable from 23rd July. Transactions on listed derivatives, no change. These continue to be applicable at the slab rates. As I pointed out earlier, indexation has gone away. So that was a little impact to foreign investors other than really in terms of long-term investors in private equity. But that's gone away from 23rd July 2024. And so that's going to have a significant impact. But obviously, the government believes that the simplified computation of this capital gains will provide some relief to investors. The point that I wanted to bring about in terms of one anomaly is that if the intention of the government was to have simplified rates of 12.5% for long-term capital gains for everyone, there seems to be an oversight in terms of FPIs because 115 AD, I beg your pardon, 2C, which talks about the capital gains taxation for on long-term capital gains for FPIs, taxes is at 10%, and it is only the proviso which takes you to 112A that the rate has been changed from 10% to 12.5% with effect from 23rd July. So to that extent, what it applies to is only to equity shares. That's the interpretation that you would get from reading the Threadbare Act. But I'm sure that this probably is an oversight, because if the intention is to have the rate of 12.5% applicable to all investors, then affording that only to FPIs under 115 AD clearly may not seem to be the intention, and probably as the bill is tabled and it finds its way through Parliament, you would find that rate changing to 12.5%. Another question that comes about is with regard to the offset of losses, because you have capital gains which will be taxed at different rates within the year. This isn't the first time, or it's not the first time that this is a case. This has been debated in the courts as well, with first investors and various other judicial precedents, wherein the courts have held that if you have gains taxable at different rates, you've got currently as well gains which are subject to STT taxable at a lower rate as compared to short-term capital gains taxable at a higher rate. The courts are very clear on this provision, which state that all the gains taken together can be offset against gains taxable at different rates, because there is no bifurcation in the provisions of Section 70. And therefore, to that extent, in this case, where there are different tax rates that are applicable to gains that are earned from 1 April to 23rd July, and a different rate from 23rd July to 31st March, you obviously have the ability to claim the offset. So obviously, one would then take the position that you would aggregate all your losses within the year, irrespective of what rate they are taxed at, and then offset that against the gains arising post 23rd July first, because that's taxable at the higher rate, and then moving on to the gains that are taxable from April 1 to July 23rd. So that's pretty much how you would treat those losses. Moving on, there is an increase in the STT rate for securities in options and in futures. This is hardly a surprise. The surprise being, well, if one has to look at a surprise, it's that the rate has increased by marginal amounts. Given what the SEBI and the government have been proclaiming over the last several months in terms of the froth in the market, the volumes that have been traded on futures and options, India seems to have one of the highest ratios. From what I've heard, more than 50 to 60% of the volumes of F&O traded in the world in the retail market are traded in India. So it's kind of become like more of a gambling addiction that at least the SEBI has pointed out. And therefore, while there was an expectation that derivatives and trading in futures and options would be taxed at a much higher rate, akin to what was seen last year in the context of VDAs or crypto, that doesn't seem to have come through. Instead, what we have is a nominal increase in the taxation on STT. I would think that this is hardly going to deter anyone from trading in F&O if they were doing before. Anyhow, they don't see these numbers coming through in the actual trade books, so unlikely that this is going to change. But anyhow, it's something that the government has taken a step for. The last thing that I wanted to cover is in terms of the shares offered in IPO. There was, obviously, as I mentioned earlier, there was the change in the taxation of long-term capital gains back in 2018 when capital gains, the long-term capital exemption was removed with effect from and grandfathered for gains that were made up to 31st Jan 2018. What was unclear at that point in terms of if shares that were tendered in an IPO, how would one value the gains that were to be grandfathered up to 31st January 2018? And in many cases, the position was taken that the fair market value as on 31st January 2018 was to be considered as the basis. But this budget has amended that to say that what will be allowed is only the cost inflation index up to 17-18. And that's a big hit to many people who would have taken a position or any persons offering the shares in the last 4-5 years, because this is a retrospective effect from 18-19. And therefore, now you would not get that step up in terms of the fair market value. This is going to result in significant reassessment proceedings, provided those limits with the reduced limit in reassessment proceedings that are available. Then this would definitely become one topic. Revision proceedings also are possible, and therefore this is something that needs to be looked upon by anyone who's taken that aggressive position in the last couple of years. The other thing is that this amendment is only with respect to equity shares, and it doesn't apply to business trusts. So any REIT offerings that have been taken place in the last couple of years, whether this will have a ripple effect in terms of making the intention of the government clear and therefore forcing people to probably take this view, that's something that remains to be seen. But by and large, I would think that if this is the intention of the government, that's something that the tax authorities would also look to address. So that was really in terms of financial assets. I know it's not much in terms of what is there, and I hope I've covered most of the topics, but Ridhima, if there are any questions, then I'm happy to take them.
Yeah. Thank you so much, Raghav. I think this is actually a topic which requires a lot of in-depth analysis, and thank you for your analysis on this. We have few questions coming in just a moment.
Sure.
So one is actually my personal question, which we have seen a lot of debatable topic in the news also. Do you think I saw RBI governor's interview, I saw the economic survey, and there was a clear intent that government is sort of in a state of shock or surprise that people are investing a lot in FNOs, in capital markets, and the traditional saving has totally shed its way out. So do you think this kind of move will discourage retail investments in the market?
No, I don't. Frankly, I don't see that coming through. And essentially, if you look at it, the addiction, if I may call it, to invest, it will very rarely take place. It will be deterred by small changes in STT. I think there have to be larger macroeconomic changes done to really deter retail investors. See, at the end of the day, one should understand that tax is a function of gain. So people who are earning gain significantly won't mind sharing tax, whatever it is. I think what is necessary to be changed is more from a regulatory perspective. If you have, lot sizes, the amount of money that you have to put to trade in FNO right now is very limited. You've got mini lots, you've got, expiries happening on a daily basis. That is something that will, if that is changed and, you have larger lots and the money at risk is larger, that's when you'll probably find people, being a little bit deterred from investing. But changing of STT rate by 0.0035% or 0.065%, people are not going to be bothered by that. Yes, if you have, a significant tax rate of, 40% or 50%, that may deter people, but, it is not going to be conducive to have different rates. You'll not have, it's necessary to have derivative investments in the industry, but you can't deter it to a great extent from a taxation perspective. So I think regulatory changes are more warranted rather than tax changes.
Noted. And we see, so this is something which is another query coming in was about this 1,25,000 exemption limit, which has now been increased under Section 112A. People are wondering how this would be adjusted. Will it be on FIFO method or the way it beneficial to the assessee the most?
It will be on the benefit. Basically, at the end of the day, it's 125,000 reduced from your total capital gains exempt. So that is going to come after you are offsetting your losses. As I mentioned earlier, you have the benefit of offsetting your losses in any manner possible. So you will obviously offset it against the gains that are taxable at a higher rate. Then the 125,000 will be reduced against the gross amount. So that should not matter in terms of which is the more beneficial.
Okay, and last question before we sign off for you. So, will a balanced hybrid fund still meet the criteria of the new definition of a specified mutual fund and be taxed under Section 50AA?
So balanced funds what is put as a threshold is more than 65% investment in debt. For most of the balanced funds that I see, if they are crossing their threshold, you have hybrid funds and you've got balanced funds. Many of the balanced funds which are there, if they're investing more than 65% in debt, you have 80% debt and 20% equity, then yes, they would fall within that threshold. But some of the balanced funds, if their strategy is to then present it as 50% debt and 50% equity, then those would not be within the threshold. So I would believe that going forward, a lot of the mutual fund schemes that come out would want to target those type of thresholds, which will still qualify for the long-term capital gains and not invest more than 65% in debt securities. But again, that depends on what the product that the mutual fund scheme is coming in. But the threshold is very clear. If that balanced fund scheme has more than 65% in debt, then that would qualify as a specified mutual fund and attract the short-term capital gains asset.
Interesting. Thank you. Thank you so much, Brenden. I think this session was extremely valuable and you shed the much needed light on this important topic. Thanks a lot.
Thank you much. Thank you, everyone.
Thank you so much. So now moving on to our next session. So our changes on the capital gain is continuing with the focus now on non-financial assets. So we are pleased to welcome Raghav Kumar Bajaj, Counsel at Khaitan & Co. Raghav specializes in income tax, corporate taxation, cross-border tax, digital taxation, and transfer pricing. With extensive experience across various sectors, he also provides advice on business restructuring and tax dispute resolution. A chartered accountant with strong academic record, Raghav has been featured in BW Legal World's 40 Under 40 and the World Transferring Prize rankings. He's a regular speaker at professional events and actively involved in Rotary International. Hi, Raghav. How are you?
Good, Ridhima. How are you? Thank you for inviting me.
Very well, very well. Thank you for being part of this marathon.
No problem. I think it's always good to be part of Taxman's initiatives. Anything, whenever budget comes, I think first forum to do all these things, Taxman. So great to be back.
Thank you so much. So now the stage is yours to take up.
Sure. I'll just share my screen.
Yes.
Let me know if you're able to view it.
Yeah, it is visible, but you can put it in the screen sharing mode, please. Or is it the PDF? I think it would work. Just maximize the screen.
Let me put it in the PPT mode then. Is it better?
Yeah, good to go.
Okay, great. Thank you once again. So as we've already, heard about the capital gains changes with respect to the financial assets, the next most important topic, I think, of the budget is how do the non-financial assets fare? It would be, I think, fair to say that at least the capital gains portion has been the much talked about amendment proposals of this budget. And why not? Because at one place, I mean, before budget also, there were so many discussions, debates, deliberations as to what will happen with the long-term capital gains tax regime, be it financial assets, be it non-financial assets. And to be honest, this distinction between financial and non-financial assets is something which people were not very used to, at least before the budget. Then the important point everyone is talking about, that indexation benefit and what is going to be the impact, at least what Brenden has dealt with is with respect to the listed equity shares, the financial assets. But now I think it's time for us to understand how does it impact A, the other classes of assets, and B, what is going to be the impact in future? Because see, honestly, 23rd July is a day which has gone by. So now this is the proposal which is there. It is now up to the government to enact it with or without amendments. Now let us see what is there in it for us in current form and shape, and how is it going to affect the different stakeholders and different pockets. So today we are going to, I've divided this session into, let's say, 5 parts. Of course, we are going to deal with the tax rates, the holding period, etc., related amendment proposals. One interesting food for thought as to with respect to the date of transfer, because that is something which will be important, as this is an amendment which has been proposed in the middle of the fiscal year. It is not something which is effective from, let's say, 1st April or 1st January or anything. It is in between the year this is going to be effective. Then I've brought about some case studies so that we are able to understand the implications better. How is it going to impact? Some other considerations. And I think in the end, I would like to sign off with some suggestions as to how this particular amendment proposal can be implemented, maybe in a different fashion. But before we do so, I think for 3 slides, I would want to touch upon some key policy updates and the economic survey highlights that were there of this budget. And I'll tell you the reason. It might take, let's say, 2, 3, 4 minutes, but I'll tell you the reason why it is important for us to know these developments and where the economy and the policy level changes might be going forward. So if you see with respect to real estate and infrastructure, again, the government was upbeat about fostering the private sector involvement in this field. There were enough opportunities and enough policy announcements that they will want to do viability gap funding. The industrial parks announcement was a very good thing. Establishment of plug and play industrial parks, again, something which is the need of the hour for a country like ours. Then the proposals with respect to ship ownership, leasing, and registration. I think this is something, again, where we are wanting to be the leaders, and we are doing year on year something else. Like few years back, we had this aviation leasing thing. Now we are moving to these things. Ultimately, the reason is that the government wants to give stimulus to different industries and create job opportunities. With respect to housing sector, the announcement for housing sector was very good, and this creation of rental housing with dormitory style accommodations, again, this was also a great point. But if you see the last 2 points, and that is something which I want to touch upon in detail. See, there was a proposal of, and this has been going on the round since I think past few years, that digitization of land records is required very much. But I think the second last one is something which we must be mindful and we must take note of. The state governments have been encouraged to lower the stamp duty rates, particularly for properties owned by women. Now, as we know, this was the union budget. This was something which was done by the central government. But the important point is that they have encouraged the state governments to do it. Now, whether they will do it, will they do it, when will they do it? All these are questions for times to come. But I think this is an important point for us to note, that in future, it is possible that we might see stamp duty rates getting lowered. And I'll tell you why I'm making this point that we might see. Because if you see the economic survey, see, on 23rd July, for everyone thought that, okay, it is like a surprise that, capital gains regime has got an overhaul. But if someone read the economic survey, which comes one day before, in that there was a mention that a staff discussion note of the IMF, amongst other things, has recommended enhancing the taxation of capital gains. Now, this is why I'm saying that reading the, let's say, the economic survey and the other budgetary announcements is so important, because, I mean, to some extent, we might be doing crystal ball gazing, but at the same time, we get a sense of what is the policy level thinking and where it might be headed. So in that same paragraph, the recommendation was that, the need is for high personal income taxes. And I'll come to the next slide also when with respect to this aspect. With respect to agriculture also, there was a statement that a reorientation of these policies might unlock the immense benefits of the agriculture sector. And I think the last 2 points would be on how the life insurance premium has gone about. For example, they made a very important observation that if you see the COVID years, the life insurance premium skyrocketed because there was pandemic risk and there was more awareness. But then in the next year, we have seen a sharp decline in the policy premiums in the policy premium growth, because there is, of course, there is a fading pandemic risk and the recent changes which were made with respect to high value policies. Now, why I said on the high personal income taxes, because these two are the charts which are there in the economic survey. Now, what they say that yes, there is number one increase in gross tax revenue to GDP ratio, and yes, number two, the tax revenues have registered a steady increase over the years. But I wanted to highlight the last paragraph that broadly about 55% of our tax revenue comes from direct taxes, 45% from indirect, and these are in line with government's effort to enhance progressivity in taxation. So as we have always seen the progressive taxation slab in income tax, this is the line on which the policy level thinking might be. And these are some things which I'm reading from the economic survey. So that is why I thought I'll bring about these aspects, that it is important for us to sort of understand the hidden points which are there in these very important, crucial policy level documents, because at one place the economic survey did observe or did take a note that yes, there is a recommendation to enhance the taxation of capital gains. Now, be that as it may, let us now move on to the, let's say, the meaty part of this session as to the tax rates and holding period with respect to the taxation of non-financial assets. Now, if you see this table, on the top table deals with the tax rates. And what I've done, I've divided that into the current rate and the proposed rate with effect from 23rd July. So as you see on the short-term capital gains, there is no change. For non-corporates, the slab rates will apply. For corporates, the applicable corporate income tax rate will apply. As we see for non-corporates, for individuals, etc., the surcharge rate can go up to 25%, 37%. When we talk about long-term capital gains, and this is where the change has happened. See, currently our long-term capital gains on the sale of non-financial assets, they are taxed at a rate of 20% with indexation. And when we talk about non-corporates, the surcharge rate is capped at 15%. So at max, the effective rate for a non-corporate taxpayer, an individual, etc., can go to 23.92%. The proposal is that with effect from 23rd July 2024, this rate gets reduced to 12.5%, which is a good point, and that is where this has been marked as green. But B, it is without indexation. Now, the surcharge rate if you take the maximum effective rate at a 12.5% base rate, it comes to 14.95, so practically 15%. The important thing is without indexation. Now, indexation as a concept has been there so as to ensure that a person does not pay taxes on the gains earned merely on account of inflation. If you are earning something just as a price adjustment, or let's say as an inflationary adjustment over a period of time, the government says that no, you're not required to pay tax. And this was the fabric for long-term capital gains taxation. But now at a 12.5% without indexation, because that, and the reason that they have stated is they want to simplify. There were many rates, there were different kinds of computation mechanisms, etc. But now no indexation is to be given. Now at a period of holding, if I see, till now there was land, building, unlisted shares, they were given a 24 months holding period to qualify as a long-term asset. Other assets used to continue at a 36 months, and the typical common, let's say, non-financial assets could be gold, silver, intangible assets. So for them to be qualified as long-term capital asset, that is to say, for being eligible for a concessional rate of tax, the taxpayer was required to hold that asset for a period of 36 months. Now, in the proposed regime, it has been reduced to 24 months. So any other asset, if you hold for 24 months, you are eligible for a long-term capital gains classification. Now, if you see these, there are three types of amendments. The rate is reduced, the indexation has been removed, the period has reduced. So all these points, something helps at least some taxpayer. The rate reduction helps someone. Indexation benefit, we'll of course see with the case studies how it goes about. But the period of holding reduction is something which is good. Now, what will be its interplay with, a land and building or the incentive for people to own immovable property, that also we'll see in the ensuing slides. Now, what are the key noteworthy points when we talk about these benefits? Yes, the indexation benefit has been taken. Yes, the tax rate has been reduced, but the indexation benefit continues at least for transfers undertaken before 23rd July. So, which will mean, let's say, if there is any transfer, if Mr. A has sold his or her property to let's say Mr. B before 23rd July, yes, that benefit will be available. If a taxpayer has converted capital asset into stock in trade before 23rd July, yes, the indexation benefit will be available. If a person has contributed, let's say, capital asset into a partnership firm or an LLP before this date, yes, the indexation benefit will be available. But yes, that comes with an additional cost. The tax rate will also be the higher one. The period of holding, as I said, has been reduced from 36 months to 24 months. For land and building, there is no change as such, because for them, the period of holding till now also was 24 months. Now, what happens when we talk about the 1st April 2001 assets? Now, as we know, there is a provision in income tax law which specifies that if a property was acquired before 1st April 2001, then that is the base year, that is the base date which has been set. Let's say, I mean, in a form of a hybrid grandfathering, in that for those properties, the cost of acquisition will be at the option of assessee, either the original cost of acquisition or the lower of the FMV of that asset on 1st April 2001 or the stamp duty value as on 1st April 2001. Now, logically, the assessee would like to take the higher of, let's say, either the original cost of acquisition or lower of these two figures. Now, after the budget, there had been this one confusion, and I mean, this manner of computing capital gains, I mean, the cost of acquisition for assets acquired pre-2001 has been, let's say, I mean, now clarified by the government also. But I think what happened just after the budget was one confusion which arose as to what will happen to pre-2001 properties, that whether those properties will continue to get the indexation benefit. Now, I mean, does it mean that if I have acquired a property in the year 1999 and if I want to sell it today, then will I get the benefit of indexation even if I sell it after 23rd July? So there was one confusion in the manner of how things got reported. But as such, there is no provision there is no carve out for those assets. So indexation now will not be available. Yes, the 2000, the base year, the 2001 date, that will be available. It's not that if I've acquired the property in 1999 for, let's say, 100 rupees, and even if the 1st April 2001 value was, let's say, 500 rupees, that I will be required to pay tax in accordance with 100 rupees. No, that benefit of 100 versus 500 will still be available. There is one question which has come up, or let's say, another issue that is now being in discussions is what will happen to interest and stamp duty cost which has been acquired for, let's say, the acquisition of capital asset. Would that be part of the cost of asset while computing the capital gains? So, see, there are some rulings which are favorable rulings which are there, but recently, I think yesterday or day before, some reports are coming which are suggesting that no, they won't be allowed as part of cost. So now we'll have to see if any clarification comes or if there is any amendment in this proposal during its passage in the parliament. Now, as you would have heard, I'm harping on the point of this particular date because all these amendments are applicable from this particular date. Now, if we see the cost inflation index numbers, now again and again, this point has been going the rounds that what happens, I mean, what is so relevant about the cost inflation index? See, this is the relevance. Now, from 2001 to till today, the cost inflation index has increased from 100 to 363, which in essence means that the Government Income Tax Act believes that something which was available that at 100 in 2001 is now available at 363. So like 3.6 times. It takes approximately 11 to 12 years, around 12 years to double in the first part. In the second decade, it took, let's say, about 8 to 9 years to double. And now I think the next 100 points will be shorter. But the point is that what this means is that if you acquired something at 100 in 2001, and if you have sold that thing for 363, there would have been no capital gains tax trigger, which means that at least your gains are protected to 3.63 times if I'm talking about this financial year. But going forward, this benefit goes on. This benefit goes away. Now, how does it impact? Does it impact all the stakeholders? Does it impact only a particular section of stakeholders? Is something that now everyone is doing their maths and number crunching because this is a provision which is not affecting everyone equally. It is depending on facts and circumstances of each and every taxpayer. Now, what will be the date of transfer? Since this particular amendment has come from middle of the year, it is very important that the date of transfer aspect becomes relevant. Because see, till now, what used to happen if you transfer an asset, let's say, there are multiple, when we talk about transfer of an asset, and let's say immovable property, there are multiple events which are involved. There would be execution of sale deed, there would be payment of stamp duty, there would be registration of the property, consideration between the parties will be exchanged, there will be giving delivery of possession by one party to the other. But if all those things happen in 1 year, at least from income tax perspective, it was sort of irrelevant, at least when I'm talking about the capital gains computation, because Income Tax Act looks at one full financial year and not a particular date. But now it is this particular point has gained and regained importance as to what will be the date of transfer. And since this is an amendment which has got introduced in between, extra care and caution will need to be taken when people are filing their return for this FY 24-25, if they have any capital gains incidents in this year, and especially in these, let's say the nearby months, June, July, August, if there are some things which are overlapping or spreading or spilling over pre-budget period and post-budget period. Now, I mean, there has been the precedent has been that if once the documents get registered, the transfer will take place on the execution date and not on the date of registration. Because see, registration law allows you a certain period of time within which you are allowed to go and get your documents registered. But if the parties have agreed that yes, we have transferred all risk, reward, title, etc. on a particular date, then that will be regarded as the relevant transaction date once the registration takes place. And we'll do this in one of the case studies also. Now, to understand the impact of this removal of indexation, the reduction in tax rate, let's see. There are 4 to 5 scenarios that I've sort of built in. And case study 1 and 2, I'm dealing with a situation that the assessee acquired the property post 2001. So there is no, let's say, 1st April, there is no relevance of 1st April 2001 value. Now, let's say in case study 1, the cost of acquisition for the person in June 2001 was 20 lakh rupees. And the value has multiplied 50 times. So now it is selling at 10 crore rupees. Now, what is happening is that if you see in the proposed regime column, the person is making a commercial gain of 9 crore 80 lakh rupees. Now, and that is because of 10 crores minus 20 lakh rupees. Now, the benefit of indexation used to be, if you see in the current regime, this 9 crore 80 lakhs gains used to be reduced by the indexation benefit. So your indexation used to eat up certain portion of your capital gains. So if you see in the current regime, the person will be required to pay tax on a capital gains of 9.27 crores, because the government believes that yes, to some extent, there is just an inflationary adjustment which is going on. But in the new regime, what will happen now, that person will be required to pay tax on 9.80 crores. At the first blush, someone will say that yes, this is going to be higher tax incidence in the proposed regime. But if you look at it carefully, the applicable tax amount in the proposed regime in this scenario, in case study 1, is much lower. And why does it happen so? Because in this case, even though there is no indexation, but because of the high appreciation that that person has enjoyed, there is enough headroom so that his tax rate goes down. The appreciation is much more than the benefit of indexation. And this is where this is why I was saying that yes, this is an impactful provision, but it doesn't affect every pocket equally. For a person who has earned great appreciation in a non-financial asset, for that person, despite the removal of indexation benefit, the reduction in capital gains tax rate is much more beneficial. Now take the flip side. Same cost of acquisition in case study 2, but the property is not appreciated 50 times. The property is appreciated, let's say, only 5 times, so at 1 crores. Now, in this case, what would have happened? The person would have paid, the person has, let's say, earned capital gains of 80 lakhs. Because of the indexed cost of acquisition benefit, the capital gains taxability would have reduced considerably. Because in this person's case, the indexation benefit is too high. If you see the gain that he has earned is 80 lakhs, but because of indexation, that person is saving 72.6 lakhs of capital gains, 72.6 lakhs of the indexed cost of acquisition. Now, in this particular case, the person is paying higher tax in the proposed regime, because in this person's case, the indexation benefit was much more than the benefit that this person is making due to the reduction in the capital gains tax rate. And these are all real practical situations that we are seeing post this budget announcement. We are seeing that there are people who were either earning, let's say, loss before this particular proposal. Now they are in a gain position, and in flip side also, people who are earning gain before this position and now they're in a loss position. And loss, when I'm saying commercially. If we talk about the 1st April 2001 scenarios, if the person has, again, if you see in the first case study, and that is interesting because, see, typically for the properties acquired before 1st April 2001, generally it is said that the cost is actual cost or stamp duty value, whichever is higher. But if you see, technically that is not the correct way how one has to read. If you see case study 1, the cost of acquisition in 1990 was 5 lakh rupees. The stamp duty value on 1st April 2001 was 10 lakh rupees, and the FMV was 12 lakh rupees. Now, what will happen in this case? The cost of acquisition will be, and the assessee has a choice to choose between A, 5 lakhs or the lower of 10 lakhs or 12 lakh rupees. So, of course, it becomes 10 lakhs, and in the option that is given to the taxpayer will logically choose 10 lakh rupees as the cost of acquisition. Now, this is the important part that I wanted to highlight, because generally people, normally say that, okay, for pre-1st April 2001 properties, the cost is cost or stamp duty value, whichever is higher. But that is not the case. Now, if the property has appreciated 20 times, so 5 lakhs has become, let's say, 1 crore in terms of sale consideration. Again, if you see, there is a appreciation much more than the indexation benefit. Now, what happens because of the indexation? The 10 lakhs cost in the current regime just goes to 36.30 lakh rupees. So yes, the capital gains amount is much lower, but the applicable tax goes high because that person has to pay tax at a higher rate. But in the proposed regime, such a person will be required, the amount of tax this person will be required to pay will be less, because the tax rate has gone down, and this person is not saving much because of the removal of indexation, is not saving much because of the indexation. Now, these are just hypothetical examples. You can put, you can filter any, input any number into this. People can calculate what is the break even, etc. But the point is, if there is a case of low appreciation, as you can see in case study 4, again, let's say 5 lakhs has become just 50 lakh rupees, then the benefit of indexation is much more, because in that case, what happens, the cost gets inflated to a figure which is much near to the sale consideration. So as a result, the quantum of capital gains on which tax has to be paid shrinks to a very small amount. And when that base shrinks to a very small amount, logically the applicable tax figure goes down. And that is something you can see in the case study 4. If the property has appreciated not at a very high price, the appreciation is very low. So in that case, the assessee will in a low appreciation scenario, the assessee benefits if the indexation option is available. In the case study 5 that I want to discuss, this is what I was telling about on the date of transfer. Now, see, these are hypothetical dates that I'm taking. It may not be exactly matching, but the point is, let's say, if the payment of stamp duty has happened before the budget day, if the date of execution, if the sale deed has been executed before the budget day, and if only the registration step is remaining to happen after the budget day, then there is a great argument to say that yes, the date of sale in this case is before the budget day itself, and therefore higher tax rate but with indexation. And when I say argument, because yes, there are multiple, these events will not happen just in silos. People will also have to see, okay, when the consideration transferred, when did the possession get delivered, etc. But this is an important determination that now people will have to do. As against this, if let's say stamp duty date was same, registration date was same, but the sale deed execution happened after the budget day. And that is the important thing, with on which day parties are agreeing that yes, I have transferred it to you, and you are agreeing that you have acquired this from me. If that date happens after this, then logically, yes, it is I mean, this is a transfer which one will have to say happened after the budget day, and therefore get impacted by this change. So important thing is for people who are transferring non-financial assets or even financial assets during this year, especially near the budget date, people should take extra care and caution when they're filing their ITR. Of course, if and when any cases get picked up for scrutiny, that might those would be sometime later in life, but adequate documentation, support, etc. should be maintained to support what is the relevant fact. If the transfer is before this date, then also adequate documentation, etc. should be maintained, and it should be well prepared in advance. And even if it is after this date, then appropriate documentation supporting, etc., that filing, everything, records should be kept maintained from day one itself. Because if at all any questions, scrutinies, etc. come in, it will be very hard to find out these small things, that okay, when was stamp duty paid, when was the registration date, when was the sale deed execution. If there are multiple parties involved in a sale, when will you say that it was registered? When will you say that the sale actually took place? Let's say if the seller has given a power of attorney to someone else to execute the sale deed, which date will you take? Will you take this power of attorney date? Will you take the sale deed date? If there is, let's say, a situation in a state where an agreement to sell happens before the sale deed, which date will you take? There might be even scenarios where, let's say, when a builder gives a property, the execution date, signing date is different. So there are multiple factors when possession letter is given. Under construction properties, what will happen, which date will be taken. So therefore, this determination of date of transfer will become very important, and one must take into account and take extra care and caution, because it is possible that uh, internal errors, etc., might creep up, which can put the taxpayer in unnecessary trouble as to prove that what was the date of transfer and what should be the capital gains taxation rate which should be applicable. Now, in terms of impact, I think one thing is very clear, and everyone is talking about what will happen to the real estate sector prices. But before I do that, I think we all want to know, okay, when we were doing the case studies, I mentioned the word, what will be that cutoff growth rate? Everyone is, trying to calculate that what would be the cutoff rate, the break-even rate, where I'm, let's say, equal, and no regime is affecting me in a different way. Now, these are three portions which I've culled out from some articles. And if you see what they say, that no matter the purchase date of your property, if the annual growth rate of the property's price is below 9%, there is a high probability that the new rule will push you towards the losing side. But if the property has grown annually by 10% or above, the new rule might end up giving you better benefits. And this is why I took those case studies of low appreciation and high appreciation. So if your property has appreciated at a good pace, then the removal of indexation benefit will not haunt you. But if the property has appreciated lower, then the removal of indexation benefit might haunt you. And now, if we see what has been the percentage or growth rate in our country in the property prices, now this is the important part, that who will be the affected class. I think mostly people who purchase property, let's say in the 5 to 10 in the recent past 5 to 10 years bracket, because that article states that most of the cities except Hyderabad have seen an annual property price growth of below 9%. So for those people, the benefit of indexation was much more than the actual commercial appreciation in the price. Because if the price is not appreciated by a great pace, then the indexation benefit was taking your cost to a higher level, so that you were able to gain this benefit and the reduced tax cost. And if in terms of cities, I think other than MMR and Chennai, these are cities which have seen about less than 5% CAGR in terms of average housing price over the 5-10 years. Others have seen majorly 5 to 10%. So if we link the third bullet to the first bullet, it looks like that most people who have purchased lately in the last decade or so might be the tax cost could be a little bit higher because the property has not appreciated as much as the indexation benefit was there. Now, question is, what will happen to the real estate sector? Now, does it mean that it has lost its sheen? Because till now, what used to happen in terms of other major investment classes other than the financial assets, real estate and unlisted shares was something else, but real estate used to get the benefit of a 24-month holding period. That is to say that you were required to hold it only for 24 months. The moment you held it for 24 months, the next day if you sell it, you are eligible for a long-term capital gains tax classification. Now that relative advantage is not there. Now whether you buy a real estate or a gold or a silver or an intangible asset, everything gets qualified into long term at the expiry of 24 months. So that relative advantage is not there at least. Does it mean that the sector has gone down? Arguably no, because this is not the primary reason by which a person would acquire real estate. There could be many other factors, but yes, this used to be a decent enough reason for a factor for people to take the decision. But yes, it is not the only reason. Now, how will it impact is something in the next, I think in the next year or so, we should be, or maybe in the next few months also, we should be able to understand, because from today on also, once this bill becomes an act, this particular thing has become effective. The second point is, and this is in some circles, this is getting highlighted as to what will happen on the valuation bit. Will it mean that there will be again the risk of undervaluation, of course, up to the circle rate? Will that be the case? Now, this is something which time will tell how people, let's say, look at it and how are they getting affected, etc. But this is a risk which is getting highlighted in certain circles. Then I think now all those sections 54, 54 EC, all those things will gain more and more advantage, because those are the capital gains saving bonds, and if people, and of course up to a certain limit. Will it mean increase in purchase of those capital gains saving bonds is also something which in the next few months, or maybe in the next 6-12 months, we'll get to see that difference. But yes, in terms of impact, these are few areas where one should keep a close watch and close eye, because this is linked to the growth rate of your property. From next year, it will again depend on at what time you acquired the property and what time you sold. But it is this impact, as I said, it is not affecting everyone equally. It is not affecting everyone in an equal fashion. Its impact is dependent on the growth that your particular property has earned between the acquisition date and the transfer date. If the growth is much more, honestly, the person is not concerned with the indexation benefit. If the growth is not up to the mark, or let's say a little bit less, then the indexation benefit was very much helpful. There is one more point which I think is relevant on this aspect. It's not just linked to capital gains, but the TDS on the property purchase, the 1% TDS they're used, so which is applicable if you purchase a property in excess, the consideration exceeds 50 lakh rupees. So there used to be this one doubt that, let's say, if Mr. A and Mr. B jointly purchase a property for 90 lakh rupees from Mr. C, then whether the TDS trigger will apply, because Mr. A is paying 45 lakhs, Mr. B is paying 45 lakhs. Will this TDS trigger apply, because the threshold is 50 lakh rupees? So now that has been clarified that yes, it will be linked to the consideration value. Secondly, what happens if A purchases a property for 90 lakhs from B and C, again 45 lakhs to be paid to both the parties. So that has also been now clarified that it is linked to the the consideration for the property. The number of buyers or number of sellers will not be relevant to decide whether this TDS trigger kicks in or not. So now I think all in all, to summarize, I think the point is that when we talk about non-financial assets, tax, the long-term capital gains tax rate has been reduced from 20% to 12.5%. The indexation benefit has been taken away. The period of holding has been reduced from 36 to 24. How will it impact? As we saw in the case studies, it is not the same for everyone. People will have to do their benchmark. People will have to do the number crunching exercise. But at a general level, as I said in the previous slide, if the growth rate is not much, and if you have acquired the property rights in the recent past, then the growth rate might not be that much. So therefore, in that case, the particular indexation benefit would have been helpful. How it can be implemented in a different way is also that, the FMV as on 22nd July, or maybe the indexed cost as on 22nd July, they can be grandfathered. And this is we have an instance, we have a similar example to the 31st Jan 2018 grandfathering in case of listed shares. So we should be watchful of as to whether during the passage in Parliament, whether this particular proposal gets amended, and at least the indexation benefit which had got accrued till date, that gets let's say protected. But we'll have to see as to how this proposal comes in, because if it is at least protected till date, people will say that yes, then it's a government's policy prerogative whether they want to discontinue the indexation benefit. But at least till date, the indexation benefit that had accrued, at least if that can be protected, or the appreciation in value can be protected, or in some fashion an option can be given to the taxpayer. So those are the things which we should be watchful as to whether this proposal undergoes any change during its passage in the Parliament. So I think the one last point which I think if I have, let me just see if there's, yes, I think I can cover this 5 minutes on the slump sale point. See, there is the period of holding has been reduced, as I said, from 36 to 24 months, but that amendment has come in section 2 clause 42A. Now, slump sale, that particular computation mechanism and the whole code comes from section 50B. Now, in the period of, now what happens in a slump sale? A person transfers a business undertaking as such to another person for a lump sum consideration. Now, and it is regarded as a capital asset, so the resultant gains are capital gains. Now, whether it will be long-term capital gains or short-term, it depends on the period for which that whole undertaking was held. So the holding period of individual assets are not relevant, is not relevant. If the undertaking has been held for more than 36 months, it is regarded as a long-term capital gains. Now, what has happened is that the period of holding for slump sale doesn't come from section 242A. It is specifically mentioned in section 50B itself. So now there is one confusion as such, or I mean that one issue which has been undergoing the discussions is what will happen to the slump sale transactions. If we see the bill and the law, there is no mention of slump sale, but what is happening is that the government has clarified that now the holding period has been simplified and there will be only two holding periods, 12 months and 24 months. So if we go by that logic, it might be possible that the slump sale holding period gets reduced, or we'll have to see whether this has been intentionally not touched on, because maybe the government feels that this is a different class of asset. So the only reason why this sort of confusion or this discussion, etc., started with respect to slump sale is because the clarification that has come that now the holding period will be only two types, 1 year and 2 years. Whereas this 36 months in case of slump sale comes specifically from section 50B, which has not been touched upon or which has not been talked about. The computation mechanism for capital gains in case of slump sale remains the same. That is to say that you take the FMV of assets transferred, you compute it in a particular prescribed manner, and you reduce the net worth of that undertaking, and then what you get is the resultant capital gains. For net worth also, there is that same formula that you aggregate the total assets of the division and reduce the liabilities which are appearing in the books of accounts. The resultant figure is the net worth. Net worth is essentially the cost of that undertaking. For slump sale, the success and tax liability risk exposure remains same. There is no change on that, which I mean, by that I mean that the tax authorities can recover the seller's unpaid tax liabilities for the year of transfer up to the date of transfer and one prior year. So from the purchaser if it cannot be recovered from the seller. So we should also be watchful as to whether any amendment takes place with respect to slump sale holding period or not, because that is a period which comes separately from the section itself, and it is not linked to 242A, at least as of now. So that is also something which we should be mindful of. So this was it from my side, Ridhima.
Thank you so much for a wonderful session, Raghav. I think there were some real concerns when this changes were introduced, especially for removable property. And I think you addressed them pretty effectively. Before we conclude, I would like to take few questions on behalf of our audience and also some of my personal questions.
Sure.
So the rationale was behind to simplify capital gain, correct? What do you think could have been a better approach in that computation of the capital gains for people in general, or everything was addressed by the finance minister?
So as I said on the suggestions bit, I think one way in which it can be done or could have been done is if we protect at least the FMV as on budget date,
Right.
or if we let's say protect the indexed cost as on that date, and we have a precedent for that in the act itself, the grandfathering benefit of 31st Jan 2018. If that could have, I mean, that is a manner I think which can be adopted, and I think during its passage in parliament, it's possible that this proposal might undergo a change. Yes, it will need to have its checks and balances, because then you can't have that a person who opts for indexation, that person should not get the benefit of a lower rate of taxation. I mean, the government will also say that. So I think a fair balance can be adopted if an option can be given to the taxpayer that
Yeah, I
if you
think
want,
option is better.
option is better, I think. So that is something one should be mindful and watchful of.
And you are hopeful that something like this would come before it gets the president assents?
I mean, it depends on how much stakeholder consultation, how many people represent that this is a genuine concern, and how much revenue forgone, and that mathematics the government does. But I think this is a point which is, I think, doable, at least because there is a precedent also in the act itself for this.
Okay. And there is one more thing, something related to JDA, one of our audiences asked, is how do you the changes in the holding period and tax rate depicts the joint development agreement? Because specifically, what are the tax implications if the JDA is entered into before July 23rd, but possession of the land is handed over after the date?
So I think I'll take that question into two parts. One is
Okay.
the JDA. In case of JDAs, the date of transfer has already been subject matter of a litigation. I mean, there has been
Correct.
different views, etc. A few years back, there was at least one amendment which was brought in Section 45 with respect to, I think, individuals and HUFs. Individuals, that if they, what will be the relevant date on which the transfer takes place. So I think because of the amendment, there won't be change in that determination. You will continue to calculate and determine your date of transfer applying those existing principles. But important is, if at all that those events, let's say possession, let's say allowing the other part, the builder, to come and step into the property and do the work, the stamp duty, etc. If at all those days happen nearby these, let's say before something happens before and something happens after, that is something which will be critical to take care, because the impact, as I said, can be in huge numbers, depending of course on the cost and sale consideration, but the impact can be huge. So that thing will need to be taken care of appropriately.
Okay, right, absolutely. And I just said that there can be and can be not situation for an impact on the real estate markets. So can we see that altogether shooting of the prices of the property can be a bit monitored with this? No.
I mean, there are always both sides. As I said, one is real estate might have lost its relative advantage, at least in terms of period of holding. But is that a very major concern for an investor? Maybe not, because there are when a person is investing, of course, this is an investment advice, so maybe the real estate investment advisors might be best placed. But I think when a person is doing that, so they are looking for more and more of commercial appreciation. But this benefit at least has gone away. So from that perspective, there are two ways to look at it. One is that the tax rate has reduced by 7.5%.
True.
Now, indexation is something which today we know that is something at least now part of proposed history. After 2 years, 3 years, this will be the law. So when a person will buy now, they will always factor in at least this part of the cost. As I said, the valuation related concerns which are being cropped up as to whether this will lead to let's say valuation concerns in real estate transactions. That is something which in the next 2-3 months, or maybe in the 2 months also, government will monitor and then take a call, because its impact will be immediate for real estate deals.
Got it. All cool. Thank you. Thank you so much, Raghav. Thank you for your time.
Thank you. Thank you, Ridhima. Thank you, Taxman.
Thanks a lot. So next, we are almost halfway through our marathon, and I'm delighted to welcome Deepak Bhholusaria for our next important session on TDS and TCS provisions. Deepak Bhholusaria is a partner at Daksha and Co LLP. He's a commerce graduate and a fellow member of the ICI. Deepak served the Taxation Audit Quality Review Board of ICI for 23-24 and is an elected member for the Executive Committee of the Sales Tax Bar Association. With 25 years of experience, Deepak is a seasoned professional, author, faculty member of ICI, and a speaker. He has presented on national televisions, industry forums, and various branches of ICI and ICSI. ICI has even recognized his contribution as a speaker over the years. An IT enthusiast and a YouTuber, he's also a life member of a major tax and fee association in the country. Hi, Deepak, how are you?
I'm good, Ridhima, and good afternoon to everyone.
Very good afternoon from everyone's side. Yeah. So, without further ado, the session is now all yours. Thank you so much.
Thank you, Ridhima, and very welcome to everyone here on the Taxman's Budget Marathon 2024. I'm privileged to be here amongst all of you. So, without wasting much of the time, let's deep dive into the topic itself. Let me share my screen, please. Is it visible, Ridhima?
Yeah, it is. It is.
Okay. So, and my voice is also audible?
Perfectly clear.
Okay, so I believe I have approximately 30-35 minutes to speak, and we can have a 5-minute session for question and answer session, right?
Noted. Yes.
And I believe all the audiences, I mean, the participants will be putting up their question only through chat window, or is there any YouTube live streaming also?
So it is being broadcasted live on almost 6 media platforms.
Okay.
So all the questions would be curated, will be directed to me, and I'll be asking you from other platforms.
Sure,
They can
sure,
put it in the comment box there.
Thanks a lot. Thanks a
Thank
lot. So already I have been introduced by Ridhima. So I qualified as a chartered accountant in 1998. And I'm into practice for the last 25 years. And our firm's name is Daksha & Co LLP. We have various offices all over India. And these are the topics which we are going to cover today as far as TDS and TDS TCS part is concerned, starting from amendment in section 192 and going to then what are the changes in TDS, various sections of the TDS. And very interesting section which they have introduced this year is TDS on payment to partners of firms. I know a lot of questions and a lot of doubts are there in the mind of the people. Then there are many changes which are related to the administration part of the TDS and TCS. There are changes as far as penalty is concerned, time limits for filing of your correction returns are concerned, and so on and so forth. So we will be dealing with each and every point in detail, one by one. So let's start with section 192 amendment. So you see, till now, if I'm an employee, and obviously I'm earning certain salary from my employer, and my employer is under an obligation to compute my TDS liability under section 192 for the whole year, right? I file a declaration throughout the year, and at the end of the year, I provide proofs. Obviously, if it's a case of a new scheme, then obviously those proofs are little less now. But in any case, employer is under an obligation to compute and deduct the TDS. Now, by doing so, there may be a certain situations where I am also earning certain other income. Let's say I have an interest income, or maybe I'm employed with employer for, let's say, employer B. And prior to that, I was employed with employer A for a part of the year. So that salary, that part of the salary, I'm also supposed to tell my present employer. And taking into account that salary, my employer will recompute my entire year's tax liability and deduct the TDS. And obviously, since I have already, I have given, I have disclosed the salary from employer A to employer B. So employer A might have also deducted some kind of TDS, right? So employer B is also under obligation to consider the TDS which has been deducted on salary from employer A. This is one example. Another example could be that I have, let's say, interest income. And on interest income, we know generally only 10% TDS is deducted. Or there may be a situation where TDS is not at all deducted, right? and I am into slab of 30%. So there is a gap of 20%. So in order to fill in that gap, either I need to deposit my advance tax, or I can simply tell my employer that, look, you consider this salary, this salary or any other income, and also consider whatever TDS has been deducted on this income, and whatever is the balance liability, it may be deducted by you through section 192, and employer used to do that. Now there were certain issues therein also. First, only income could be considered by employer, not losses. Let's say there is a loss, maybe in certain head, which employer is barred to consider, and that position still stands. Loss cannot be considered even after this amendment. There may be situations where I have TDS or TDS in some other sections also. Let's say if you see if a particular income has not been considered and that income actually has a loss, then since that income has not been considered or that loss has not been considered, if there is any TDS which is related to that particular source of income, that was also not considered. So the law said that income and TDS thereon. So there has to be a linkage between the income and the TDS. First. Second, TCS was not allowed because TCS is not income. Let's say I have purchased a car, and on that car TCS has been deducted, collected from me. And obviously, well, I'm filing my income tax return, I need to take the credit of that TCS, and ultimately there may be a situation where I am getting a refund from the department. So again, that TCS credit was not allowed. Now, two things have changed. First, obviously you can disclose the income. Second, any kind of TDS which has been deducted somewhere else can also be considered. And second, if there is any TCS which you have deposited or it has been collected by some collector, then obviously that credit is also now allowed to you. So these are two very major changes, and it's very beneficial to all the employees. If we look at section 193 basically talks about interest on security. There is 192A, 194A, which is interest on other than securities, and there is section 193, which is TDS on interest on security. And within section 193, there are certain exceptions also, wherein even though the primary provision of 193 says that TDS has to be deducted on interest on security, but there are certain exceptions therein also. And one of the exceptions which has been provided in section 193 is that if there is an interest on central or government securities, say for example, treasury bill, I take an example, right? If there is an interest which is paid on central or state government securities, by mistake, I have only mentioned central or government security. Basically, it is central or state government securities. So if there is any interest which is payable on state or central government securities, as of today, no TDS is required to be deducted except for saving bond of 2003 and 2018. So these were the two only exceptions, meaning thereby, if any interest is payable on saving bond of 2003 and 2018, then TDS provision shall still apply. Now they have changed this provision, whereas not only 2003 and 2018 are still retained, they have now also added floating rate saving taxable bond. Basically, if you go at RBI's website, these floating rate taxable bonds are issued. You see, generally, the state government or central government securities are issued at a fixed rate of interest, but there are certain market linked saving bonds also which are issued by RBI. So on those bonds, if any interest is payable, even then TDS shall be deducted. Not only that, now there are three entries which are mentioned in the 193 itself. There may be a situation in future where some other securities are required to be notified for the purpose of section 193. So now the government has taken the power to notify such security rather than amending the section 193 again and again. Now simply they have taken the power in their hands itself, and this provision is effective from 1st of October 2024. Now going ahead with the changes in TDS rate. So in a lot of sections, they have actually reduced TDS rates. So say for example, section 194D. payment of insurance commission, right? From 1st of April 2024, instead of 5% TDS on payment of insurance commission, right now it's 5% under section 194D, it shall be reduced to 2%. And since it is commission, so similarly under section 194H, the TDS rate shall be from 5% to 2%. If you remember, earlier the TDS rate for commission used to be 10% under section 194H. Then they reduced that number from 10% to 5%. Now, this number has been reduced from 5% to 2%. Similarly, commission again on sale of lottery, again 5 to 2%. Payment in respect of life insurance policy from 5% to 2%. Then 194IB, wherein if I am an individual or HUF, I am paying any rent more than 50,000 rupees per month, then at the end of the year or at the end of the term of lease, I am supposed to deduct TDS at the rate of 5%, right? Now, instead of 5%, that rate of TDS has been reduced to 2%. Similarly, section 194M, wherein if let's say I have engaged some professional, I am talking about a situation where 194C is not applicable, 194J is not applicable, 194I is not applicable, right? I'm talking about those situations. I will be dealing in this part in the later part of the presentation also. There is one particular slide on this issue. So again, therein, the rate of TDS has been reduced from 5% to 2%. E-commerce operators. Now, why, the question is why it's from 1% to 0.01%. Again, the genesis of this change is in section 194Q and 206C1H, right? Therein, for sale of goods or for purchase of goods, the rate is 0.01%. Even though, please appreciate, 194O does not cover only and only goods. Even supply of services through e-commerce operator also attracts 1% TDS. But they have now reduced it to 0.1% only. Similarly, in case of any repurchase of units by the mutual funds or UTI, I mean, till now, the rate of TDS was 20%. Now, from 1st of October 2024, it is going to be omitted at all. So, no TDS as far as repurchase of units by mutual fund or any or UTI is concerned. So, it's again a welcome change. So, all these provisions are effective from 1st/10/2024. Please appreciate that all these provisions are procedural in nature. So, that is why generally in the past we have seen either the rate of TDS are changed from 1st of October or from 1st of July, right? Since the budget is announced in the month of July, so practically it is not possible to change the rate overnight. So instead of that, they have changed it from 1st of October 2024. But traditionally, we have seen that the rate of TDS are generally changed or increased or decreased as the case may be from 1st of July at the after the completion of one quarter, because by that time budget or finance bill we call it, it becomes an act, and that is why it is implemented from 1st of July. But since budget is late this time, and that is why the implementation date is either from 1st of October or 1st of April. So 194IB, I have already explained this part. Similarly, 194M. So 194M basically covers three parts basically. You should be an individual or HUF, and you are not supposed to deduct TDS under section 194C, H or J, or in other words, the amount you are paying to your pay shouldn't be covered. There may be a situation that I am a businessman, right? I'm a businessman. I'm making payment for my business or for my personal use. So if I'm making payment for my business use, obviously 194C shall be covered. And if I'm making payment for my personal use, then 194H shall be covered. So if I'm not wrong, the threshold limit is 50 lakh. So in this case, if you are making payment for these nature, so these are parameteria with 194C, 194H and 194J as far as nature of payment is concerned, then in that case, I'm supposed to deduct TDS at the rate of 5%. No, now it is 2%. So now it is 2%. And obviously, there is a separate challan cum return for section 194M. You are not supposed to file 26Q for these, right? The e-commerce operator, I told you that the genesis of this change is in section 194Q and 2061H. So now the rate of TDS from 1st of October 2024 is only and only 0.1% rather than 1%. You see, if I'm making taking any online transaction, offline transaction, that the rate of TDS is only 1.1%, or whether it is a sale of goods or whether it's a purchase of goods, as the case may be. But now to bring parity between the offline transaction and the online transaction, now the rate of TDS or TCS, as the case, TDS basically is 0.1% only. Now we were listening to other speaker as far as capital gain is concerned. So the impact of changes as far as capital gain on financial assets is concerned, we can also see those impact of those changes in section 196B as well as 196C. So in case you see till now, if there is any capital gain or any income from mutual funds, right, from units, so the rate of TDS used to be 10% for units. So till 22nd of July 2024, the rate of TDS shall remain, I mean, it used to be 10% only. Because of change in rate for capital gains, for long-term capital gain on section 112A you talk about, or any other section you talk about, or 112 you talk about, the rate is 12.5% now. It's flat, 12.5%, right? So accordingly, consequently, the changes have been made in 196C now. So the rate of TDS on units, as far as capital gain is concerned, but as far as dividend is concerned, it is still 10%. But on case of redemption, it may be a case of redemption basically. So if it is a case of redemption, then the rate of TDS will be 12.5% for all those units which are covered by 196C. Similarly, if the units are covered by section 196C, the rate of TDS is 12.5% instead of 10%. So only the thing is that both 196C and 196B covers different assets, different financial assets basically. But as far as rate of TDS is concerned, it is same. It is 12.5% on capital gain, long-term capital gains. Now, this is a very, very, very interesting section they have introduced. And this section has been introduced from the 1st of October 2024 itself. So let's say I am a partner in a partnership firm. Obviously, what kind of income I earn from my partnership firm? It can be a salary or remuneration, whatever name you call it. You have to see the substance of the transaction rather than the nomenclature which you are giving it to it. So it can be salary, it can be remuneration, right? It can be a commission, right? Commission in the form of percentage of profit of the firm, or it can be in the name of, or it can be in the form of bonus also, or it can also be in the nature of interest on the capital which I have deployed in my firm. And on top of that, I shall also be eligible for profit from the firm or maybe losses from the firm. Now, what they have done is they have introduced TDS on all these kind of payments at the rate of 10%. So at the rate of 10%. So similarly, like any other section of TDS, so the provision is at the rate of 10% at the time of payment or credit, whichever is earlier. Now, this is effective from 1st of October 2024, and threshold is also 20,000, right? So there are a couple of issues. It's a first time provision. There can be a transitionally issues also. First, let's say till 30th of September 2024, I have already credited partner's account. I am a firm, right? The responsibility to deduct is on the shoulders of the firm. I have already credited partner's account by, let's say, 50,000 rupee on account of. You see, it is very important that on what account the account has been credited, right? It can be credited on account of salary. It can be credited on account of remuneration, commission, bonus, interest, and also profit. But you see, profit is only credited generally it is only credited at the end of the financial year. So I'm not taking that situation. I'm taking a situation on 31st of September 2024. Till 31st of September 2024, I have already credited account, maybe on account of salary or maybe on account of interest. Now that amount is paid in 1st of October 2024. So let's say till September 2024, I have credited an account by, let's say 70,000 rupees, right? And opening balance, let's extend this example. Let's say on 1st of April 2024, the opening balance was 1 lakh of rupee. Till 30 September 2024, I credited the account by, let's say, 60,000 rupee in the form of salary, not even in interest, in the form of salary. So what should be the closing balance as on 1st of October 2024? It should be 1,60,000 and it is payable to the partner. It is payable to the partner. So now on 1st of October 2024, I have made a payment of 2 lakh of rupee. So the opening balance was 1,60,000. I have made a payment of 2 lakh of rupees. The question is, on what amount should I deduct my TDS? Should it be only? Sir, since the provision is applicable only and only from the 1st of October 2024, so the first 1,60,000 shall be excluded from this payment. So 1,60,000 should be excluded, and only on the TDS should be deducted on the 2 lakh of rupee. Now again, there may be a situation to understand now this 40,000, this extra payment of 40,000, is it in the nature of interest, salary, or what? You see, in my particular example, already I have exhausted the balance itself. So what is remaining is the payment of 40,000. So depending on the facts of the cases, it may happen that this payment is on account of capital, right? But since there is no clarity, even though I would expect some circular from the department on this particular issue also. So prima facie, it appears that this payment of 40,000 is on account of salary, interest, or maybe a commission. Generally, it is, and there may be a situation also that during the year I am withdrawing the amount from the firm, but the payment, the credit entry of salary or interest is only made at the end of the financial year. Let's take that example also. So until 1st of October 2024, there were no credits in the bank, in the account. And whatever credits were there, these credits were on account of extra capital introduced by the partners. So extra capital introduced by the partner. So let's say on 1st of April, the balance was 1 lakh of rupee payable to partner. During the financial year, partner introduced some amount of 2 lakh of rupee. So on 30th of September 2024, the outstanding payment is 3 lakh of rupee. Now during the financial year, partner made certain withdrawals also. So there were certain inwards, there were certain withdrawals, there were certain inwards, there were certain. So we have to figure out that this payment which is being made to partner, is it on account of salary or is it on account of the balance which is already lying in the account? So what I will do is I will apply the FIFO method, right? So let's say on 1st of October 2024, the balance payable to that partner is 5 lakh of rupee. I am taking an example. In the month of October, for first 15 days, I made a payment of 4 lakh of rupee. So this 4 lakh will be adjusted against the 5 lakh which is already payable to the partner. So there is no question of making a payment on account of salary, remuneration, commission, and so on and so forth. So still 1 lakh rupees payable to the partner. So no TDS. Right? On 16th of October, I made a payment of 3 lakh of rupee. So 1 lakh is already outstanding. So 1 lakh is registered there. So 2 lakh I have extra paid. On 17th of October, partner introduced 3 lakh rupee extra. So 2 lakh extra was first paid and then 3 lakh was introduced. So net balance now is again 1 lakh. So the question now will arise, should this amount of 2 lakh be considered as paid on account of salary remuneration, or should it be considered on account of extra withdrawal by the partner? So this is one particular area where I believe clarification should be issued by the department. Can we put a clause in partnership deed stating that the salary interest to a partner shall be calculated till September of following year and deducted tax in that year? Sir, I can't catch your name. Let's say your financial are prepared for 31st of December, March 2024. The question is, while filing your income tax return, won't you be computing your book profits and asking for the deduction of salary? So can you say that I have credited the account only in September, though this salary is pertaining to 31st of March 2024, or can you claim the deduction? I don't think so. I don't think so. So you see, we need to bring in the discipline now to, you see, as far as salary part is concerned, generally there is a clause in the partnership deed that the salary should be computed, or the remuneration shall be computed per month so and so, and subject to certain limits. This is the general clause I have seen in as far as partnership deeds of generally firms are concerned. So those clauses shall also come into play. So if there is, if you put in the clause that it shall be credited in the account in the next financial year, so how can you claim that deduction? So there are issues. So my suggestion is that we should at least prepare two accounts as far as partners account is concerned. Even though 194T clearly says any account of partner, it is immaterial whether account is by the name of capital or by the name of current account. So what I will suggest is that you should prepare two counts, still two counts. One is related to capital, where only the amount introduced by the partner and the amount withdrawn by the partner is concerned. And there should be a current account where all salary, remuneration, bonus and interest should be credited. So if let's say partner is withdrawing salary every month, so that amount should be debited to the current account. Again, it is only for the administrative convenience. I'm not saying that law would be qua capital account or qua current account, because law is very clear. You see, generally in other sections, the concept of suspense account is there, but as far as 194T is concerned, there is no concept of suspense account. But they have clearly said that any account, whether it is a capital account, whether it is a current account. So for the discipline purpose, I will suggest that you should maintain two set of accounts, one only and exclusively for capital. If partner is introducing capital, so that account should be debited as till the time there is a balance in there, so any withdrawal should be debited to capital account, unless and until you have an issue that if I withdraw capital from my capital account, I may be entitled to less interest on my capital. In that case, you should go to current account and then you should bear the 10% TDS also. There may be a situation, friends, that let's say I have made a payment of, let's say 5 lakh of rupee, but at the end of the year, I see that the salary which is allowable to my partner is only 4 lakh. So that also will create a certain situation where even though the payment of TDS is on a higher number, but actual amount which is allowed to that partner is on a lower side. So in that case, the probable solution could be that you amend your TDS return, but the only thing is again, how will you justify that even though you are paid 5 lakh rupee, but at the credit is there, but at the end of the day, it is the extra payment which you have paid. It's like an advance to the partner. Don't we deduct TDS under section 194C or 194J on advances also? Yes, we do. Similar kind of principle shall also apply here. So I think this question can be closed. If there are any other additional question on this particular issue, I would love to answer those questions also. Okay. So I believe there are no more questions. So again, the lower deduction certificate or lower collection certificate, which is issued by the AO under section 196, 197 or 206C, subsection 9. Now they also cover section 194Q or section 206 in its ambit. Till now, as far as sale of goods are concerned, for that, even though the rate of TDS is only 0.1%, please appreciate the rate of TDS is 0.1% only. But still, there are certain situations where, even though the rate of TDS was such a low, but a lot of people were under losses. So in order to cover that particular section also, the section 197(6), 197 and 206C is being amended to include within its ambit those section also. So now if you are a purchaser or a seller of goods, then you can obviously after 1st of October 2024 file form 13 and you can obtain a low deduction certificate for that. Because generally I have seen that as far as rate of 10% is concerned, a 0.1% TDS low deduction certificate is issued, but already it's 1.1%. So practically, I don't see any situation where a zero rate TDS LDC would be issued, even though law doesn't bar you to issue 0% LDC. But practically, they always issue LDC with some certain kind of rate. So maybe 0.01%, at 0.01%, they may introduce. Again, from 1.1% to 0.01%, it could be a substantial amount. But it is applicable only from 1st of October 2024. Now, there may be a situation where, let's say, I am earning income from outside India, right? Let's say 100 rupee. And on that 100 rupee, 30 rupee TDS has been deducted. Right? So, what is my income? It is 100 rupee. What is the TDS deducted? 30 rupee. So the question is, what amount of income should I offer? And should I claim FTC or not? So as far as 198 is concerned, if you look at other things also, it very clearly says TDS deducted is also income earned. So that if let's say it is a case of 70 rupee, you shouldn't offer 70 rupee as income, right? And then you also claim 30 rupee as TDS. But as far as foreign income was concerned, it was happening so. People were, because of definition in section 198, people were offering only rupees 70 as income. And at the same time, they were also claiming FTC for that 30 rupee. So there was a double loss to the government. One hand, you are offering income of only 70 rupee. It means that on 30 rupee, government is collecting no tax. And at the same time, you are also claiming FTC. Now they have amended section 198 to tell us that in case you're also claiming rupee 30 as an FTC, in that case, this entire 100 rupees shall be treated as your income. But in case you are not claiming this 30 rupee, as far as foreign taxes are concerned, you are not claiming this 30 rupee as FTC. In that case, you can clearly claim only 70 rupee as your income. And this change in section 198 is effective from 1st of April 2025. So how much time is left with us, Ridhima?
Sir, we have good 5-6 minutes more.
Okay. So again, I have a lot of slides. Let me quickly rush to them. Okay. So you see, till now, there was a time limit to file your original TDS statement or TDS return or TCS return, which we generally call it. But there was no time limit per se for filing of correction return. So now they have corrected this anomaly. So there is a period of 6 years, both for filing of original return as well as filing of correction return within 6 years from the end of the financial year, from the original due date of filing return, And this, obviously, this limit shall be qua each return separately. For 26Q, we are supposed to file 4 returns. For 27Q, we are supposed to file 4 returns. And similarly, we are supposed to file 27EQ or 24Q as the case may be. So for 4 separate returns, the time limit would be separate. At least for 3, for first 3, it could be combined time limit, because Q4 TDS return basically, the due date of the Q4 TDS return falls in next financial year. So effectively, we have an extra 1 year for that return. But now there is a parity between original return, time limit of filing original return as well as correction return. Now, this is a very, very, very interesting amendment. If you remember, earlier it used to be that if you don't file your TDS returns or TDS statement within a particular time limit, you are supposed to pay a penalty of rupees 200 rupees per day, right? We all know that no penalty can be levied automatically. You see, you need to give a chance to the filer that why TDS return or TCS return was not filed within the time. What were the reason behind filing of that late TDS returns? But in my experience, rarely that penalty was levied. So instead of penalty, they introduced section 234E. Years back, they introduced 234E, whereby now instead of penalty, they said late fee for filing of TDS return, right? But it doesn't mean that the penalty was altogether removed from the statute books. No, it was still there. But the penalty was after a expiry of 1 year, from the due date of filing the return, right? Now, please appreciate that the date of filing or income tax return under section 139, now it has been gradually reduced only to 9 months. Earlier it used to be 2 years also, right? For original return or for revised return. Now it has been reduced to 9 months. So instead of 1 year, reducing it to 9 months, they have straightway reduced this time limit for levy of penalty to 1 month only. 1 month only. I believe it's a very, very, very harsh provision now, right? At least the reason you have given is that because of 139, a reduction of period of 139 from 1 to 9 months, there are a lot of issues in processing of your income tax return. So my humble suggestion is that instead of reducing it only for 1 month, it should be linked to 139 also, because you see, I have seen practically that while doing audit, we have seen that certain TDS which were supposed to be deducted or certain TCS which were supposed to be collected were not done so by the auditee. So on our recommendation, or maybe because of 3CD, now they have deducted the TDS and also filed their income tax, TDS returns, TCS returns. So it would be a very harsh provision on them, because in the month of September, now they have got to know that, okay, this TDS or TCS was supposed to be deducted in Q4. Now they are filing it. But the moment they are filing it, not only they are liable to pay late fee, now they are also liable to pay penalty also. They are also liable to pay penalty because 1 month period has already lapsed. 1 month period has already lapsed. So I believe this particular provision is a little harsh on the, and on the very pretext that you had introduced this late fee, now it is also there. It is similar kind of situation when STD was introduced, saying that, okay, we are exempting long-term capital gain on shares and introduced STD. Now STD is also there. Long-term capital gain is also there. Not only that, you have also increased the rate of long-term capital gain. So similarly, is the situation here also. You have introduced penalty, late fee of 200 rupees per day. And on top of that, I'm also liable to file my return within 1 month. If I don't do that, there would be a penalty. Ridhima said that there is an applicability. Let me check, Ridhima. I can check and get back to you on this, whether this is applicable from 1st of April or 1st of October. I believe I read it 1st of October only, but still, let me check that. No problem.
Because we have some
Maybe
similar query from the
I might have read it wrongly, but all the principle would remain same. Only the date might differ.
Yes.
No problem at all. I may be wrong. Anyway, so so this was what was the provision? Okay, just a sec. So the ambit of section 200A is also the title, I think, is incorrect, but the provision is correct that not only deductor, there may be a situation where other than deductors are also filing certain kind of statements. So provision under section 200A was not there to process these kind of returns also, but now they have introduced the applicable provision and it is applicable from 1st of April 2025. So again, time limit, you see earlier the time limit for default in SSC was 6 years for resident and 7 years for resident, and there was no time limit for non-residents. So now they have bring the parity between all the resident and non-resident, and also the time limit of issuing order is 6 years both for resident as well as for non-resident. And they have also introduced provision whereby through notification they can exempt somebody from the provision of TCS. So again, it's only when a particular notification issued, it should come into picture. Now, as far as late payment of TCS is concerned, if you look at section 2001 capital 1A, the provision is that in case of late payment, the rate of interest is 1.5%. In case of late deduction, the rate of interest is, in case of late payment is 1.5%, and in case of late deduction, it is 1%. So now again, they have bring the parity that in case of late payment of TCS is concerned, the rate of interest shall be 1%, not 1%, it shall be 1.5% only. Yes, it's a very, very, very interesting and very beneficial provisions for all the parents out there. There may be a situation where TCS has been collected in the name of minor, right? So now what they are saying is that that TCS can also be claimed by the parent and only in the name or in the hands of those parents where that income, that clubbing income of that child has been clubbed, right? So again, it's a very good and beneficial provision. Then 194J, 194C, again, they have introduced a clarificatory amendment in section 194C, whereby they have said that in case of the definition of work, that in case there are certain sums which are covered by 194J, there was a confusion there. So if a particular payment on account of work is covered by 194J, it won't be covered by 194C. It will still be covered by 194J, meaning the higher rate of TDS. So with this, all the changes are covered. Let me go through the point which you have raised, Ridhima. In the meantime, if there are any questions, I can also answer these questions. Give me 2 minutes in that case.
Sure. Deepak, yeah.
Yeah, you're right. It is from 1st of April 2025 rather than 1st of October 2025.
Yeah, so
I stand corrected.
this particular change for 194T is from 1st of April 25.
Right, correct.
Yeah, because we have one YouTube query which was saying that what if the partner
Okay,
resigned on 31st of October or 30th September?
No. So now I can answer that query in light of this change. So can you ask this query again?
Basically, the query was basically what if the partner resigned before the cutoff date of October? But in this case, now I don't think so there would be a problem, right?
Even if let's say it used to be, let's say if used to be 1st of October 2024, if the partner has already resigned, so on that particular date, whether it is 1st of October or whether it is 1st of April, if it is there is no partner, so there is no question of TDS. There is no question of TDS, because you see the amount which you are paying, it pertains to the amount, it pertains to the period when he was a partner. So we have to see that the amount which is being paid, it is pertaining to the period as a partner and which period, right? So let's say he's not a partner on 1st of April, obviously this provision at all is not applicable at all.
Right. And since we are talking about 194T only, do you think non-resident partners are also included?
Just a sec. It's a very good question. So the provision reads like this: any person being a firm responsible for paying any sum in the nature of partners. I believe it shall also be covered here also, because it doesn't say any
Non-partners would be
resident
covered.
partner. It shall also be covered.
Non-resident also?
Yes, yes. And obviously in that case, 195 shall not be applicable. 194
Absolutely.
shall be applicable.
Right.
Because 195 is a general provision, and then 194 is a specific provision.
Yeah, because otherwise, when partners' salaries were paid to your non-resident partners, there was no provision for the resident one, but 195 was always there.
Yes, yes.
So now it's all under the umbrella of
You see,
194.
it's a very simple provision. If there is a specific provision, it shall always prevail over the general provision.
Correct.
Because even in case of 195, there are certain payments where 195 is not applicable, even though it's a payment to non-residents. Say, for example, interest. There is a specific
Yeah.
provision for that.
But interest also, 194A did not cover partners'
No,
interest
no, it doesn't.
specifically.
It doesn't. Because it
So
is
now
not
everything is under one umbrella.
it is very much clarified. If you look at section 28, it very much clarified that these are the payment which are covered by business and profession, right? You see, salary is not a salary per se,
Correct.
right? There is no employer-employee, there is no employee-employer relationship between a partner and a firm. So that is why I'm saying it's a very, very, very interesting provision, 194T.
And I think it was required because there was no check on the source
Correct.
anyway.
Correct.
So it was very much required.
Though I believe 10% is on a harsher side.
Yeah.
It is on a harsher side, but still, let's take it on the positive side of it. Let's take my example. I'm also a partner in my firm. I also take a lot of salary from my firm, right? So till now, you see, my only source of income is from my partnership firm, right? So since till now, there is no TDS on that amount, I had to deposit advance tax from my own pocket, isn't it? And while depositing that advance tax, you see, as generally it so happens that I might have forgotten one installment of my advance tax, and I end up paying an interest to the department. So at least this is a beneficial provision for me. Look at the positive side also. So I know that, okay, I'm going to get X much amount of salary from the firm. So I can make a provision, or I can tell my firm that, okay, that much amount I'm going to take. And obviously that TDS is still lower as far as my liability is concerned. But at least that much of amount I can, save interest. Again, there can be a tax planning there also. Correct. So it's a positive side. There is a positive side to that also. But there may be a situation that you are earning income of only 6 lakh, 7 lakh from the partnership firm, and this is the only income. In that case, obviously, you have to either go for the refund or go for LDC. That
is with every TDS provision, rather.
Yes.
And one last question. What do you think why 194F was improved? What was the was removed? What was the rationale behind it?
194T?
FF. Which is for the repurchase of units by the mutual funds from the investors, from the unit holders.
I don't think any amendment in 194F.
I believe it is
194F.
Just one second.
It has been omitted, no?
Yeah.
Acha, omitted. Okay. Again, there is no explanation for this particular provision, if I'm not wrong, right?
Though it is not very prevalent also right now, so we can take it up later, not a problem.
No problem. Okay.
Great. So I think TDS and TCS is every budget favorite, because there has to be some changes always, and there is a clear
TDS
vision
is also
of
one of my favorite topic to speak on.
Mine too, actually mine too. So, but I think government has to rationalize it more, because there are close to 100 provisions when we come to TDS, TCS. There's so many. So I think they should rationalize it more with the coming changes in the Finance Act.
You see,
probably in the next year.
Only takeaway from the entire amendment is that even though you have reduced the
rates,
TDS rate, but 194T, it has a mixed response, right, from both sides, but needs a lot of clarifications, because when I'm taking something from my firm, it may not always in the nature of interest or so and so forth. Even partnership firm may give me a loan, right? So people may also try to justify certain amounts as a loan instead of it is being paid as a salary or so and so. And the another one is the time limit of penalty. It has been straightaway reduced from 1 year to 1 month. I
agree.
It's not a good move. At least you should have make it in equivalent to the section 139 limit of 9 months. Then we would have understood the issue there. But 1 month,
Correct.
it's not a good thing.
Great. The point taken, definitely. Thank you so much, Deepak, for this insightful session. And I think audience must have definitely benefited from it. Thank you so much.
Thank you. Thank you, everyone.
So now we move on to our 7th session of the day, and I hope everyone is as energetic as they were in the morning. So the session topic is changes proposed in assessment, appeals, and penalties, presented by Darshak Shah, partner at SN&Co. Darshak Shah is a chartered accountant and a partner at SN&Co Limit and leads the corporate tax advisory and business analytic practice. With experience at KPMG and Shah Associates, Darshak combines commercial and legal expertise in his work. His areas of specialization include corporate and HNI tax, litigation, international taxation, capital gains, personal taxation, business automation analytics, estate planning. Darshak regularly speaks and writes on tax matters across various platforms. He aims to transform over 100 SMEs into large corporations through strategic business analytics and structured data analysis. Hi, Darshak, how are you?
Hi, Riddhima. How are you doing?
All well, all well.
I don't know about others, but I'm seeing you are too energetic.
Thank you so much. Thanks a lot. Third session, so probably third time, so I'm probably now used to it.
Wonderful.
Thank you so much. So, Darshak, all over to you now for the assessment of fees and penalties.
Sure. Thank you very much. Just give me 1 second.
Sure.
Yes.
Yeah, it is visible.
Okay, great. Thank you, Riddhima. So to start with, of course, I would just share that today has been a wonderful day for me. The reason is, as we all are aware of, we have just crossed the date of Kargil anniversary, and I'm in a place where you are able to see some photographs behind, which is one of the locations where there have been a lot of activities going out in relation to Kargil for students. And I'm pleased to have that, and therefore a wonderful day which I had today for. And the second thing importantly is, of course, this marathon presentation which we are having today. So the task which has been given to me is assessments, appeals, and the topic is very connected to me. Like Deepak ji said, he is more connected to TDS. I'm more connected to litigation because I like litigation. I like litigation because there's always challenging and we get a lot of new ideas to find the solution for it. With this, we'll start this presentation. Basically, my presentation is going to be lasting for 45 minutes, wherein I'll be trying to cover this in 30 minutes. And of course, we'll be taking the question answer sessions after that. And the presentation, what I've tried to do is try to keep it in such a way that we are able to understand what is the core of the provision, and secondly, also to understand how is it going to be applicable to our day-to-day practice, right? With this short introduction, these are some of the points which are there in this presentation, which are related to assessments, appeals, right? Reassessment, first important element which has come up, and I'll take up that first. Reassessment, we all are aware of, it's always been a challenging topic, and there has been a lot of new changes which are going across regularly in the reassessment. Third phase of changes which have been introduced. How far to understand what literally the changes are, and finally I understood, okay, the changes are not that particular complicated. The changes are somewhere certain things which was not there earlier. So reassessment, as we are aware of, September 24 is the date when it is going to be applicable, and before that we are going to see a lot of notices which are going to be issued in this span of time, because every time when this changes happens, there has been a flow of notices which comes from different sites to different clients. Yeah, so the shall be issued only when the officer has information of escapement. So that's number one condition. Survey. So survey is basically, other than TDS survey, is now been included as a part of information. So any information which you receive at the time of conducting a survey, so that is also going to be included as a part of information which was not there earlier. Now, 3 steps important in the amendment which we need to remember. Reopening. What is he supposed to do? Number one is he has to first check whether the reopening has happened under section 135A or not. So basically, if the information is pertaining to section 135A, then the reopening is going to be directly under section 148, right? Just to pause for a second, I hope everybody is able to listen to me properly. Riddhima, are you able to hear me properly? Hello. Is anybody can just give a response whether
yes, sir, you are audible. Yes, sir, you are audible.
Okay, great. So the first steps which one need to understand is basically whether in the information which is available with the officer is not required. Which is available with the officer is other than section 135A. Then, of course, the officer will have to pass through the process of 148A. And of course, later on, he will have to understand and agree to the point that, okay, this is a fit case for reopening. And for that, he will also have to procedure. But if the information is other than 135A, then the person has to pass, the officer has to pass through the procedure of section 148A. So that's one thing which needs to be remembered. Under both the situations, under 148, he needs to take an approval. Even under 148A, while he is passing an order, he has to take an approval of the authority. Authority discussing which are the authorities which they are referring to. The next slide talks about what is the changes. So just get the summary of it. Some people can snap of it so that they understand changes. Now the changes over here are first explanation, which was explaining what is deemed information. So something which was related to survey matter, search matters, etc. So those informations which was deemed to be an information, they have done away with because they have brought a specific amendment which is for block assessment, and therefore they have done away with from this particular part, and they have only included survey. So survey information is already, as I said, is included as a part of the information. Balance is something which they have removed from the explanation. That explanation is out from. What is the second change? Basically, period to reply was 30 days, which is now not there. So they are going to come out with specific notification on what should be the time limit. But yes, earlier it was from 7 days to 30 days, which has now not been there in the BEAR provision. What is the third point? The third is basically there should be an information along with section 148. Now, information along with evidences, that's not something which is specified, but yes, the information should be available is what has been mentioned in the BEAR Act along with the note under section 148A. Right? Time limit to pass an order, 1 month is removed. So basically there was 1 month time limit window which was provided, that has been removed. Issue of notice under 148 does not gain required approvals once 148A is. So prior to it, what happened is they were under the dilemma whether there should be 2 approvals, 2 time and approval is required under 148A, and then while issuing a notice under 148, they have clarified and they have done away with, rationalize it by saying that once you have taken approval under 148A for passing an order, you don't need to again get an approval under 148. Now, when I say you means, so it's not required to take 2 approvals. In two situations where information or evidence suggests that the income escape exceeds 50 lakhs, 5 years or 3 years. So basically, the period is basically has been reduced to 5 years from 10 years, which we all are aware of, that the time limit has got reduced. What is the other change? The change is, earlier, what was happening is very limited time which was provided for the assessee to explain that why the matter should not be reopened. But now they have said that there should be a window of 3 months. Within the span of 3 months, there should be a proper communication and inquiry which should be run across to identify whether this reopening is required or not required. So that 3 months window is now been provided under the law, and that's been brought it out. So that's a welcome step. Now, let's understand, not a part of an amendment, but what is the change? The change which has happened is, till now, earlier we were always always debating whether the officer is having reasons to believe, right? That's what always we were dealing with. Now that terminology has got changed. So now it is not necessarily a reasons to believe. What is important is that he should be having information which suggests, mind you, the word is suggest, information which suggests there is an escapement of income, right? Now that's one C change which has happened, reasons to believe, and now it is information which suggests that there is an escapement of income. So that's one important element which has got shifted from the previous, which is going to fact some officer to have a reasons to believe. Now what is important is he should have the information. That's what the change is. Now, change of opinion is still prevailing. So that's one thing which we should keep a note of, that if there is only because of the change of opinion, there is a reopening happening, still we can take a particular stand based on series of cases where we say that change of opinion should not lead to reassessment. This we have already discussed, but I'll just give you a very short snap of it, which is saying that in case if suppose the matter is normal cases, which is normal cases means below 50 lakh of escapement, then in that case it is 3 years and 5 years. And if it is specified cases, then it is 5 years basically, which was earlier 10 years. So now that has got reduced to 5 years, right? So that's one change which we need to keep in mind, right? Now, officers, earlier the permissions were supposed to be taken from the higher authorities, which is commissioner, principal commissioner, etc. Now they have got done away with. They have said that you have to take an approval. You means, again, I'm saying assessing officer. He is supposed to take the approval of additional commissioner and joint commissioner. And in case if it is the other part of the cell, then it is additional director or joint director. So that's where he is supposed to take the approval about. Yeah, now we remembered a situation which arose in 2021 amendment, where basically after the amendment, there was a certain span of time where there was a gap like we are having now. From July 24 till September 24, when it is going to be applicable, there is going to be a gap. So in this particular gap, which particular law will apply? So they have made it very clear over here that the law which is currently going on, that is pre-budget, the law is going on, that law will prevail till August 31st. From 1st September, the new law will be prevailing. So now, therefore, it becomes very important for us to understand that which particular year can be reopened and which particular year cannot be reopened. So don't worry, I have prepared a snapshot of it, which will give us a complete idea about or a ready reckoner for you to understand that which one will prevail and which one will not prevail, right? We go to that particular point. So this is a snapshot. You can take a snap of it, which basically says assessment years wise before 31st of August. Okay. Before 31st of August, where the income is less than 50 lakhs, the escapement amount I'm talking about. If it is less than 50 lakhs, then these are the dates under which the assessment can be reopened. If the amount is above 50 lakhs, but before September, which is, if that is the case, then these are the dates which will prevail. And if the amount is above 50 lakhs, but after September, then these are the dates which will prevail. So this broadly gives an idea or a snapshot about which year what assessment can be reopened and which year the assessment cannot be reopened. That's the summary and the snapshot which one can take a note of and take a use of it. Now, if I just give you an idea about it, for previously, if you go before 2021, the law was 4 years and 6 years. We have been running across our practice since many years, right? Where the point was 4 years and 6 years. 2021 made a change wherein it reduced 3 years, it made a period of 3 years and 10 years, right? So that was a change. Now the law is from September, 3 years and 5 years. So how is that going to play a role is what something I have described over here, and you can take a note of it, right? Moving to the next point, block assessment. Yes. Now what happened is previously we were under block practice. Later on, it got moved, it shifted from a block practice to reopening practice. So we must have come across a lot of inquiries which were related from the investigation wing, where they were asking certain transactions. They wanted to understand certain transactions, more importantly from the demonetization era. From demonetization, bogus purchases, etc., etc., etc. There has been a lot of inquiry which we have come across from the departments, from the investigation department, mainly in relation to what is this information all about. Now, after having understood it, in case if they wanted to reopen the matter, then they had to make a report and submit it to the jurisdictional cell, mainly to get this particular matter reopened. Now, as a result of that, what happened is there were multiple years which were getting reopened. It was not 1 year which was getting reopened. Multiple years were getting reopened, and that was increasing a litigation at the year-on-year basis, right? Now, because once the matter is reopened, the matter is open. Now, when the matter is open, everything is open, and every year are open. So you need to deal with every year separately. So that was leading to a increase in the litigation part. So therefore, what they brought again is they reintroduced the concept of block assessment, which was even earlier there. Now, some features of block assessment broadly tries to say, what is it saying? So block period, previously also it was the year in which the search has been conducted. So that is the year, and the previous 6 years. So for example, if we are talking about today, and today if there is a raid which is going to happen, in that particular case, today, so this particular period from April to July, previous 6 years is what is going to be clubbed for the block assessment. So that's number one. Any pending assessments. So if the matters are pending and if they have not concluded, then those matters will be abated. So they will be not considered to be continued, and it will be clubbed with this particular block assessment. What's the next point? The next point is 60 days. So within 60 days, we are supposed to file the return. And one important thing which they have brought out over here is that if you are not filing the return within 60 days, there's an introduction of imprisonment, which is from 3 months to somewhere around 3 years with a particular fine. So that is a criminal matter which is introduced if the returns is not filed on time. Now, what is going to be assessed? So what are the powers which is available with the assessing officer in conducting such block assessment? So what he can assess? So number one, what he can assess is the return which we have filed. I'm going to compare it for the sake of easy understanding with the reopening part. So generally in reopening, what happens? First, the notice is received, right? Once the notice is received, we file a return, right? Once the return is filed, the matter gets open for the assessing officer to evaluate completely, right? Once that is done, he is able to assess the income. So the assessment of income is from the return perspective and from the openness of the matter perspective. So whatever he finds it right to be assessed, he will assess that. I'm just now bringing back to the concept of block assessment. Under block assessment, what it says? A, the return which you are going to file. So once the search is conducted, and if you are going to go back and declare certain income, then that is one the power which is to assess that particular income. Number one. Number two, the matters which are already concluded under section 143 to 53C. So any matters which has been concluded will be considered, that is second thing which he can assess as a power. Number 3, what he can assess is basically incomes which were originally declared. So of course, that is also part of power to assess, because now he's going to do a consolidated block assessment. So therefore, that's number 3. That's very natural. Number 4, what is he going to be able to do is basically, if he's able to, while a search was conducted, if he's coming across certain amount, so and that also something which is included, of course, as a part of power for assessment. And the last one is undisclosed income. So any income which is not disclosed is the last one which is going to be added. Now, let me take the example of how the tax computation is going to function over here. Now, let's say the assessee files a return of 65 lakhs, on which assessment was completed with 5 lakh increase, okay, to 70 lakhs. And after search, return under 158 BC was filed, which was totaling to 75 lakhs, let's say. So 5 lakh is an increment which was declared, let's say, as an example. But after assessment of search, EO found undisclosed income of 55 lakh over and above 75 lakh, which is already declared. Okay, then that particular amount will also going to be added, right? So that's going to be the total amount of income which is available as a disclosure. Now, on that 60%. Okay. So basically, that is going to be undisclosed income. On undisclosed income, that's going to be 60% tax, and then balance on the penalty. Okay, penalty, there is going to be, what is it been saying is that if suppose you are not disclosing the income, okay, if you have not disclosed the income, then in the return also. So let's say you got a last chance of declaring the income after search under 158 BC. So if under 158 BC return which you are filing, if you are disclosing or declaring the income, on that penalty will not be levied. But if you are not disclosing the income, or if you are not declaring the income, and then later on as a part of assessment that income has been identified, then there is going to be a penalty of 50% on that particular amount. So that's something which is important to note. Yes, now going to the next para. The next para is trying to put about rationalizations of powers of CIT appeal. Right. So now what was happening is, because of the technical assessments, because of faceless assessment, there had been a lot of cases where the matters have not been heard. Okay, so best judgment assessments have become a very frequent part of the practice, where a lot of matters have come across under best judgment assessment. And once that has been best judgment assessment orders have been passed, the matter goes to CIT appeal. But before CIT appeal, once everything is filed as an additional evidence, CIT appeal is not able to review all those informations which was supposed to be filed before the assessing officer. So now what he will do, he will basically consider this matters. Now, till before the amendment, what was happening is, before the amendment, CIT appeal did not have an option to review it, everything. So he used to pass everything to the additional commissioner, to the assessing officer. He will prepare a remand report. Once the remand report is prepared, again it will come to the CIT, and CIT will take the decision. That's the practice which was there. Now the change which they have done is, like we have a before tribunal. So under tribunal, the powers of the tribunal is to set aside the matter, right, or to completely cancel the matter. So here also the commissioner also has now the power that these matters will be set aside to the assessing officer. Assessing officer will do a fresh assessment, and those fresh assessment will again be considered as a part of the final assessment. So that's something which has been included, number one. Couple of things which one need to note it out over here is, first is this power is not with the joint commissioner CIT appeal. It is only with the commissioner CIT appeal. So that's one thing which we need to keep a note of. That's number one. Number two is basically the assessing officer who is getting a fresh assessment order time to do it. He is supposed to do it in a span of I think it's 9 months. In 9 months, he's supposed to complete the order, right? So that's one thing which needs to be kept in mind. The next thing is tribunal appeals. So earlier we had 60 days. So now it has been increased by saying that, okay, it's not now 60 from day to day, but it is from month to month. So let's in on this month, we are on 20, we are in the month of July. So now if we receive the order today, so we are on 27th July. If we receive the order today, then end of the month, and from end of the month, 2 months. Earlier it was 27. If we are on 27, then it was 60 days from 27, which was supposed to be calculated. Now it is end of the month, and from that 2 months to be calculated. But yes, one thing to be noted over here is it talks about this is applicable from 1st of October 2020. So now what is important? Because let's say an order is already received, right? And the CIT appeal order is already received. Let's say somewhere in the 3rd of August. Okay. Now that order is received, but that order is not getting complete. The time limit, which is going to be 2 months, is from where? It is going to be from 1st October, the order which are getting passed, or it is from now. Now that's something which one needs to keep in mind. Conservatively, it's always better if we consider it from 1st October, because then we are not getting into that particular trap of days. But yes, the amendment is talking is from 1st October. So from 1st October onwards, it is going to be 2 months. What I mean is basically if the order is passed before 1st October, whether it should be 2 months or 60 days, and when the order is passed post 1st October, what is the point? The post 1st October, it is 2 months, right? Pre 1st October, whether it should be 60 days, we consider 60, and then we can go for 2 months. That's what I would suggest. VVD scheme, again, a lot of matters were taken up under VVD. A lot of things got completed under VVD. So therefore, they have reintroduced this particular scheme. Largely remains the same, no major deviation which we are able to see. But yes, I would just highlight that they have as a 2 phase. The first phase was something which was there till 31st of January 2020, right? When the first VVD, I mean to say the VVD which was there prior to this. So that VVD is basically where if you are still having a matter which is filed an appeal, you didn't choose to make an VVD, you didn't choose the VVD scheme at that point of time. And now if you want to choose the VVD scheme, you can still do it. The only thing is previous to now there is going to be 10% more tax which you are going to pay as compared to the previous one. So that's one thing. The second thing is basically if the matters which are pending now, okay, the appeals are filed post January 20 until 22nd of July, those matters will be 100%. And if it is paid post January, so January 2025, so December 24 के बाद अगर हम pay कर रहे, then that is 10% top up, right? So that's the broader scheme talking about. Again, penalty, more or less, it's the same thing. So I'm not just moving forward from this. What is important, which we analyzed while we were having the last scheme, is basically when the taxes were already paid. Now what happens? So that is of course available for refund if there is an FAQ which allowed to do that. There were losses. The losses, you had 2 options. Option 1 is you forgot the loss later on, or the second option is you pay off the tax today and then claim the loss. So if you have already claimed the loss in the subsequent year, then the option available is you pay off the taxes in current year. Or the second alternative was you don't pay off the tax, but you forgot the loss. So that's option which is available as per the FAQ, and that you can continue to have is what I believe. Of course, unless there is a new FAQ is talking something differently, which we are waiting for. But until now, the last FAQ, if we talk about the last FAQ, then that's the reference point where the loss was treated accordingly. Yes. So basically, VVD will not apply in certain cases that we are search cases, etc. There it won't apply. The orders which are passed and not appealed as on 22nd July, but the time limit to file appeal have not expired. So basically, this was a question before FAQ that if let's say today, okay, on 22nd of July, there is still a time limit available, and let's say 27th is the July when it's the last date for you to file an appeal, whether still you will be available for VVD. This question was there before FAQ in the last FAQ, and this was considered to be allowed. So I'm just proposing that, I'm just referring to that particular thing. Now, the next is basically interest paid. So if you have already paid the interest, whether it will be refunded, answer is yes. If there is any matter which is subject matter of rectification, so whether finally when you are determining the tax, whether the rectification will be considered, answer is yes, it will be considered. Appeal accepted. So let's say whether I have not filed an appeal. Okay. My time limit has also lapsed. Now there's a condonation, and that condonation is accepted. Okay. Now what happens? So while I was searching for it, I came across one case which is of Supreme Court, which is of 1998, where they said, because previously also somewhere in 1998 there was one VVD scheme, and their similar issue had come across before Supreme Court. Then Supreme Court said that yes, if the condonation is getting accepted and there is a due reason because of which the matter was not filed, then that was considered to have been accepted at that particular point of time, and it was considered that it should be eligible for VVD. So I'm just taking that as a reference point and maybe putting up on table that if a matter is not the matter is still not under appeal. Now, if you want to go for an appeal and make a condonation application, okay, and try to get this particular benefit of VVD, whether that is available, one can try to have that and take a reference point of the Supreme Court decision. Of course, I am not the decision authority. Of course, it is going to be the department who will take the decision. But yes, the of Supreme Court of 1998 is available, which can be considered for this particular matter, right? Yes, I think this is one particular snapshot. If members who are participating over here, they can always be, because this is one group which is run by a lot of chartered accountants. There are around 1,000 chartered accountants who are participating in this group, and everybody are part of this particular group where we raise question answers to each other and we take the benefit of the knowledge which everybody has. So if anybody wants to participate as a part of this particular WhatsApp group, they can scan it across and become a part of this particular group. Yes, now moving on to the next is basically penalties. I think the previous speaker has spoken something about penalties. I'll be also brushing upon what has been there. So basically till now, there was always a problem with the non-residents where they didn't wanted to, the non-residents and now who have become residents or who are now the resident but are having the foreign assets, and they were not remembering all disclosure, or they didn't wanted to disclose everything. So there is a leverage which is there to the extent of 20 lakhs rupees. In case if there is no disclosure, there is not going to be any penalty. But if it is beyond that, then of course there is a penalty which we are aware of. TDS provisions, basically, I think the previous speaker have already spoken about it. So I'll just moving forward. Rationalization of period for imposition of penalties. So earlier 6 months, that's an administrative factor wherein 6 months still continues, but it is not only once the order is received by the commissioner. I remembered while this thing came up, we had one matter where the penalty was levied 6 months after the date the order was received. So this date of receipt of the order by the principal chief commissioner, which was very important, because we could take that as a ground, as a technical ground, and for that particular matter, saying that it is beyond 6 months from the date which was received by the principal chief commissioner. So therefore now they have done away with, they said that once the order is received. Now once the order is received means it's available. So once it is available from that particular day, 6 months will be calculated, right? Basically, relaxation from prosecution. So basically, if the TDS payments have got delayed, but if you're getting it filed before the return is filed, in that particular case, this will be immunity from the prosecution provisions. So if you have not been able to file, or you have not paid the TDS amount, but if you're getting it paid before the due date of return or TDS return filing, then in that particular case, you will be immune from the prosecution. I think I'm done. Dot at 4 o'clock. I have completed the presentation. I'm now opening this particular forum for question answers. Not Riddhima not asking questions, but others asking questions.
Yeah, that's actually right. Anyone, please drop in your queries in the chat box. And if you're streaming through other live platforms, please drop in your queries on the comment box.
Please go ahead, Riddhima. I was just being on a lighter note.
No, definitely, because I have few queries already curated, but otherwise I'm just waiting for others to come up with.
Please go ahead.
Okay, so while we get some queries, so there was this one particular thing which we were discussing about Section 135A. What is the process to issue the notice, and who would be the authority to approve the issue of notice?
So basically, if there is an information which is coming under 135A, okay, then it is going to be passed through, this is going to be passing through the procedure under 148. So then there is no need to go for 148A procedure. There's only directly going to be 148 procedure. 148, not 148A. Right. However, the approval authorities are going to be the same, additional commissioner and the joint commissioner. So that's going to remain the same.
Okay.
So they have done away with the approval to be taken from commissioner, principal commissioner. They have done away with that. Maybe one of the reason could be they are too busy with a lot of things available. So therefore, to complete it within the span of 3 months would have been difficult for them. So administratively, they have rationalized this.
Makes sense. And in this respect only, does it appear that there is no provision for recording of the reason of the issuing of the notice now?
Can you please repeat the question? I'm sorry.
So can we say there is no provision to record the reason to issue the notice now?
No. So basically, okay, let me clarify this point. The point is that along with the notice, which is getting issued under 148A, okay, there is going to be accompanied with the information. So without information, there will not be 148A as per the law. Practically, we all are aware of. But yeah, as per the law, those informations will have to be provided. So it's not that it won't be provided.
Noted. Perfect.
That's very clearly mentioned in the Barrett itself.
Right. None. And I think most of them are just again asking for that QR for this group which you shared.
Should I do that?
Yeah, if you can do that again.
Okay, I'll do that. Just give me 1 second. Yes.
Perfect. Then, so any other query, if it's unanswered, please confirm. Okay, so we got one from the YouTube. So the appeal is decided at the CIT level, but at the time of the appeal, with tribunal has lapsed, such as SC, whether can be applied for VVD scheme?
Where can I see this question? Can you just help me to see this question?
So this is on YouTube.
Okay, so can you please
let me
repeat
just
the
drop
question?
it in the comment box for you.
Yes.
Yeah.
So I think Rajesh has asked the question, if the appeal is decided at CIT appeal level, but the time to appeal with the tribunal has lapsed, but assessee whether can apply for VVD. Rajesh, I answered this question. I'll repeat that question answer. Basically, if you see pure technical, okay, the act is not permitting, because they have been very clearly mentioning all the open matters which are till the date 22nd of July. However, I referred to one Supreme Court matter which is of 1998, where they said that if there is a condonation which is filed and the condonation is having a valid reason, and if because of that reason, if the condonation is accepted, then you can go for VVD. So that is how they have asked us to choose the VVD. So that's the reference point which you can take of Supreme Court 1998, and then you can try your luck. I think that's what I can say.
Perfect. Thank you so much, Darshak. I think this is actually one of those topics which is very critical and crucial, and you did a great job condensing all the information. Thank you so much.
Thank you very much. Thank you, and most welcome to the next speaker.
Great. Thanks a lot.
We are seeing a marathon happening.
Right. So just
wonderful. Can I
thank you
just
so
take
much.
20 seconds more?
Yeah, please.
I'll just take one thing to acknowledge for taxmen. I am seeing the way Taxman is contributing in the terms of the benefit for members, the kind of efforts, really I'm saying, the kind of efforts you guys are spending on coordinating with speakers, ensuring the right topics selected, and also ensuring that the way it is getting conducted so that us or the participants are getting benefited out of it. It's absolutely a wonderful job which you guys are doing. Thank you very much. And thanks for everybody.
That's very sweet of you to acknowledge it. Thank you so much.
Really are doing good job.
Thanks.
Ciao. Bye-bye. Thank you very much.
Bye. Thanks a
Over
lot.
to you. Over to the next speaker.
Thanks, Darshak.
So, as we were all talking, so India's growth is reflected in the progress of its startup. And as innovation is one of the 9 priorities, startup have been always a key focus. So to shed light on the recent changes in income tax for startups and M&A taxation, we present session 8 with Sanjeev Jhunjhunwala, partner at Nangia Anderson and LLP. Sandeep leads the corporate and M&A tax practices in Nangia Anderson, India, and the firm's emerging law practice. With over 16 years of experience at Big Four accounting firms, he specializes in corporate international tax, strategic transaction advisory, cross-border tax structuring, and controversy management. He represents the India firms in Anderson Industry Group for technology and real estate, and also manages USA, UK, and Ireland corridor relationships. Sandeep collaborates with regulators and policymakers on new regulations and their effectiveness, and has extensive experience advising multinational companies in various sectors. It's great to have you here with us, Sandeep. I request you to take the session forward.
Thank you. Ridhima, would the Taxman team be presenting the slides, or can I put it up directly?
I suggest you can share it, and then we can also do if you say so. Whatever you're comfortable
That's fine.
with.
I'm okay with that. Is my screen visible?
Yes, it is.
Sure. Okay. Very good evening to all the participants. In this part of the budget marathon, we are going to discuss about the implications of some of the announcements that have been made by the government as it relates to M&A transactions and deals. So I'll be very focused on only those aspects of the amendments which are relatable to M&A as well as to the deal transactions. And broadly speaking, there are 5 such areas which are going to get impacted. 5 such areas which are going to impact the M&A as well as the deal space. The first one is about buyback, and we will discuss about each one of these in greater detail. The second one is on angel tax abolishment, which was the ask of the industry for a very long time. The third one is in terms of gifting of any assets, including the gifting of shares. The fourth leads to OFS transaction, a very, very important clarification, which is going to, impact a lot of private equity investors or the early age investors who have offloaded their securities in, during the OFS phase just prior to the IPO. And the last one is on capital gains. I'll just touch it a bit only to the extent it concerns the M&A and the deal market, because I'm assuming there were 2 separate sessions on capital gains for financial as well as non-financial assets, and maybe a broader part of this discussion would have already got covered there, but still to the extent it is relevant for this, I will cover it on the subsequent discussions. Now, coming to the first point on buyback dynamics, again, one of those headline kind of announcement that came in the budget this year, where they have now made buyback taxable in the hands of the shareholder, which erstwhile was taxed in the hands of the company itself. And this is the first time probably in the history of the country where the income and the cost will be lying in 2 separate pools. And, shareholder may technically not be able to utilize the cost of acquisition of shares at the time of discharging the capital gains tax liability or, a dividend liability. So just to go back a little bit in the history to talk about the buyback taxation, how it emerged. I think buyback taxation and dividend taxation both have, been quite fluidic, and a lot of changes have happened over a period of history. So it was the buyback tax was first introduced by way of Finance Act 1999. There was an exclusion given to the definition of dividend under Section 222(4), and 46A was introduced to tax buyback proceeds as deemed capital gains. Subsequently, the Finance Act 2013 introduced 115 QA and made buyback of unlisted shares taxable in the hands of the company at the rate of 20% plus applicable surcharge and cess. And subsequent to this, listed shares were also brought within the ambit of 115 QA itself. Now, what this budget proposes to do is, it proposes to include a separate entry under the definition of dividend under the entry 222F, and the buyback tax regime under section 115 QA has been made ineffective. So technically, what it means is that the entire buyback proceeds will now be taxable in the hands of the shareholders at the slab rate or at the normal rate which is applicable. And as far as capital gains is concerned, there will be a capital loss which will be arising to the shareholder, which is nothing but the cost of acquisition. So the cost of acquisition will turn into capital loss because the deemed value of consideration will be seen as nil. And then subsequently, the cost of acquisition being zero, you will result into a capital loss kind of scenario, which is offsettable in the future against any capital gains tax liability. So depending on the period of holding, if you have a short-term capital loss, then you can set it off against long-term capital gain as well as short-term capital gain. And if you have a long-term capital loss, which is arising on account of buyback of transaction, then the same will be offsettable against only long-term capital gains. So this is how the provisions read. I mean, we are all aware of the kind of buybacks that have happened on the listed space in the last couple of years. Have tried giving some statistics on the presentation itself, where we have spoken about some of the buybacks, the companies which were in the press or in the media for the top 5 buybacks of 2023. So the a lot of cash reserves which were accumulated by the company during the COVID time, and a lot of these companies actually decided to buy back the shares in the previous years. So now few things that emerge as points that we need to discuss is about the capital loss, which cannot be carried forward indefinitely. So we will have 8 assessment years, and this capital loss will become a sunk cost. We are going to discuss this by way of examples as well. This becomes a sunk cost if there is no subsequent capital gains that arises in the subsequent years to offset the capital loss, or if there is a non-resident shareholder who is availing exemption under DTAA on any other secondary sale that happens subsequently, then in all such cases, this capital loss that arises will become a sunk cost. Now, how does TDS work in this case? So the Indian company which is proposing to do a buyback will have to do TDS under section 194 if the buyback proceeds are flowing to a resident shareholder. Whereas if the proceeds are flowing into a non-resident shareholder, then the company needs to do a TDS under 195. Now, what does that mean in terms of withholding tax obligation for the Indian company? The Indian company will need to have requisite documentation. So for instance, if there's a non-resident shareholder, then the company needs to obtain the electronic form 10F, TRC, no PE declaration. There will be a 15 CA-CB that can come into picture. So this is going to increase the compliance burden on the Indian company on the withholding tax side, be it remittance of the buyback proceeds to the resident shareholder or to the non-resident shareholder. Now, few things that comes up are whether this regime of buyback tax applying to the shareholders itself instead of the company, will it apply in the case of redemption of preference shares, or the earlier regime of 115 QA will continue to apply in the case of redemption of preference shares and also in the case of NCLT sanctioned buybacks. Now, if we look at the definition, the way the definition of 222F, the way it reads, it says any payment by a company on purchase of its own shares from a shareholder in accordance with the provisions of section 68 of the Companies Act. Now, redemption of preference share doesn't fall within section 68. It technically falls within section 55 of the Companies Act. And therefore, one can take a view that this regime will not apply, and 115 QA could probably continue to apply in the case of redemption of preference shares. The second point is on NCLT sanctioned buybacks. Now, the way section 230 subclause 10 of Companies Act read, it says that no buyback of securities shall be sanctioned unless such buyback is in accordance with the provisions of section 68 of the Companies Act. So in some sense, it gives reference to section 68 which also finds a mention in section 222F, which is the new proposed amendment. So technically, one can take a view that in the case of NCLT sanctioned buybacks, the new regime can probably continue to apply. Now let's look at how this buyback dynamic will work in the case of non-resident shareholders as well as resident shareholders. So let's first look at how it will work under the domestic tax regime. So for non-residents, we have section 115A, which will apply for taxing their dividends. The rate of dividend is 20% plus applicable surcharge and cess, and they will have a capital loss claim arising out of the buyback that they receive from the company. Now, one question that arises is 115A gives exemption to the non-residents to file a return in India if there are certain streams of income, say for instance, dividend, fees for technical services, royalty. If the non-resident only has those streams of income and the tax on that has been duly discharged as per the provisions of the domestic income tax law, then there is no requirement to file a return of income in India. But the question here is that while buyback is getting taxed as dividends in the hands of the shareholders, there is also a corresponding capital loss, which is there with the shareholder, which the shareholder has to utilize in the future against any capital gains tax liability. So the question that arises is that is there a requirement to file the return of income to ensure that the carry forward of those capital losses is not impacted? Now that's something that is not quite clear. We will have to wait and see how the law evolves and if there is any clarification which is issued by the regulators. The second question also is that is there a requirement to file the return till the time that those carry forward losses are utilized subsequently in the future? So I have a year one in which the capital losses arise and I have filed a return, and I could have a year 5 in which I am actually able to utilize those capital losses. So do I need to file the returns from year 1 to year 5, or do I need to file the return showing capital losses only in year 1? Now that is also one question that's not quite clear, and we'll have to wait and see how the law evolves over a period of time. Another important aspect from a non-resident shareholder is about FTC. Now, all this while, since 115 QA was a tax which was paid by the company, non-resident shareholders were not able to utilize the foreign tax credit on this. Now, with the tax now flowing to the non-resident shareholders itself, now such non-resident shareholders will now be eligible to claim a foreign tax credit as per the as per the treaty, as well as some of the guidelines which are given by the laws of the domestic country. So this is on the filings as well as the implications that could arise under the Income Tax Act. Now, a very important thing that comes up is in the case of non-residents is also about the tax treaties. Now, how are treaties going to characterize this income? Are they going to characterize this income as a dividend or as a capital gain is a question that one needs to evaluate. Now, technically, in my personal view, I think a capital gain section is more specific and not a dividend. Though the Indian income tax law is trying to tax this as a dividend, I would still believe that the income under this is arising only on account of alienation of shares, and therefore the non-resident could still explore some exemption which is available under the treaty. Say, for instance, in the case of any treaty coming from India Mauritius or India Singapore tax treaties where there is a specific exemption for shareholding before 1st of April 2017, I think those positions needs to be explored. Also in the case of, say, India Netherlands, I think non-residents will have to evaluate this position. Now, as far as dividend is concerned, in the case of dividends as well, the treaties, the treaty provides for tax rate which could actually range from 5% to 20%. We have treaties like Mauritius, Malaysia, Hong Kong, which taxes such dividends at the rate of 5%. We have treaties where the tax rate is 10%. And then we have treaties where the tax rate is 20%. Now, this 20% could still be beneficial because under 115A, the rate of tax is 20% plus applicable surcharge and cess. So therefore, treaty benefit, even in the case of dividend position, could still be better as compared to what it will be under capital gains, where there could be a complete exemption which is available to the non-resident shareholders. Now, this evaluation between the characterization of an income as a dividend or a capital gains becomes very important. And that's something that the non-resident shareholders will have to evaluate. Also, the point that there may be a requirement to file a return of income in India if the non-resident decides to offer this income to tax under the DTAA beneficial provisions, because in that case, the exemption which is provided under 115A will not come to rescue for the non-residents, because the condition there is twin, that one of the conditions there is that the income should have suffered tax under the domestic tax rates and not under the treaty rates. So this evaluations become very, very important. The characterization of income between a dividend vis-a-vis a capital gains, I think that is the first point of evaluation that non-residents will have to do, and then possibly after that, which is a better rate to apply in the case of the DTAA between dividends or between the rate which is given for the capital gains. Now, as far as resident shareholders are concerned, obviously this will lead to a higher tax incidence, because earlier under 115 QA regime, this was getting taxed at the rate of 20% plus applicable surcharge and cess. But now, since the incidence is passing on to the shareholders, it will be under the slab rates, and therefore technically it could attract taxes up to 30% plus applicable surcharge and cess. And capital loss will be available to the shareholders, as we had already discussed. Now let's quickly look at some of the examples, to understand this provision a little more in detail. Let's see how this was working pre-amendment and how it will work post-amendment. So for instance, there's a company where the accumulated reserves and surplus was 250 rupees. The cost of acquisition of shares was 100, and the distributed income therefore is 250 minus 100, which is 150. So therefore, under the 115 QA regime, the gross up tax on 150 rupees will work out to be 28.34 in terms of absolute number. And the balance which will be available for distribution to the shareholders on buyback will be 250 minus 28.34, which is 221.66. So therefore, technically the tax which applies pre-amendment is 28.34. Now let's look at how it will work post-amendment. Post-amendment, same example, same numbers. Accumulated reserves is 250, cost of acquisition is 100. This QA section will not apply, because the regime now requires the shareholders to pay tax. And therefore, if there is a resident individual, then the maximum tax rate could be 35.88%, which is inclusive of surcharge and cess. And therefore, the tax becomes 89.7 crore. In the case of NRI, again 115A comes to picture, and the tax rate could be around 59.8 crore. In the case of a domestic shareholder, domestic corporate shareholder, which is a company or a LLP, depending on that, or a foreign company, the tax outflow could be 62.92 crore or 87.36 or 95.55. So technically what we are trying to showcase here is that the tax under the previous regime, which was capped at 20%, is now probably flowing back to the shareholders and getting taxed at a much higher rate. Now, two important questions that come up is that whether this amendment is intended to bring parity in the tax treatment for dividend and buyback. The answer is not quite clear, because 222F doesn't restrict the payment only up to the extent of accumulated profits being seen as dividend. It says that any payment which is made by the company without any limitation will qualify as dividend. The second question is also, is it intended to bring a parity with tax on capital reduction? I think there again, the answer is quite, the answer could be no, because in this case, the entire buyback proceed is treated as dividend, and the original cost of share is allowed as a capital loss. So technically, this is not also bringing the arrangement in par with a capital reduction transaction. Now let's look at the bigger picture and see how this will work in the case of a group company where a subsidiary company buybacks the shares from a holdco. So assume there's a case of a partial buyback, which is the way it operates in the case of the provisions of the Companies Act as well. Assume that the accumulated reserves are 250, the cost of acquisition is 100, the distributed income is 150. Similar to the example that we discussed earlier, 115 QA will tax it at 20% plus applicable surcharge and cess, which will result in a tax of 28.34. Now, assume that there is another secondary sale transaction by the holdco, and assume that the sale consideration for that is 800, and the company, when it initially invested, the holdco, when it initially invested the shares into the subco, the cost of acquisition was 500. Indexed cost of acquisition will then make it 572, and the long-term capital gains will be 227. And the tax on that will be 20 plus applicable surcharge and cess, which will be 52 rupees. So technically, the tax at the group level is 28 plus 52, which is 80.38. Now, under the new regime, which is post-amendment, all things being constant, which is in terms of your sale consideration, the biggest impact is on account of no indexation, which is 572 becoming 500 here. And the only advantage is the offset of long-term capital gains of long-term capital loss of 100, which is nothing but the initial cost of acquisition. The taxable LTCG is 200 in this case, and therefore the tax is 28.6. The total tax at the group level is 62.92 plus 28.6, which is 91. So technically what we see is that at a group level, the tax under the proposed amendment is higher as compared to what the taxes were pre-amendment. So I think buyback is one such area which will require a very deep evaluation for companies which now intend to do this post-October. The changes are effective from October 1st this year. This will require quite a bit of dipstick kind of evaluation before a company can take a call in terms of the increased tax cost. Now, quickly moving to the next point on a very important change that has come in terms of the sunset of angel tax. Now, this was the ask of the industry for a long time. The tax was almost more than a decade old. And the ask of the industry was that this angel tax, which is a tax on the premium between the fair market value and the issue price, that was getting taxed earlier. The ask of the industry was that it should have been abolished. Now, the government has done that. They have inserted a provision on the section itself saying that this will not apply on or after 1st of April 2025. This is a prospective amendment. Two catch there. The first catch is that section 56 to 7B has per se not been omitted. There is only an insertion of provision which is mentioning that the provisions will not apply from 1st of April 25. So therefore, technically the question that arises is that will this impact or will this relaxation also apply to the ongoing amendment, to the ongoing assessments or to the ongoing litigation? That's something that's not very free from doubt. Another important aspect that one needs to know it is about section 68, which continues to be there. Section 68 is about unexplained cash credits. So if a Indian company which is receiving any kind of capital infusion from outside India is not able to explain the source of funds, and we have seen the department asking multiple documents such as financial statements, return of income, bank statements, KYC documents of the investors to evaluate the genuineness of the transaction. Now, if the Indian company, which is the recipient of those FDI, is not able to provide this kind of documents under section 68, then they may suffer a much higher tax liability under 68, which is close to around 78%. The effective rate of tax under section 68 is around 78%, plus there is a penalty of 10%. Whereas in the case of a 56 to 7B, which is angel tax, the effective tax was close to around 35% and the penalty of close to around 200%. So one has to keep in mind section 68. Also the point that, FEMA requires that share infusion cannot happen for a value less than the fair market value. It can definitely happen for more than fair market value, but not less than fair market value. Transfer pricing also requires you to do an arm's length test of capital infusion. We have a case of 𝐊𝐞𝐲𝐧𝐸 Reddy Allah, which was in talks until recent for a ruling that came from the Telangana High Court, which said that the infusion of capital at a value which is higher than FMV without a commercial substance and then a subsequent sell at a lower price to incur losses, book capital loss, and then utilize it against capital gains, that also can invoke GAR as well as the judicial anti-avoidance provisions. So this is very important. Even with the angel tax getting abolished, I think startups definitely need to keep in mind some of the aspects like, on conversions, if there is a subsequent conversion of CCD, will this kind of abolishment of angel tax with effect from 1st of April this year, will that be beneficial to them, or the position cannot be applied, plus the rigor of Section 68, which continues to be there under the domestic tax provisions. The next one is on the gifting of, on gift, where erstwhile Section 47(3) clearly said that transfer of a capital asset by way of gift or will or an irrevocable trust was regarded as a exempt transfer under the provisions of Section 47 Clause 3. Now, this clause has been amended to grant this benefit of transfer of any capital asset only by an individual or a HUF, because corporates were, taking this point on, transfer of shares or transfer of any capital asset by way of gift to be an exempt transfer, and there were a lot of rulings to say that the law is not currently worded to tax this kind of transactions where a gift is made by a person who is not a natural person, which is the case of a company. We had a case of Reddington where, for the purpose of gift, company was considered to be a natural person under Section 5 of the Transfer of Property Act. We have a lot of other rulings under the Income Tax Act as well, which gave the allowance of this exemption under 47(3) to the companies as well. And I think that's what the government intended to plug. Now, it's very clear that if there is a case of transfer of any capital asset by individuals or by HUF, that only will be considered as an exempt transfer. If it is any other person, including the corporates, then it will not result in any sort of exemption under Section 47. Now, what is important is also for us to look at Section 50C, CA, and 50D, which imputes the fair market value as the sale consideration in case the consideration received or accruing as a result of transfer is unascertainable or indeterminate. Now, these are deeming provisions under the income tax provision. So one can say that sale consideration is nothing but the fair market value. Your cost of acquisition is actuals, and therefore will it result in a capital loss for the transferor. So we are talking only from a transferor perspective when we are talking about 50C, CA, and 50D. As far as transferee or the recipient is concerned, 56 to 10, will continue to apply and tax it as IFOS. Now, as far as transferee is concerned, obviously, a literal reading could be that I will impute the values, the fair values as sale consideration, which will result in a capital loss. But I would believe that in my personal view, in the case of gifting of any capital asset, there is no question of consideration, and therefore the computation mechanism itself fails, and therefore there may not be any requirement to compute capital losses in this kind of scenarios by the transferee, and maybe then carry it forward and utilize it in the future. I don't think that scenario arises. It's arguably possible to take that view. The next one is on OFS transaction, quite interesting because a position was being taken that under the provisions of the Income Tax Act, the way it read out is for shares which are listed and where STT is not discharged at the time of. Okay, let me just first give a background of OFS to the audience here. OFS is a leg of transaction prior to the IPO where many of the PE investors as well as the early investors of the company offload the shares to the markets prior to that getting listed. Now, a position was taken, and a lot of companies are, evaluating and doing this in the stock market. It is either by way of further issue of capital or by OFS, or a combination of both issue of capital as well as OFS. A lot of companies, and we have given some statistics as well here, were offloading the shares by way of OFS. And the reading as per Section 52 AC was such that the computation mechanism was failing because the shares were not listed on the date of transfer. So aggressive position was being taken that the computation mechanism itself has failed, and therefore many of the promoters and PE funds had evaluated and taken a position that there's no requirement of paying capital gains because the computation mechanism based on the Supreme Court ruling in the case of BC Srinivasa Setty applies, and therefore since the cost of acquisition is indeterminable, the computation mechanism fails. Now, an interesting part of this amendment is that they have applied this retrospectively. It says that this is deemed to be inserted with effect from 1st of April 2018, and what will now happen is that, investors who have not offered OFS transaction to tax as per this amendment, which is the capital gains tax provision based on the indexation for 2017-18 as it relates to the year of acquisition. If this position and methodology of applying the capital gains tax has not been applied by the investors, then they may, be liable for paying interest for almost 6 years now, because this is a deemed inversion with effect from 1st of April 2018. This can result in a huge interest liability, as well as there may be a requirement to file the updated return of income with the requirement to pay additional tax and interest. A position could also be taken to voluntarily disclose this in the ongoing scrutiny tax assessments to mitigate the penalty exposure that can arise. The last is on the capital gains regime. As I said, since there was a specific discussion on this, I'm not dwelling too deeper into it, but there was an overall ask, to rationalize the capital gains tax regime, which has been done now. Period of holding being streamlined to 12 months and 24 months. Rates of taxes now being aligned for listed as well as unlisted securities to 12.5%. Overall, the way it will impact some of the capital gains transaction is, one is where in the case of slump sale, they have still not defined whether the period of holding needs to change as per the amendments that they have announced now. So therefore, as we speak now, the period of holding will remain unchanged for any slump sale transaction, and therefore we'll have to look at it only from a 36 months period. There has been a lot of discussions about the indexation of removal, the removal of indexation benefit impacting the real estate holding transaction, and whether the new regime will pan out beneficial as compared to the old regime. Now, no clear answer to that, and that's what we have tried to explain by way of an illustration there. This determination whether the new regime where the rate is now 12.5% as against 20% and the removal of indexation together will result in a better or a lesser tax outflow will remain dependent on multiple factors, which will be what is the period of holding, what is your compounded annual growth rate, and what is the CI of the year of transfers and the year of purchase. Overall, I feel that if the property appreciation is higher than the rate of inflation, then probably the result could be such that the new tax regime, which is 12.5%, could work out beneficial to the person who is transferring the real estate asset. So this is the overall amendment as it relates to or as it impacts the M&A as well as the deal space. Ridhima, any questions? We can probably take it up now.
Okay. Sure, Sandeep. Just 1 second. Let me just quickly have a look. So there is as such one general question upon the benefit of startups. So this question actually have been in news for a long time. Why benefit to startups are limited to Section 80 IAC startups and not to all the DPIIT startups?
See, I think one of the important conditions that's written on Section 80 IAC is to showcase that the business that the startup is doing is a original, kind of business. It's not a duplication. There is an innovation in that business. There is a probability that that business can scale up and generate employment opportunities. So the government is quite clear that they don't want to crowd this space by giving the 80 IAC exemption to all the startups, but they want to test all the startups on the basis of these conditions, which are innovation, scalability, and all that, and then offer the 80 IAC benefit only to that limited set of startup pool, which kind of merits this kind of tax exemption. So I think that is one of the reasons. The second important aspect also to note is that most of the startups in any case incur losses, right? During the initial years, they don't have much of the profits that could be offered to tax. So I think these are some of the considerations that one need to keep in mind that, probably has resulted in only close to around 3,000 startups currently being under 80 IAC, where we have, close to around 30-40,000 startups which are DPIIT registered.
So I think government should come up with something like more tax incentives for the startups in the coming year. Do you think so? Because Make in India 2.0 is all over the news again.
It is. I think they are trying to do it gradually. Maybe this angel tax abolishment in itself has been, one of the key, item that obviously they did it over a period of time based on the ask of the industry. Maybe in the next couple of years they may come up with some of the incentives which will mean that the profits of these startups are not getting taxed eventually.
Right. And one general question came from this angel tax abolition only. So, impact of angel tax abolition of valuation under the Income Tax Act. What is your point of view?
See, all this while there were two kind of issues that were coming in the Income Tax Act as far as valuation is concerned. One point was the department was always disputing on the method of valuation that was being deployed for arriving at the FMV. Now, we look at most of the startups applying DCF, and they were trying to dispute that the DCF is not backed up by the actual, projected cash outflows, etc. They were trying to test the valuation that was taken 5 years back, saying, can you please try and align it with the actual cash flows that you have actually received now when you're undergoing an assessment. So the method of valuation was always been disputed, DCF versus NAV, etc. And the second one was on the requirement to showcase that the valuation has actually been genuine in terms of demonstrating that whatever was the projected cash outflow in my DCF calculation has actually transpired in the future. So I think this kind of issues will now go away because there may not be any requirement to substantiate FMV per se under section 56(2)(7)(b). And this in actual applies only for the prospective period. As I said, it may actually not be of much help for the ongoing assessments or litigation unless the government specifically comes out with a clarification that all the existing litigation on 56(2)(7)(b) is also put to rest.
Right. Then it actually addresses for what it has come for.
Right.
Great. Any other question anyone has on other live platforms? I believe that is all. So thank you so much, Sandeep, for an amazing session. And it was a very informative one as always.
Perfect. Thank you. Thank you, Ridhima.
Looking forward to have you again.
Thank you.
Thank you so much. So now towards everyone's beloved topic, charitable and religious trust. Our next session will be conducted by our favorite duo, Manoj Fogla, Senior Partner at LLP, and Suresh, Senior Partner at LLP, and Suresh Kejriwal, Partner at 𝐊𝐿𝐞𝐲𝐬 & Co. A very warm welcome to both of you. Manoj Fogla, a fellow of Institute of Chartered Accountants of India, holds a law degree and PhD from Utkal University on social accountability standards for NPOs. He is an expert in taxation, CSR, FHCRA governance. With over 30 years of experience, Manoj has served various charitable sectors, including education, religion, and the environment. He offers advisory, compliance management, and litigation support services. He has authored Trust and NGO Ready Reckoner and several FAQs on GST FCR for the ICI. Manoj is also frequently faculty member at the national and international forums. We also have Suresh Kejriwal, a chartered accountant and a founding partner of Messrs. 𝐊𝐿𝐞𝐲𝐬 & Co. in Kolkata. He has over 32 years of experience specializing in NGO sector across India, Bangladesh, and Nepal. He teaches the Diploma in Financial Management and Accountability at the Tata Institute of Social Sciences in partnership with Financial Management Service Foundation. Suresh served on the Cooperatives and the NPO Sectors Committee of ICI for 2013-14 term. He's an associate author of Taxation of Trust and NGO by Taxmen and contributing to drafting ICI and FAQs on GST for NPOs. He has led numerous workshops and seminars on NGO sector topics for various institutions, including ICI. It's an honor to have you both on board, sir.
Thank you.
I hope you both are doing great.
Yeah, thank you.
Thank you so much. So without further ado, the stage is all yours to take.
Yeah, thank you, Ridhima. Today we will be discussing on the amendment pertaining to the charities in the Budget 2024. So at the outset, I will take you through to the major, in a layman's language, I will take you through the major amendments. And then Sureshji will take you threadbare to the nuances of the act. So I have jotted down, there are five major areas in which we find the amendment in charities has happened. In fact, if you see the amendment of charities, you cannot see, you will be able to make a meaningful analysis if you take 1 year at a time. Particularly for the last 4 or 5 years, 4 years or 5 years taken as a block of period, you will make some sense about the way and where the charity related amendments are moving. This year, the most major defining amendment is that all approved category of organization under section 1023C will no longer be allowed approval under 1023C. So therefore, we will have only one category of registered institution for charitable, religious, solely educational, solely medical, all kind of institution will come under one umbrella. That will be section 12A, read with section 12AB. Now, let me just give you a brief context. Under the prevailing law, there are 9 different sections under which charitable and religious organizations can take tax exemptions. 8 categories under section 1023C. Under 1023C, there are 8 categories, 4 categories which are directly exempted without any need for going to the commissioner for approval. While filing the return, you can just declare that you are an organization. So those 4 organizations are government-funded schools, government-funded medical institutions, educational institutions below 5 crore, medical institutions. So these are exempt category, any kind of approval, and they have kind of a blanket exemption. So they are not subject to various compliances, 85% application, specified investments, payment to specified persons. So those 4 categories will continue. Then you had another 4 categories under 1023C, 1023C, clause 4, 5, 6, and 6A. Here we had 4 categories of institution of national importance or state importance, specifically religious institution, specifically charitable cum religious institution, solely educational institution, and solely medical institution. These institutions were specially approved by the CIT or the PCIT, and these were considered as 2 parallel regimes. Initially, when these provisions came, the regimes were not parallel, because if you remember in 2021, the budget, a lot of changes came in Finance Bill 2001, which more or less merged the differences between 1023C and 12A. Before 2021, a 1023C registered organization could accumulate funds without filing Form 10 or Form 9. The amount accumulated beyond 15% were not required to be invested in specified investment. There was no penal provision for making payment to specified persons. There was no provision pertaining to activity outside India. So there were a host of privileges enjoyed by organizations registered under 1023C. Those in any case were nullified over the years. This year, the entire segment of exemption under that section has been removed. Now onward, the cutoff date is 1st October 2020. The problem is that though they have removed, but the sunset clause will be 2029, because up to October 2010, the commissioner will go on issuing 1023C registration. Beyond October 2024, 1st October, no more exemption under this category. So this will be a transition over a period of time. Then another which has not been noticed very well, that a provision has been added to section 12A1AC clause 6. If you remember, from 2021, this new scheme of taxation came, and all existing organizations were required to apply in Form 10A to regularize their registration under the new scheme, 5-year registration. And many organizations, due to lack of awareness, technical glitches, selecting the wrong code because of so much of complex provisions, were unable to apply. And there were so many circulars. The last 2 circulars in the last 1 year were circular 6 and 7. And 30th June was the last date till which organizations whose registration expired in March 2021 are allowed to apply after a gap of 4 years. All this happened because the Act did not have a provision empowering the Commissioner to allow continuation of delay in filing of an application form for either new registration, renewal, or regularization. Now in the Act, there is a provision which empowers the Commissioner to allow continuation of delay, of course with reasonable cost, in all category of application. This is a much needed relief, and the organizations who failed to take advantage of Circular 7 by 30th June, they can still apply for new registration, because the Act says clause 1 to 6, and clause 1 is regularization of 2021 registration. Then we have a altogether new section added, section 12AC. This section is about merger of charitable institutions. Now, due to various reasons, merging of charitable institutions and religious institutions had been a big issue. And issue under the trust laws, the societies laws, Companies Act, as well as the Income Act. All the 4 statutes related to charities are not very enabling in nature to provide a reasonable or an appropriate way forward for merger. So now, at least under the Income Tax Act, there is a section which says if 2 charities merge, then this merger will be permissible. And why it is most important under Income Tax Act, suppose you dissolve a charity, then the dissolution of charity itself will attract section 115 TD, that is accredited tax. So that was the reason whenever we were asked to do tax planning, we used to suggest that please don't try to merge, better to the organization can be dissolved. But now, at least the Act provides merger of charities, and the demerged defunct will not be subjected to 115 TD, even if it surrenders the 12A registration. Then one more amendment, though it has in some sense increased complexities, under 80G below the section where application for provisional registration, where activity has commenced, provisional registration for activity has not commenced, and direct registration for activity has commenced. There, in both section 10, all the 3 sections, 1023C, 12A, and 80G, a very arbitrary provision exists, and it exists even today. All these sections say that you cannot apply for a fresh registration under section 12A, 80G or 1023C if in the past ever you had taken benefit of that particular section under section 12A and 1023C. So now, if your 12A registration has not been renewed for any reason, you cannot apply for 12A registration any time in future. That is the provision of the law. That is the provision under section 12A1 AC clause 6. So under 12A it has not changed, but under 80G it has changed. So now organizations can apply for 80Gs, but this provision will have very limited utility. It will help only those organizations who had 12A registration but never had 80G registration. These organizations can apply for 80G. For other organizations, unless there is a corresponding amendment under section 12A, this provision will be of not much help. Then lastly, section 47 has been amended, that definition of transfer. And now gift of capital asset will not be treated as a transfer, and primarily corporate entities cannot gift capital assets, land, etc. to charitable institution. This, I think, is a provision which should be reconsidered, because the explanatory memorandum says that gifts should be related with natural love and affection, and in a corporate there is no cause for natural love and affection. But a corporate giving for a social cause or a public cause reflects social empathy and corporate citizenship, which should be considered higher than a normal individual love and affection. So this will have a lot of cascading effect. We find corporates donating various kinds of assets to deserving beneficiaries, movable, immobile, etc. Those will be subject to tax. What will be the tax implications? We are not discussing. So I briefly took you through the provisions. We have very little time. I will ask Sureshji to quickly run through some of the key provisions, and then we will discuss few key issues. Thank you.
Thanks, Manojji, for setting the context by sharing with us the overview of the proposed amendment. And what I will do is shall initiate the detailed analysis of some of the key proposed changes. Let me share my PPT. So Manojji has given this. Manojji, I'm clear?
Yes, sir.
Okay, my PPT is visible?
No, not at all. I guess you have to share it again.
You share it again, and Sureshji, you can continue. You can continue while the PPT comes down.
Okay, no, I am to. So I will just stop share.
Is there any problem?
I am not able to share the PPT. So I'm before PPT, I'm just going then.
Okay.
Yesterday it was going on. Just let me try again, because PPT would have been better.
Yeah. No worries, take your time.
Okay. ये PPT क्यों नहीं शेयर कर पा रहे हैं? यहाँ पर आ क्यों नहीं रहा है? इनको बुलाओ तो.
शेयर का ऑप्शन है ना इसमें. मेरे को तो पहले
लेकिन इसमें तो आ नहीं रहा नीचे, जैसे ये पीपीटी है.
Sir, open it once.
I am opening the PPT. I am downing it. Now here.
You can mail me, I'll share it quickly.
Suresh, you don't bother about the PPT, you continue.
Okay.
Yeah.
Okay, I am audible?
Yes.
So the first PPT is better thing. So first detailed analysis is on the gradual merger of two regime, that is first regime to second regime. And as Manoj ji has rightly said, that 1026C has two different category. One is non-approval category and another is approval category. So this will this non-approval category will stay, and this is not going to merge even after gradual shifting from second regime to first regime to second regime. Only the second regime, first regime is going to be merged with the second regime. Now, what is the process of this regime with shifting? They have closed the window to apply for new approval on or after 1/10/24, meaning thereby up to 30th September 24, the first regime applications can be made, and the CIT has to consider that application if the application has been submitted before 1st October 24, meaning thereby after 30th September 24, no new application, but the entities which have already got the 2026 approval shall continue. That means parallelly, though there will be no new entry to this first regime club, but all the existing organizations which have already been approved shall continue to operate. And as Manoj has rightly said, and this way the 29-30 assessment year shall be the sunset clause when the first regime will going to be totally merged with the second regime, but non-approval category will still to continue without any change. So Manoj, the first issue is, or we will take up the question at a later stage. Now the second change is the much needed continuation of delay, which Manoj has also said very nicely that at the time of submitting application for registration under either for one-time registration or for converting provisional to regular registration or for change in object, whenever there is a delay, the delay continuation power was not with the CIT exemption, and those applications were refused. And in those cases, either we have to go to the CBDT for 119 or we have to go to the Income Tax Appellate Tribunal, though government has given a number of circulars extending the timeline. Now the government has realized this difficult task and has given this power, proposed this continuation power to the CIT exemption, and this exemption power has been given to all the type of registration under Section 12AB. But ironically, this again has not been given. Similar power of continuation has not been given for ATG approvals. And again, the circular 6-like position will prevail, where though you will get the 12AB registration through continuation, but you will not get ATG approval because there is no continuation power to the CIT exemption. And again, we have to go to the CBDT or to the ITAT. So I think the government should take a view that in both the places, the continuation power should be there. Now, coming, the next key amendment is the new section for merger for charities. As we all know, presently Income Tax Act doesn't deal with specifically on the merger or amalgamation of the trust. An irrevocable trust, whether it can be dissolved, again is a question for debate. And the beginning is being made by inserting a new section under Income Tax Act, which provide that one registered trust can be merged with another trust, provided they carry the same or similar objects, or they meet the specified conditions which are yet to be prescribed. So I think this is a welcome provision because in number of groups we find a number of trusts is operating and they want to merge to cut down the number of trusts because of the compliances issues. And this provision shall be a welcome provision for those type of requirement. But at the same time, we have to also go through the constitution document, the law under which we are incorporated, the state laws where applicable, and we have to take a consolidated view whether we can at all go for the merger or not, and what are the conditions we have to meet. Now, another key change is the opening of the window for ATG approval, where it was closed from 1/10/23. We all know ATG approval was not always taken at the time of taking 12-baby registration. And the NGO tend to take ATG approval when they started to wanted to raise the CSR fund, or they wanted to raise local fund. But incidentally, from 1/10/23, a proviso has come that if you are going to apply for the first time for ATG approval and you are an entity which has already commenced activity, then one of the conditions that you should not have taken benefit of section 11, 12, 13 or section 1023C in the past. But in such cases, always the entity was already registered under section 11, 12, 13, and so they were not satisfying this condition, and they were not eligible to apply for ATG approval, though they are going with the 12-baby registration. And this created a great deal of hardship for those type of entities, because for raising CSR fund, holding ATG and 12-baby registration is a must. I think the proposed amendment done away with this condition, that the requirement of whether the NGO has a past exemption benefit or not. Now there is no such requirement, and now the NGO can apply for ATG approval at any time. But again, this corresponding provision also exists in 12-baby registration, meaning thereby, though in cases where 12-baby registration is there, in those cases the entity can avail in this amendment and can get the ATG. But take for example, for certain regions, the ATG has been cancelled, 12A has been cancelled for some entity, and they wanted to go ahead with the new registration under section 12AB. In those situations, as the entity has already taken a benefit of 11, 12, 13, that entity will not be allowed to apply for a 12-baby registration. Though that entity, after this amendment, can apply for a ATG registration. But again, for ATG registration, having 12-baby is a must, is a precondition. And that's why we understand similar amendment which has been made for under ATG should also be given under 12AB, so that the same level ground fit can be there for both type of entities. And lastly, the changes by which Manoj also mentioned about gift of capital asset to the charitable entities may be subjected to tax under section 47. The section 50C and 50D are deeming provisions, maybe in the rescue of the NGO, but the way the budget memorandum explained, I think that will be a litigation, and the corporates will be discouraged to gift the immoral property which they own for a charitable purposes. So I think again the government should exempt the gift or continue to exempt gift for charitable purposes as exempt transfer under section 47(3). Now with this word, I want to discuss with Manoj for the condonation power has been given only for ATG and not for 12AB. So how it is going to affect the NGO?
No, as we have already discussed, that ATG related condonation will only apply for those cases where ATG was never taken. Otherwise, 12A being a precondition to AT, this amendment doesn't make any sense. And maybe by the time they finalize the bill into an act, a corresponding amendment in 12A is necessary, though 1023C is also there, but we may not require an amendment there because of the phase out.
Secondly, Manoj, as we know that after 30th September, the window for applying 1023 approval shall be closed. Now take a case where the NGO has obtained the provisional approval under section 1023C. So what he will do, and the 6-month time limit has not expired on 1/10/24. So whether she should wait for the NGO should wait for applying for a 12AB, or what the NGO should do?
And if an application under 1023C has been made and the 6-month timeline has not been elapsed, then if the registration under 1023C is not issued prior to 1/10/24, then the NGO should get registration under Section 12AB.
So in those cases where the application for converting provisional approval to regular approval has not been made up to 30th September, then that particular entity has to submit regularization under 12AB.
Yes.
Next, after the new novel case, most of the NGOs, because of the word solely, have changed their object to only education. Now they will also shifting to the second regime. So what advice we have for those type of those entities?
This is a very important thing. We would seek the attention of all the viewers. A couple of years ago, we had a landmark ruling by the Supreme Court in the Noble Educational Society case, where it was said that under 1023C clauses, an organization has to be solely and it cannot engage in any activity, and it was suggested that even the bylaws should be changed, and many organizations changed their bylaws to make it a solely educational institution. Now there is a corresponding problem under Section 12AB. 12AB is a general section under which an educational institution with other objectives can also enjoy exemptions. If an educational institution shifts to 12AB, it is recommended that they may go for amending their bylaws prior to shifting, so that they will not have to apply again for modification of objects. Why we are suggesting that? Under Section 12AB subsection 4, one of the specified violation for cancellation is if an organization works beyond its own stated objects. Earlier it was if the organization works beyond objects as per Section 215, but now if you work beyond your own objects, it will be a stated violation. So better to have a broader object clause.
Thank you, Manoj. Before we close, we will take up one more question. As you have discussed about continuation of power to the CIT exemption in all categories of registration process. So whether the 5-year registration for the existing organization as on 1/4/21, whether they can still apply for 5-year registration after this continuation power, and when they can apply?
Now it is quite typical. Now after so many circulars and after 3 years, many organizations have still failed not to apply for regular registration, and their registration has expired from 31st March 2021. Some of them are facing scrutiny assessment as an AOP. Such organization also has a window because the Act has been drafted in such a way that the condonation power is for clause 1 to 6. And clause 1 is specifically for 2021 registration. But it will become effective from 1st October 2024. So those organizations, in our opinion, should wait and apply after 1st October 2024 for condonation of delay. They may file a ask for permission to file Form 10A, and they should get their 12A registration regularized, even if it expired on 31st March 2021. So it is a huge opportunity. If some organizations are there, they should take advantage of it.
Thank you, Manoj. As the time is very short and we are near to completion of time, I will hand over it to the Ridhima ji for taking any question from the dais. And before I end, I would like to thank Taxman for giving us this platform to share our views. So over to Ridhima ji for taking any questions.
Thank you so much, Manoj. Thank you so much, 𝐊𝐞𝐲. I think this is, as always, a very informative session with you two, because you people actually dug deep into the details. That's pretty awesome. Just 2 queries before we hand over the session to the next speaker. First we have is, what constitutes for a reasonable cause for filing a condonation of delay request before PCIT and CIT? This we got on some forum.
Reasonable cause is a very generic term, and we don't have any special provision or any clause. So the definition is reasonable as applicable in civil law. So normally what we suggest, the reasonable cause in the past, because of the glitches. We have several tribunal decisions where technical glitches, selection of wrong code, etc. So if the organization has made effort to file a return or the application has failed, then that can be a reasonable cause. Otherwise, the organization, the reasonable cause are circumstances under which it was unable, and the organization normally tend to take the health or the medical ground of the key people or the finance officer. These are the standard causes we find as reasonable cause.
Correct. Interesting. And since Section 47 change, this proposed restrictions on the gift under Section 47 of the Finance Bill, how will this affect the charitable entities?
Charitable entity, in fact, it will, because any kind of capital asset, the corporates are discouraged, and we have been seeing that corporates have been given various kinds of capital assets, including, say, computers, etc., to beneficiaries, even vehicles, etc. A lot of things were being given to beneficiaries, used vehicles, used assets, used furnitures. So being in the charity sector for so many years, and we don't understand the rationale, I think this is one provision which will severely affect the charities, unless some tribunal comes to the rescue, seeing that this kind of transfer will not come under Section 50C and all those kinds. So those kinds of litigations will going to go. But on the face of it, it is not a very desirable change.
So it is. Yes, sir.
I agree with Manoj because it is not only corporate, other entities, even the LLP, where the government is going for the CSR. So this provision for charitable purposes needs to be reviewed. Transfer for charitable purposes needs to be reviewed.
It's a very open one right now.
Very open one. Only individual HUF. Only individual HUF.
Yeah.
Correct. Great. Thank you so much, sir. It's always an honor to have you both, and it was actually an engaging session as always. Thanks a lot.
Thank you. Bye.
Thank you so much. So before we proceed to discuss amendments in other laws, we have last session waiting on income tax, a crucial one, which will cover the topic transfer pricing. So to quickly guide us through the recent amendments, we have joined by Sri Mithilesh Reddy, founder and CEO of Steadfast Business Consulting LLC, SBC. Mithilesh brings over 15 years of extensive experience in transfer pricing. He's specializing in advising multinational enterprises on 3-tier documentation, transfer pricing, litigation support, and complex intercompany transactions. The expertise include transfer pricing structuring, controversy management, global benchmarking, compliance, advisory services for APA, MAP, and BEPS. Mithilesh diverse client base spans sectors such as technology, industrial, pharma, financial services, and consumer goods. A very good evening, Mithilesh.
Yeah, hi. Very good evening.
So how have you been?
I'm good.
So now the session is all yours to take.
Yeah. Can we start?
Yeah. Would you be sharing the screen? Yeah. Okay.
So it's visible?
Yes. Could you put it in the slideshow mode?
Is it fine now? Yeah.
The slideshow mode isn't visible right now.
It's fine now, I think.
Yeah.
Yeah. Okay. So hi everyone, the Mithilesh here. So we'll quickly get through the amendments. There are almost like 9 amendments that have come, specifics to transfer pricing, wherever the references to the transfer pricing provisions can be made and where exactly it is going to impact the transfer pricing assessment, as well as the specific aspects of Section 92 or Rule 10. We'll have 8 things discussed in overall perspective. One such important amendment is the SDT provisions. What exactly happened in this specified domestic transactions earlier, before this amendment and after this amendment? we'll just quickly run through. In the existing provisions under Section 92CA, wherever the reference to the transfer pricing officer was being made by the assessing officer, the transactions pertaining to international transactions were specifically having any other international transactions where 92CA 2A and 2B had not been extended to SDT provisions as such. So whenever a international transaction gets referred to the TPO, the transfer pricing authority had the power to get into any other international transaction where the reference was not made as such. So once a file is referred to him, if only a specific international transaction is referred, he can get into any other international transactions where the specific reference for him was not made, because 2A and 2B of 92CA had this reference of any other international transactions per se. Now, this section is amended by the current provisions, saying that the TPO will have authority to extend this particular reference for a specified domestic transactions to any other specified domestic transactions also, which have not been referred to him for the transfer pricing assessments as such. So any SDT file that comes to the transfer pricing authority, he can get into any other international transactions that can be, any other specified domestic transactions that have not been specified by the scrutiny parameters or by the assessing officer or by the internal reasons why this particular file is picked up for transfer pricing assessment. With this amendment as such is important from a transfer pricing assessment per se, is because of the fact that most of the SDT files or the domestic transfer pricing files have been skipping through the nose of the authority, or even if the authority goes and does the adjustment or goes into any other specified domestic transactions, assessees were always contemplating with this particular section, saying that you cannot go into any other specified domestic transactions other than the ones that are referred. So they have blocked this loophole in the law by including the specified domestic transactions also. For example, if at all ABC is a tax-paying unit or a tax-paying entity within a group, they have royalty transactions as well as purchase or sale transactions. So the sale and purchase transactions are part of the reference, but royalty per se is not part of the reference. Then the TPO can get into the royalty transactions also. So there was one judgment of Ahmedabad which said that it is directed that even if AO failed to make TP reference, he can consider the TP adjustment proposed by the TPO while passing the final assessment order. But this specifics were not there within the Act if the SDT transactions were not there. So there was a specific intention behind this. There was an expansion of the scope for the transfer pricing authorities. It's a very good amendment. Only thing is, wherever there are specified domestic transactions, they have to be very careful in terms of disclosure of specified domestic transactions and also declaration of the arm's length. There has to be a specific indication that there should not be an excessive or unreasonable profit making in any of the transactions per se, and all the transactions have to be disclosed. And if any transaction is not disclosed and if it is not being referred by the authority also, transfer pricing authority can get into any specified domestic transactions from 1st April 2025. Now, what exactly happens with this SDT transactions is the entire jurisprudence will get covered for the transactions, even if they are not reported by the assessee per se. And it ensures that there is fair market practice. It ensures that there is less dispute. The TPO making the adjustment, assessee saying it is not covered by the Act. So they have plugged in all the loopholes with one amendment saying that it extends to specified domestic transactions also, 92CA 2A and 92CA 2B. Safe harbor rules have always been the part of dispute resolution mechanism. The first amendment, the first introduction of safe harbor rules as such has been done in 2013. In 2017, there has been an amendment. What exactly are the safe harbor rules? Safe harbor rules is a indicative margin given to a specified set of transactions, specified set of activities being done by the related parties in a group. If the transaction falls within the definition of such definitions indicated by the safe harbor rules, and if you maintain the margin specified by such safe harbor rules, then the authority can give you that safe harbor order or the exemption from transfer pricing assessment. So for ITITS, the Rule 10A to Rule 10 HD specifies that if you are not more than 200 crores, if you are more than 100 crores and 200 crores, there are specific indicative numbers of 17 and 18%. So there are specific transactions of ITITS. I'm just giving you a rough example of only ITITS per se for the sake of simplicity and easy understanding. So if you are falling within the definition of IT and if you are maintaining 17%, and if you are less than 100 crores or 200 crores for 18% also, then the definition per se, the margin and how the coverage happens, and you are avoiding the transfer pricing assessment. So this is called as a dispute resolution mechanism, alternative to the exposure to the transfer pricing assessment. So these safe harbor rules were introduced in 2013. They were amended in 2017. Now there is a proposal made by the finance minister saying that she wants to include the foreign mining company. They wanted to specifically include the safe harbor rules for foreign mining companies selling raw diamonds in India. And she has also proposed a certainty in terms of changes or widening the safe harbor rules per se. But there is an indicative expression that the safe harbor rules definitions, the term, and also the coverage in terms of the margins would set to be revised or widened. So we have to wait and watch what exactly is going to come out in a separate notification. But however, they are aiming to reduce transfer pricing litigation. They are aiming to widen the scope of the definitions that were indicated. They are aiming to make it more attractive, was the word. So obviously the margins that were set out were a bit more than what the industry was generally expecting to in 2013 or in 2017. So if the margins are reduced, then there will be a huge benefit for all the foreign subsidiaries staying in India for the definitions that they have announced. So most probably the margins would come down, the scope would be widened, and the definitions would be subsumed, and they would be more inclusive definitions is what the expectation is. And the term earlier in 2013, it was applicable for 3 years. After 2017, 2020, 21, 22, they made it applicable for 1 year, where each year the notification or the applicability was kept on extending. So there was only 1 year applicability. So the term also might get increased. This is the industry expectation. So we have to wait and watch for the notification as such. Now for thin capitalization rules 94B, there is a specific section which was applicable which was extracted out of the OECD BEPS provisions also. But this BEPS plan specifically indicated a thin capitalization rules where the loss-making companies were taking a much more advantageous position for claiming the interest deduction. In spite of being loss-making entities, they were claiming the interest element, and they were siphoning away the funds was the normal indication with which this provision was introduced. But specific to IFSC units, they have made sure that to develop the world-class financial infrastructures, the exemption was given to this IFSC units to meet the specific conditions in relation to the IFSCA Act. This amendment will come into picture in 2025. The objective is that these companies flourish even in spite of being, they can take more and more funding, and these interest limitation deductions or the specifics of the thin cap rules will not be applicable to these IFSC entities as such. So the point is, government is in favor. They are giving that exemption. They are allowing them to claim more and more funding. They are allowing them to promote and give them that levy or leverage over and above the thin cap rules also. So it's a very good positive move, I think. I mean, in overall basis, this thin cap rules must be eliminated for anybody who is going to promote employment or generate employment or going to be useful to the country. That is a extension that was expected, but they have specifically included only for the IFSC units. They should have given it to MSMEs or anybody who is a startup kind of a thing also. It should have been extended, but they have not extended that. They have kept it specific to the IFSC units. So rate of foreign companies, 40 to 35% is a welcome move. However, these permanent establishment entities, wherever there is transfer pricing applicability, generally kind of whenever we attribute any transfer pricing, income to a permanent establishment, the specifics of 40% and 2% surcharge, all these elements were very, very high. The maximum marginal rates or the 40% plus 2% plus 5% was a very much higher, applicable rate. But these TP provisions, wherever they are applicable, or the general rate of 40% coming down to 35% will be a very, very good attractive specification, especially where the tax burden on the non-domestic companies earning in India is only 30 or 26%. So they're only at that 9-10% gap right now. And the one more important provision that has to be taken care is that the 2% and 5% have continued to be levied. So there is no such indication that they're going to get down from the surcharge and the 5% where more than 10 crores is there. But only the basic rate or the fundamental rate of 40% has come down to 35%. Now, this can be an incentive, is what the language or the provisions are indicating. But from a overall perspective, from a global minimum tax rules or from the indicative perspective, the expectation on the general rate also was they expected to be reduced, but they have not reduced it for the domestic companies. They've only reduced it for the foreign companies per se. So wherever transfer pricing, amendment, the benchmarking happens for the permanent establishment or for the attribution purposes, 40 to 35% needs to be considered. From a 𝐊𝐴𝐳-𝐶𝐵 scheme, wherever the applicability from a transfer pricing assessment or the dispute relating to TP appeals is concerned, the upfront payment needs to be made. Wherever the assessee was a appellant as on 31st January 2020 was the indicative number that they have given. But in my understanding, in my specific experience, practical experience, most of the TP litigation gets nullified at the ITAT or a high court. So depending on the more likely than not scenarios or the past litigation, or if it is covered, then most of them may not go to VSV. They would fight it out and get it cleared. But from a TP angle, if you see the 𝐊𝐴𝐳-𝐶𝐵 scheme, they may not be going, if at all, the coverage of the specific comparable issue or a guarantee or a receivables, or there is any specific issue, AMP, there is any coverage that is already available. And if the jurisprudence is available, then they may not go for an upfront payment and try to settle this. But from any other issues which is complicated in terms of not having a judicial precedent in favor of them, I think most of them might go for the VSP scheme. So this is the summary where the specifics of 100% payment or 110% payment before or after payments of December 2024 are there for tax purposes, and 25 to 30 and 30 to 35 for disputed interest or penalties is applicable. So these are the payment schedules that we have summarized. But the appellant, whether he is an appellant or as on 31st January 20 or not, are the specific dates which would determine most of the payment schedules. I mean, whether he's applicable for the VSP scheme or not. And the payment schedules will be 100% before 24 December and 110% after 24 December for the taxes. There is only a 10% difference if you available in the column number, serial number 1 and serial number 2. But in terms of the interest and penalties, the difference they kept is 5%, 25 to 30 and 30 to 35. As on 31st January 2020, whether you are an appellant or not. from a VSP scheme standpoint, whether the appellant is eligible or not, and when the payment has to be made within 15 days from the date of payment, they have taken the extract or the intent from the past, VSP scheme. However, this time they've specifically mentioned that this scheme will not be applicable for search cases, prosecution, wherever there is a dispute relating to foreign income and asset, whether there is a dispute relating to narcotic drugs and all, which may not be a specific case for transfer pricing as such. So my point is, wherever there is a jurisprudence which is applicable, whether it is applicable or not applicable, whether there is a coverage that is there, the more likely than not scenario will be the decision-making point for the VSP scheme to be taken for most of the transfer pricing cases. So ITAT filings, wherever the transfer pricing litigation is applicable, earlier it was 60 days from the end of the month in which you got the communication from the CIT or the DRP. Now it is 2 months from the end of the month in which the order, the order is communicated. The 60 days from the date of which the order is communicated was the existing provision. Now the proposed provision is 2 months from the end of the month. So they have extended the timeline by saying it to be specifically 2 months, and that too from the end of the month. Earlier provision was 60 days from the date on which it is communicated. So these specific amendment is kept effective from 1st day of October 2024. So 2 months from the end of the month is the revised timeline for filing the income tax ITAT appeal. From a revisionary standpoint on the 148 also, most of the cases, the timelines have been revised. So if at all any specific cases are there, we've just summarized it from a TP assessment, TP provisions angle is as such. But most of the cases, wherever 140 and 148A are there, and there is a revision that is applicable, the specifics of existing and proposed provisions are summarized for 148 and 148 as such. So all in all, the main amendment was specific to the streamlining of transfer pricing assessment. The general scenario wherein the 12 months timeline would be given as an extension is still applicable. However, from a TP assessment standpoint is concerned, the expectation that they would announce the entire streamlining of transfer pricing assessment is applicable, is expected from a separate notification. The 12 months timeline is still kept. The transfer pricing assessment proceedings as such, whenever they are streamlined, would be applicable for the specific dispute. The route of transfer pricing assessment would still be the same, or they will keep the DRP proceedings alive, or they are going to get it to the faceless mechanism. Whether the ITAT or the income tax appellate proceedings as such will be streamlined to be kept separate as a physical for transfer pricing assessments. All these aspects are due for a notification. So the point is, the transfer pricing assessments were kept out of faceless proceedings, first of all. So they were kept physical. All the transfer pricing assessments that are currently happening are physical. Now, they are saying that they're streamlining this transfer pricing assessment proceedings. Whether they will keep it in the NFAC or they will keep it away from NFAC is one point. Whether they are going to announce the dispute resolution process, that is the litigation process, whether they are going to keep it the same or they are going to keep it away from NFAC, and they are going to say that the CIT appeals also will be physical completely, because most of their files, wherever the transfer pricing litigation was there, and erstwhile, if we have applied for a commissioner appeals, they are still stuck at CIT appeals. They have announced a notification saying that everything has to be assessed or everything has to come back to commissioner appeals designated for transfer pricing, but most of them are still stuck. So there are complaints that have gone to the CBDT, there are complaints that have gone to the finance ministry also, and suggestions being given by the direct tax committee of ICI. So that they have considered this and they are analyzing all the provisions to be streamlined completely for transfer pricing assessments, to be kept physical maybe, and then have the commissioner appeals also streamlined. All the cases of TP litigation will come back to the commissioner appeals physical. And then what about the ITAT also? So these questions are still remaining to be answered, and they have specifically specified that they are going to streamline the entire transfer pricing assessments. I was explaining the objective why they have kept it separate and they wanted to announce this separately is the fact that there are multiple questions that are being raised by the transfer pricing officers and also the assessees as such. So all these 4 questions need to be answered. That will be answered through the specific notification. So the powers of a commissioner, most of them, wherever there are 144 or best judgment assessment that are happening, commissioner appeals have been empowered that they can send back all these assessments and the timelines will be extended. Wherever there is TP, the timelines can get extended for 12 months. So the specific power has been given to the commissioner appeals or the JCIT appeals under section 251, and the amendment to the specifics of 153. The timelines also will get extended again by these specific timelines, which were, the erstwhile provisions of the assessment timelines. Wherever there is transfer pricing wherever the transfer pricing provisions are applicable, the 12 months extension also will be given. So these are the 8 amendments that we wanted to talk about from a transfer pricing perspective is concerned. Ridhima, you're there?
Yeah, Mithilesh.
Yeah.
Thank you so much, Mithilesh. Let's just give a quick shout out to anyone who has any queries from transfer pricing.
Yeah.
Yes, everyone, the PPT, all the PPTs would be accessible. Those who have registered definitely will get all the PPTs of each of the session separately via mail.
Sure.
Just 1 second, let me just have a look into it. So there is a general question coming up. From an international taxation point of view, do you think the government will reduce tax compliances and simplify provisions for companies engaged in international taxation in future?
They are already doing 15CA, 15CB assessments. They're already doing surveys in income tax, international tax perspective. They are having a specific division on international tax as such. Wherever there is a cross-border transaction, if a permanent establishment is being question, all these assessments are happening in a small jurisdiction like Hyderabad. We are having almost like 500, 600 assessments happening. So you can imagine Mumbai, Delhi, there'll be in thousands. So they're already doing it, but specifically applying international tax assessments other than the 15CA, 15CB foreign payments and the receipts and the permanent establishments and also the lower deduction and nil deduction certificates. Other than these 3-4 issues, there is no specific thing that can be added because all the provisions are getting assessed under the regular scrutiny itself. The specifics have been kept only for the international tax as a specific division. So I don't think there'll be a specific assessment as such for the international tax provisions per se, but anything can happen. They can take a call that, you can do international tax assessments separately also. But I don't think so. It's a mere possibility right now.
Right. Another query, Mithilesh, I have given you on a direct chat box. If you just can give a look to it. It's regarding some timeline for filing appeal.
Timeline for filing appeal before CIT will increase from 30 days, but PPT slide shows 30 days. Okay, where is 30 days? I think they're talking about this chart. I think this chart needs a amendment. Is what they are pointing out here somewhere. Yeah, they are correct. We can change that 30 to 60 days. That should not be a problem. Yeah.
Okay, so Manish Joshi, if you're here, your comment is absolutely right. It is 60 days.
We can mention that in this thing. Yeah.
Great. Perfect. Thank you so much. Thanks a lot, Mithilesh. It was always a pleasure to have you.
Thank you.
So now moving on to amendments to other laws, and we will first know the changes in indirect tax, GST and customs. We have with us Jatin Christopher, a chartered accountant, cost accountant, a law graduate qualified in 1996 and specializes in indirect tax laws. Jatin is a published author and a resource person for ICAI in its various post-qualification programs on indirect taxation. He supports ICAI in publishing educational and research material on indirect tax topics and is also a resource person for the government, conducting training for practitioners, trade and officers. Jatin has been practiced since 2000 as a partner in JCSS, a full-service firm with a presence across India. A warm welcome to you, Jatin.
Thank you.
So how are you?
Very well, thank you. Very wonderful.
So here we meet again for the budget marathon.
Yes, thank you.
Great. So now the session is yours to lead. Please take it forward.
Thank you very much. Good evening, friends. I recognize that participants have been sitting in on this marathon presentation organized by Taxman, and it's something that's very put together very quickly and very opportune to bring key issues to participants' attention that the fine print in the budget document reveals. Speaking about customs and GST, there are certain significant amendments proposed in this law. Many of the amendments, particularly in GST, was anticipated, but what we were looking forward to was the exact construct of the language in the bill. And as we see this bill move forward into a legislation, we will see there are some areas, perhaps there could be some tweaking of the language to carry the address any gaps between what was the decision and what's the language employed. But otherwise, we see a lot of value in the bill provisions that we need to take away from this marathon that Taxman has put together. We'll quickly get into some of the provisions on customs law. The purpose is not to take participants through all the various clauses in the bill, but to bring to your attention certain key aspects. Of course, the question of certificate of origin, we can't miss. It's something that brings a lot of clarity by introducing some of these requirements within the statute itself. So the proof of origin has now found a specific and clarified definition in the statute. So complex transactions which were left to be determined based on international practices have now been aligned with the way domestic law looks at proof of origin and admits proof of origin. This opens up new possibilities for a lot of merchanting trade transactions reaching India, although they may origin, the origin of that supply the import may be from a specified jurisdiction. Even if it flows through a intermediate jurisdiction, it will still be entitled to the concession that we see under the preferential tariff agreements that India has with several countries. This also opens up the possibility for us to be very cautious as we claim concessional tariff on imports by examining how do we establish the basis to secure proof of origin. Now, there is also this added peril that there could be, there's a demand for transparency of gross margins if intermediaries are involved and the shipment is from a preferential tariff jurisdiction, but the transaction is with an entity located in a different jurisdiction. So that is something that jumps out of the pages that we will need to take note of. And as we find specific applications, this will sort of give us some work to do before we determine that preferential tariff is not at risk in certain transactions. Looking at some innocuous but important amendment is in section 65. As we know, warehousing has got a lot of attention, perhaps in the last 10 years, where a lot of in the name of allowing ease of doing business, we've seen a lot of change in section 65 for many, many years. Manufacturing operations in bonded warehouse was quite free from action, but suddenly we find that there is no such there have been too many changes that has come in, and yeah, Ridhima, this deliberations will not have any PPT to share, but we're going through the various clauses only. I'm only keen on sharing the implications of this. All right.
Okay, great. Please go ahead.
All right. So for many years, we've not seen any change in the provisions relating to the rules under section 65, but we find profound changes coming in the last 10 years to ease doing business. Now we've seen mover regulations also come in. Now we find restrictions flowing in by government deriving power to specify what activities are not permitted in a warehouse. for those who are involved in mover operations, it's very significant that government has sort of created an enabling proposed to create an enabling provision in Section 65 for the government to notify what will and will not form part of operations permitted in a bonded warehouse, whether it's a private warehouse or a public warehouse. This is something that is of significance for us to, at least for many years, we've worked with companies setting up bonded warehouses and carrying out operations in that, even without being an EOU, that we find that this amendment, although so innocuous, can be very significant as we go forward. We'll quickly jump to the GST amendments given in the interest of time. Clearly, we see ENA issue being addressed straight away in Section 9. So ENA is going to be addressed and kept out of the scope here. So therefore, the doubt that existed has been addressed. But significant it is that when there is an amendment in Section 9 that requires ENA, an amendment that was required to keep ENA out of the incidence of tax, this amendment obviously is going to have a bearing as far as its effective date. And if it is effective prospectively, what happens to the incidence of tax for the past, that requires some redressal. Directly on this point, we thought that Section 11A, I'll tell you in a moment about what is 11A. Section 11A that has been inserted, proposed to be inserted in the statute through this budget proposals, can bring in a lot of relief from a legislative inflexibility point of view. What do I mean by legislative inflexibility? If you see Section 9 or 11 and several other provisions, the cooperative federalism principle took away a large amount of flexibility in lawmaking that the government had exercised in the earlier tax regime. We find progressively a lot of those restrictions where prior concurrence of the GST Council was necessary before moving any amendment or issuing any notification or prescribing any rules. In several significant places, that is being diluted. But I would also like to mention that this dilution is very cautious, to see that as long as the decisions taken by the council are, the government is able to effectively implement those, in such areas the inflexibilities are being taken away. And Section 11A is one such provision where, if it has been a custom in the trade that taxpayers have historically not paid GST, or where GST has been paid at a lower rate than what the language of the legislation requires, power is now vested in the government to notify that for the past, the liability will be extinguished. That is significant because taxpayers have seen in the last several GST Council meetings where what's dubbed as the as-is circular. Circulars are issued under 168 perhaps to resolve disputes on as-is basis. That is to say, wherever taxpayers have paid the tax, no refunds will be granted, but wherever taxes have not been paid or paid at a lower rate, no further disputes will be raised by the revenue. So if you look at this approach, it seemed to be that it had become commonplace. Today we find a very solid legislative framework being put in place through Section 11A. And we will find that this Section 11A can be put to use in many instances. Past liability for ENA could be one case. Gaming disputes could be another. There are many instances that come to mind to see where Section 11A can be put to use. But yeah, after 9, the amendment proposed by introduction of the Section 11A is quite significant. Another aspect to consider is that again, seems very innocuous, nothing to be anxious about, but the language here in the provision can have profound implications. I'll touch upon two amendments that are proposed. One is in Section 13(3)(c), along with the amendment proposed in 31(3)(f). If you see here, as regards reverse charge liability, time of supply provisions were left to two criteria. now a criteria regarding the issuance of self-invoice is proposed to be made mandatory. So time of supply in respect of reverse charge liability of services is now finding a place in 13.3C, read with 31.3F, which specifies that the self-invoice that should be issued, it also says it should be issued within the time prescribed. Please bear in mind Rule 48.5, which says where e-invoice is applicable, but such an invoice has not been issued, or a manual invoice has been issued, such an invoice will be non-est in law. That's what 48.5 seeks to accomplish. So when there is a manual invoice issued, when e-invoice was applicable, that manual invoice will be non-est in law. If you consider that experience and read it in the context of 31.3F having a time limit to be prescribed, let's see what is the time limit that is likely to be prescribed. Prescribed, as you know, it's going to be prescribed in the rules. So another amendment to the rules is in the offing. Clearly, the amendment will come in after the law comes into force. When will the budget proposals be notified? Not only should the Central Act be passed by the lower house, upper house, and assented by the president, but in order for the Central Act to be notified, all states also must amend their state legislations in a mirror fashion, and on one fine day, both legislations, because GST is a dual tax, both legislations will be notified, which means we're looking at a good few months away for these proposals to take effect, and it's only after that that we will have a notification under 31.3F. What does that do? 31.3F, along with 13.3C amendment, keeping in mind 16.4 can wreak havoc as far as RCM liability is concerned. Today we have a circular number 211 that says past liability for RCM can be discharged presently along with interest, and there won't be any bar on credits. Speaking about 16.4, straight away the language of 16.4 does not accommodate RCM or import payments. However, through this circular, some teeth is sought to be given for RCM to also get covered by 16.4. So that itself will be a bone of contention. But if we move from there to look at what 13.3C and 31.3F amendment read with 16.4 can cause, it can only bring in a outer limit for belated returns. What does it mean? With circular 211, self-invoice can be issued belatedly and taxes discharged along with interest. Credit will not be restricted. But today, but tomorrow, when all these amendments are in place, and if the time limit to be notified is in line with 16.4, we will find that the last date to issue a self-invoice also will be November 30. When the last date to issue self-invoice is November 30, RCM tax will be recovered subsequently, because RCM liability cannot be forgiven just because self-invoice was not issued. But RCM discharge subsequent to November 30, the self-invoice may find that we may find that self-invoice issued after November 30 is non-est in law. So then we will find that the recipient will not be entitled to credit for defaulting on 16.2A. I'll just leave these four provisions on the table for you to please contemplate on that and consider the profoundness of the implications we see coming in through these two amendments in section 13 and section 31 of CGST law. The next amendment we will look at, of course, we have to talk about 16.4. 16.4 relief has not been as elegant as I would have liked to see. I'll tell you why. 16.4 clearly deals not with belated returns, but with stale credits. Invoices that have been omitted in spite of returns having been filed is what 16.4 should cover. But returns filed belatedly with late fee enjoy curative effect on payment of late fee. But this amendment seeks to disturb that meaning that is emerging plainly from the language of the law as it currently exists. What is this amendment that is proposed? This amendment proposed basically says that if anyone has filed returns belatedly, but not later than 30th November 2021, any delay in filing returns and consequently forfeiting credit, that credit will now be admitted as valid and proper. Three situations exist today. Taxpayers who have got notices and have paid the credit, have reversed the credit or discharged that liability along with interest and or with penalty. Situation where taxpayers are currently dealing with notices, and situation where taxpayers are in appeal in respect of these notices. In all three situations, remedy is available only for case 2 and 3. Remedy in the first case is not available because anyone who has discharged the tax cannot be refunded any amount of money that they have discharged. Please bear in mind, you cannot claim refund in the context of 16.4 is different from the context of 128A, which I will come to in a moment. Please be mindful. If 16.4 recognizes that credits claimed within 30th November 21 is valid and proper, and someone has discharged this tax, option to file refund cannot be ruled out. So taxpayers who have discharged the tax, that is use case number 1, taxpayers are advised to please evaluate the feasibility of filing refund, because 16.4 relief that is provided in 16.5 is not lost, unlike the relief that is sought to be introduced via section 128A, which I will discuss in the later part of this evening's deliberation. Next, another important aspect. I'm only sensing that this is first of several. Section 16.6 sees a proposal where taxpayers whose registration was cancelled and on account of cancellation could not file returns and therefore were hit by 16.4, when their registration is restored, in such cases, if they were to file all outstanding returns within 30 days from restoration of registration, they will not be denied any credit in terms of section 16.4. Two aspects to consider. One, 16.6 should have commenced with a non-obstant clause because it operates as a proviso to 16.4 and not as a standalone subsection. So in the construct, there is some refinement that may be warranted. Secondly, if 16.6 is in fact a exception to 16.4, what about 8 or 9 other exceptions that are required? I'll give you one example and I will move on in the interest of time. Clubs and associations were made liable to tax only and only because of an amendment introduced in 7(1)AA, effective 1/7/17, notified 1/1/22. So therefore, 54 months of credits need to be claimed by these clubs and associations when they file their first returns. Will they be hit by 16.4? It cannot be, because credit cannot be denied, because the incidence of tax on clubs and association comes up only because of a retrospective amendment. Where is the corresponding saving clause in 16.4? So like this, there are other 7 or 8 more exceptions that merit to be introduced in section 16. So we only have to find that the government has very gracefully accepted the need for 16.6. We are very thankful for that. We need 7 or 8 more such exceptions to be created. This goes only to show that 16.4 is now going to operate as what's called an extinguishing prescription. Very quickly, what is limitation? What is prescription? Limitation takes the remedy but leaves the right undisturbed. Prescription takes away the right itself. So therefore, this debate about vested and indefeasible right versus concession, etc., needs to be resolved. But there's a lot of work in section 16. I'll bring your attention also to another amendment in section 30 that is proposed. Very innocuous, easily overlooked when we are going through the proposals in the bill. But section 30 is very significant because revocation of cancellation is now made subject to conditions to be prescribed. So please bear in mind, someone's registration may be revoked. Someone's registration may be revoked. Revocation is not done in appeal. Revocation is done by the proper officer. When revocation is being done, new conditions are sought to be introduced. What could be those conditions? Section 16(6) could become one of those conditions. If someone wants revocation, please be very vigilant. I'll give you another aspect to consider. Registration that is cancelled without going for revocation, can someone file an appeal for restoration? Please consider this possibility. If you go back to the proper officer for revocation of cancellation, you're hit by the condition in section 30 to be introduced. But if you bypass revocation and go to appeal for restoration, you might be saved by the operation of section 16(6). Please consider that as you evaluate the possibilities that can come because of that. A brand new section, 74A. I will go into what 74A is in just a moment, but consequential amendments, when I saw the list of sections that have been touched by the finance bill and saw 61, 65, 66, the entire chapter being touched, I was immediately drawn to looking at what the bill provisions contain. But the only amendments that we see in the whole of that chapter deals with including reference to section 74A, wherever references were limited to 73 or 74. So now to look at some of these related references, we'll talk about some of the key amendments that are being proposed related to section 70. 70, as you know, friends, is a power to issue summons. Let me also bring this to your consideration. Please read section 70, subsection 1. The authorization referred to in subsection 1 of 70 does not have a rule or a form in the statute. Please consider that 70 is an aid to 67. So INS1 and INS1 alone is the authorization for proper officer to issue summons. The two remarkable things I find here. One is that a new subsection 1A is sought to be introduced in section 70 to say, when a person is summoned, the person is bound to appear. Remarkable for the reason, as if when a person was summoned, he had a choice not to appear. Secondly, 1A proposes to permit an authorized person to enter appearance when summons is given to a different person. This greatly dilutes the severity, seriousness, and importance of summons. Summons have to be attended by the very specific person. As you know, different people have had different experiences, but in many parts of the country, summons have been issued without any authorization. And when you question the correctness of the authorization, you found that those responses, those investigations were abandoned. So please consider section 70 with some amount of discernment, because nothing new can be achieved by introducing certain severe language in subsection 1A to section 70. The next aspect to consider is the whole construct of 74A, 74A requires very careful study. Very quickly, if I have to bring to your attention what is 74, no new jurisprudence. I've spent a lot of time trying to update the publication of Taxman quickly based on this new section. No new jurisprudence. The only aspect that comes up is that time limit under 73 was 3 years, under 74, 5 years. Time limit under 74A is now 42 months to issue notice, 12 months to pass an order, that's 54 months, 6 months extension permitted for passing this order for sufficient cause, which means 60 months becomes the limitation, and we'll have to only contend with that. The whole of the safeguards for taxpayer in section 75 applicable under 73, 74 has remained undisturbed. Please pay attention. 73, 74 will stop being used if the demand pertains to 24, 25 or later, which means for the next 4 or 5 years from today, 73, 74 will continue to be in force. We have to continue to expect notices under 73, 74 for the next several years before 74A starts to take effect. Moving on from there, important reference, definition of suppression in 74 is at the end of section 74 is sought to be omitted, and a new section's definition is sought to be introduced at the end of section 74A. Remarkable change in the language, but no new jurisprudence, because the safeguard is that even if that were to be considered suppression in the new definition, evasion of tax still has to be discharged to established by revenue. Moving on very quickly to other amendments. GST Appellate Tribunal, a lot of attention, a lot of refinement in the language, because GST Appellate Tribunal is around the corner. We can see it take shape in the next few months. Anti-profiteering orders are set to be left with the principal bench of the tribunal for adjudication. It is remarkable that adjudication is now going to be with the second appellate forum in GST. A lot of questions as to whether this is the right forum, because there's a very long-standing principle called the Leary principle. When a taxpayer has a right to fair trial and a right to appeal, taxpayer cannot be expected to make do with a fair appeal without an adequate adjudication process. Here, adjudication itself is left with the second appellate forum, so there's going to be questions surrounding the validity of this. Tribunal, what is the limitation? Previously, we had seen tribunal to be notified and president to enter office. 3 months limitation to commence from that date, but now it is the time to file the appeal is extended by 3 months or the date notified by the government, whichever is later. So there is going to be a reprieve. Limits of upper limits for pre-deposit reduced marginally from 25 crores to 20 crores each. I say marginally because those who have such significant demands don't find this reduction very significant. But what is significant is that the additional deposit of 20% in the tribunal has been reduced to 10%. So please consider a significant amendment made in Rule 142(2)(b). This rule has already been notified by 12/2024 notification, 10th July 24. Please see Circular 224 makes it mandatory for all those who have made pre-deposits in first appeal, waiting for second appeal due to recovery action, made payment due to court direction. For whatever reason, please read Circular 224 regarding the procedure under 142(2)(b) made applicable for all pre-deposits made via DRC3. Please bear in mind, this circular further goes on to say that awaiting the tribunal's decision, tribunal's constitution, taxpayers need to do two things. First, give an undertaking to the proper officer that you wish to prefer appeal before the tribunal to make pre-deposit. How do you make pre-deposit? There's a process specified in the circular. It's not DRC3, mind you. It's directly go into the services module of the portal and make this deposit to declare your intention. It's an affirmative action that you wish to carry the matter in appeal. Amendments have been made consequent to these changes in IGST law and the compensation cess law to make provision for similar to 11A in the Central GST Act. So please bear in mind, profound changes, very, very significant long-term implications, many of them to refine the due process, bring small changes, but significant in the bearing that it can have as far as how this needs to be done. Interest provisions, multiple effects being given to these provisions. Please be very, please give it the time needed to go through these amendments, because the implications of this can be very profound as we wait for the budget proposals to get enacted. And that is going to be very interesting before these new provisions take effect. Over to you, Ridhima.
Okay. Thank you very much, Jatin. This was much anticipated and in-depth analysis. Just give me a moment while I take few queries, if you allow me.
Yes, please.
Just 1 second. So this first coming up is, I'll take quickly 2, 3 of them. Can the taxpayer take the benefit of waiver under Section 128A for SCM in DRC 1 for the first year and go to appeal for same matter raised in statement in DRC 2 for another financial year?
Absolutely, absolutely possible. Every notice is the boundaries of the list. Taxpayer is welcome to pursue whatever remedy she feels serves her interests best in a given matter.
Okay, great. And another one is pretty interesting on Section 128 only. So Section 128 provides that the benefit of waiver would be available only where any tax is payable by the person. So in case where the demand is of interest or penalty is there, would it be covered under this section? If not, would it not be unfair for such taxpayer who has paid tax and only interest was not paid?
Every dispute resolution scheme in the statute by way of policy is bound to be unfair to somebody or the other. We cannot expect equity in a dispute resolution scheme proposed by the government.
Can they take a plea that the benefit is not available? Can't they do that?
Absolutely, no question about it.
Okay. Any other important query? Just 1 second.
And mind you, on 128A, if the revenue were to carry the matter in appeal or revision and an additional amount becomes payable, that too will be payable. So therefore, 128 relief has to be pursued with a lot of care and attention. It cannot be something that can be blindly followed just because it brings an end to litigation.
Correct, correct. Just last one of the lot. So in the amendment made in Section 17, subsection 5, to remove restriction of ITC on tax paid under Section 74, what is the purpose of adding the year 23-24 specifically? Because as Section 74 itself is restricted till financial year 23-24. This effect would have been automatic, right?
I suppose we have to pay attention to what will happen to the liability discharged through a demand under 74A. Please bear in mind, with 16.4 now firmly planted, with support of 16.6 and 16.5 and 6 inserted, as far as the interpretation goes, it is very clearly possible that all demands which are not discharged, all liability that are discharged, whenever it's pursuant to notice of demand, credit will be lost. Particularly with the amendments to 13.3C and 31.3F, RCM is the one of interest in 17.5I, credits will still be lost.
Correct. And one I think is in the Zoom chat box here. We have paid taxes, filed appeal for interest and penalty. Can we avail the amnesty?
Yes, yes, of course, of course. The requirement is that that has to be withdrawn, and 128A permits bringing quietus to this dispute by discharging the liability and withdrawing the appeal.
Okay. Sorry, one more coming in. If the time to file the appeal before tribunal has not expired, can the department initiate query recovery?
Absolutely. Please follow Circular 224. Make the pre-deposit, file the undertaking. Even if someone is planning to take the relief under 128A, please bear in mind 128A is only a bill proposal. It's not yet law. File your appeal. Keep the matter alive. The vaccination is on the way. Please look after all patients.
Amazing. Thank you so much. Thank you so much, Jatin. It is a wonderful session indeed.
Thank you very much. Thank you very much.
Thank you. So for the final essential session of the evening, which you surely can't miss, we are pleased to welcome Mr. Vinod Kothari, partner at Vinod Kothari and Company. He will provide an in-depth analysis of changes in corporate laws, financial markets, and capital markets. Mr. Kothari, a fellow of the Institute of Company Secretaries of India and associate of the Institute of Chartered Accountants of India, brings over 35 years of expertise in corporate law. He is renowned authority on company law and has been specialist editor of Ramayya's Company Law. His notable publications include Understanding Companies Act 2013, Guide to Independent Directors and Corporate Boards Committee, and Policies under Companies Act 2013. As a consultant, Mr. Kothari addresses a wide range of corporate law issues and advises leading companies nationwide. He frequently speaks at forums on topics such as related party transactions, CSR, and secretarial audit. His lecturing experience spans numerous countries, including the USA, UK, Italy, Germany, UAE, Singapore, and more. A very warm and cordial welcome to sir. The platform is now yours to lead.
Thank you very much, Ridhima. Thanks a ton. I would just put my screen on so that we are able to structure this a bit. But let me first start by thanking Taxman for giving the opportunity, and let me congratulate all the marathoners who are running this long marathon. As in case of every marathon, the sturdy and the hardy are the ones who last till the end. So I'm sure those who all are still staying back today are the hardiest and the sturdiest of the lot. And I'm sure those stay till the end of my presentation would probably be awarded by Taxman as the marathon winners. And like the previous speaker just mentioned, vaccination is on the way. So I think in my case, all I would say is that some bit of water, some bit of refreshments are probably on the way. So please do hang on and stay for this presentation, which would capture some significant budget proposals, which might impact the corporate sector, which might impact the economy in general, and which would generally be of interest to everyone. So let's get this started straight away because it's been a very, very long day for you. And this is what I'm going to talk today. I'll start with the provision dealing with share buybacks. I'm not sure, and I definitely can imagine that somebody during the day might have talked about it.
Yeah.
My perspective would be correct, Ridhima. My perspective will be still a little different, and therefore I would still want to talk about it because this is something which is going to impact the corporate sector. And I would say among all the provisions of the budget, this one can actually be singled out, and I'll explain why. And then we'll talk about the internship scheme that companies may participate. This is quite a lot talked about, something which will generate 1 crore jobs over the next 5 years. Huge job creation opportunity, but what exactly does it mean to the corporate sector? What does it mean to the country? We'll talk about that. And then another provision which was talked by the finance minister during her budget speech was variable capital companies. What are they? What do they mean? What would they result into? Subvention of educational loan, not likely impact of the subvention scheme. We would obviously not know the details of any of these schemes, but these schemes would obviously be launched after the budget is approved. But we have some cues from similar subvention schemes in case of home loans. So let's talk about what do they mean. Very, very important provisions for SMEs as self-financing credit guarantee fund, and then guarantees for loans to SMEs which are tagged as what you call special mention accounts. What do they mean? And then we little mention about the amendment of section 47 of Income Tax Act dealing with gifts. It now restricts to gifts by individuals, and therefore what happens to gifts to companies? Is there a likely impact on companies because of that? Let's talk about that. And finally, we will talk about the important change about fund management entities out of International Financial Service Center, so-called GIFT City. What impact will it have on the fund management industry? But let's first get started with the provisions on share buybacks. I said this is a one budget proposition which can be singled out of the entire budget. The rest of the entire budget is extremely development focused. There's absolutely no doubt that the entire budget, you could probably have difference of view when it comes to taxation on capital gains. And I'm sure speaker after speaker today might have, had some things to say, less good things and more less good things about the taxation on capital gains. The entire capital market probably feels hurt on these changes, but there might be a viewpoint because remember that this was talked about in the economic survey as well. If somebody cared to read chapter 2 of economic survey, there were indications. The government is not very happy with the huge amount of young individuals investing in stock market, particularly those investing in derivatives. So as regards changes in capital gains, well, I'll reserve. I don't have opinions. I'm not intended speaker on this topic. So I'll reserve my comments on that. But the rest of the entire budget is extremely development focused, be it educational loans, or be it the provisions for SMEs, or be it provisions for farmers, something that talks about 1 crore farmers being encouraged through natural farming. Provisions dealing with the production linked incentive scheme, which is also supposed to be broadened. Provisions about liberating FDI, whole amount of provisions which are extremely visionary, far-reaching in impact, which are foresightful. However, in the midst of the entire scheme of the budget, this is something one gets surprised. Where did this come from? Who advised the finance minister? I'm not sure what was running in the minds of those who advised the finance minister on this provision. Now, innocuously stated in the finance minister's speech was there was a recommendation from SEBI's working group that the taxation base for share buybacks may be shifted from companies to shareholders, which is actually true. There was a recommendation from a SEBI group that the current taxation base, where the companies pay tax on share buybacks, the tax is paid on behalf of the shareholders. Shareholders don't pay the tax, the companies pay the tax. That is inequitable. Why inequitable? Because those who are staying back in the company are paying the taxes. Those who are going away are getting a tax-free income. So supposing I am the one going out, I'll probably get a tax-free income. The one who's staying back is paying the tax. That's the inequity part. But did the SEBI consultation paper ever say kill the entire scheme of buybacks? But what's actually proposed is no short of a death sentence to share buybacks, which is why we said it's now bye-bye to buybacks. Buybacks will, unless the finance minister buys back the proposal, rolls back the proposal, it would simply be a bye-bye to buybacks. The buybacks will cease to exist because, as I'll just demonstrate, the entire economics of share buybacks is completely gone. First, let's try understanding a little bit of history, and I don't think history is of great interest to everyone, but let me very, very quickly say these provisions were there since quite some time. 2013, buybacks for unlisted companies were introduced. In 2019, they were extended to listed companies as well. 2024, the present changed. The three sections which actually matter: 115 QA, which is the present section dealing with buybacks; 115 O, which is dealing with dividend distribution by companies; 10 by 34A, under which shareholders get exemption; and section 46A, which talks about capital gains to shareholders. These are a bunch of sections which are impacted. We did mention about the SEBI consultation paper. That consultation paper is fairly recent. It talks about aligning regulatory requirements with the changing market dynamics so as to enable efficiency of the buyback process. It's not talking about introducing a complete deadlock to buybacks. It's talking about making it more efficient, making it more equitable, making it more aligned with the objective of promoting buybacks. So all this consultation paper was basically for promoting buybacks. And it recommended shifting of tax base, which is what I mentioned, from the company to shareholders, because that is more equitable, as those who are going out, those who are receiving the money, are the ones paying taxes, not those who are staying back in the company. But those are ones who are anyway not receiving the money at all. Now, I said this is a provision which is completely going to kill buybacks. Before we get into that, let's try understanding, is there any kind of an offense? Is there any kind of a foul intent or a tax planning gimmick or some kind of illicit or unfair use of share buybacks by companies? True that every provision of taxation law can be misused or exploited by companies. And we are all aware that there are very large companies which have come up with schemes of arrangement under which bonus preference shares were issued. Probably the preference shares are intended to be bought back or redeemed. And that might probably be some tax arbitrage opportunity there. But in general, was share buyback being used by companies as a kind of a tax planning gimmick? It doesn't make sense. It couldn't have made sense. Why? Because the tax rate itself, when a company does a buyback, and on the buyback, the company pays excess over the issue price. What actually happens? The company buys back the shares. The company pays the fair value of the shares. The fair value of the shares may be higher than the issue price. And if the company pays the fair value, which is higher than the issue price, then the excess, that's what is taxable, the excess, that is the excess of the price paid on buyback over the issue price, suffers tax in the hands of the company at a 23.29% tax rate. The company pays 23.29%, which is almost like the tax rate which might be applicable to shareholders in general. The company pays it on behalf of the shareholders. Don't pay it, the company pays it. Now, with 23.29, roughly 23.3% tax rate, was there a possibility of tax arbitrage? Were we envisaging that this structure is being exploited by companies to create some kind of tax revenue leakage? Because the tax to be paid by shareholders, the shareholders reported tax on their respective income. Shareholders would probably be liable to pay tax at differential rates. Some of them probably would be smaller shareholders. They may not even be taxable. Some might be taxable at lower rate. In any case, under the alternative scheme, the maximum marginal rate itself is quite low. So 23.3% couldn't have been any kind of a revenue leakage for the government. Therefore, the intent couldn't have been to plug some kind of a tax avoidance device. The intent was simple. It was to shift the base to make it more equitable, which is what the finance bill actually explains it to be. But in the process, now try understanding what has the government done. The government now says what? Whatever amount the company pays on by, therefore, imagine if a share was issued by the company, say with a par value of 10 rupees, the issue price was say 50, and the company now buys it back for a price of 80. Par value 10 rupees, issue price 50, the company buys it back at a price of 80. So what is the gain the shareholder is making? The shareholder is making gain of 30 rupees. That 30 rupees was earlier taxable in the hands of the company. Now what happens? The entire 80 rupees paid by the company will be deemed to be dividend in the hands of shareholders. The shareholder paid 50 rupees to buy the share. He gets 80. The government says, I'll take the entire 80 as your income. And now this 50 rupees that you paid, I'll treat it as a capital loss. Then this is what you're trying to say is that I'll tax your capital first. Because I'm taxing the entire 80, so I'm taxing not just the profit, I'm taxing your capital also. And given the fact that I'm taxing your capital, I'll allow you capital loss of the 50 rupees. When do you claim this capital loss? You claim the capital loss only if you have capital gain. If you have a long-term capital loss, probably you'll claim it over the next 8 years. If you have a short-term capital loss, you'll probably claim it only in just about a few years. So in a sense, the entire money distributed by the company becomes income in the hands of shareholders, breaching every fundamental principle of taxability of income. I think let's try understanding that it's unarguable, and probably no one could probably think of any dispute on this. Unarguable fundamental principle of taxation that a taxpayer can be called upon to pay tax on his income. No taxpayer can probably be called upon to pay tax on his capital. His own capital coming back to him. Where is the question of tax on that? In the example I gave, I got 80 rupees, whereas I paid 50 rupees, but I'm paying tax on 80 rupees. Next question, assuming that I paid 50 rupees and the company returns me 50 rupees only. In other words, I'm not making even 1 penny of profit. Even then, I'll be paying tax on 50 rupees. Take a even worse case. Supposing the company has lost money and the company is now buying back shares at a price of 40 rupees. I paid 50, the company is buying it at 40. I am therefore incurring a loss. However, the government would still say, pay me tax on 40 rupees. And you can claim this entire 50 that you paid as a capital loss, assuming you have a capital gain. They cannot be higher in equity than that because this is completely inequitable. I'm almost certain that the provision will suffer some kind of rollback, some kind of turn back, some kind of boomerang on that, because if the provision stays the way it is, it's a height of fiscal inequity. Now, this is what the government has therefore done in terms of buybacks. Now, if you were to say, is buyback commonly done by companies? Almost everyone connected with the corporate sector in any manner, large companies, small companies, startups, any kind of companies, would completely agree that buybacks are fairly common. Buybacks are extremely common across the country. I mean, the extent of buybacks by listed companies also quite a lot. Even in case of unlisted companies, data would be available for listed companies, but in case of unlisted companies too, buybacks are quite common. Why do buybacks happen? First, understand, buybacks might be devised to distribute the company's profits. Like companies may distribute profits either by way of dividends, or companies may distribute profits by way of buybacks too. In case of dividends, there are some restrictions because I can distribute only the profits. In case of buybacks, not only can I distribute profits, I can also distribute the share premium. In fact, in certain cases, I can even do a buyback by issuing fresh capital. So I can issue a fresh capital and do a buyback out of fresh capital as well. So buyback is number one, an important alternative device for companies to distribute profits. More important than that, because profits can be distributed by way of dividends also, but more important than that, companies also use buybacks to scale down their size. See, the important point in case of companies is that unlike partnerships, unlike LLPs, where capital is flexible, in case of companies, capital is fixed. There's no way to reduce capital. In order for companies to reduce capital, the only option available to companies is to use buybacks. In what way can buybacks be used to reduce capital? I can do a buyback of 10% of company's net worth in a financial year merely by passing a board resolution. I can go up to 25% by passing a special resolution. So what mostly companies do is do a 25% buyback in a financial year. Next year, once again, then they can do another 5%. This way, companies can scale down. No one can ever argue that once the capital is introduced in a company, the capital may not be needed. I have brought capital into the company, but then I realized that I don't need so much capital for the operation. So I might want to scale down the company's operations. So buyback is the most flexible way to scale down the company's operations. The only other way, I'm extremely emphatic when I say the only other way for companies to scale down their operation would be to do what is called reduction of capital, which is an extremely tardy process because number one, it requires me to obtain shareholders resolution. Number two, it needs me to go to creditors also and take creditors resolution. Number three, I need to go to NCLT and spend a good number of months to get the NCLT's approval. Buyback, therefore, reduction of capital is not at all a flexible or convenient way, whereas buyback is the most common method for scaling down. That's part one. Part two, buybacks are also very commonly used to allow exit to specific shareholders. Therefore, if I have a bunch of shareholders in the company and I want to allow exit to some while not giving exit to others, companies do buybacks even to provide exits. Many people familiar with venture capital world would also understand when strategic investors or venture capitalists, private equity investors invest money in companies, they have a clause, they have a shareholders agreement saying after X number of years, the company allows the company does what you call a put option. The company grants a put option whereby the company will be ready to buy back the shares of the venture capitalist, of the strategic investor. Now, if buyback results into tax on the entire capital, the entire flexibility of allowing exits to private equity investors or venture capitalists or any kind of strategic investor is once again completely frustrated. Third situation, if the company has issued a compulsorily convertible debenture or compulsorily convertible preference share, there also buyback is only way because it's not possible to do a buyback of something which is compulsorily convertible other than by using section 68. Now one might still argue that if it's a buyback of debentures, maybe the new provisions may still not be applicable because the provision talks about buyback of shares, and therefore technically it will not be applicable to buyback of compulsorily convertible debentures. That's something that companies may still exploit to a certain extent, but the way it stands, the way it's now structured, companies would find it extremely difficult to use buyback as a device for distribution of profits, because as you can see in the tabular comparison on screen, if I have two options, buyback of shares versus dividends, you can see that two ramp up extremely badly. You can see here, look at buyback and look at dividends. And as far as dividends are concerned, dividends are only out of profits. I can pay dividend only out of profits, whereas buyback can be done out of paid up capital and free reserves. Source of distribution in case of buyback can be profits, premium, or proceeds of a fresh issue of securities as well. In case of dividends, it can be only out of profits. Timing, buybacks can be done anytime during the year. Dividends are typically done end of the year. Of course, interim dividends are allowed. Approval up to 10% board resolution, up to 25% shareholders resolution. Dividends can be only board power. Impact on the shareholder, if the company does a buyback as per the new provisions, the general impact of buyback is that holding, the number of shares held by shareholders comes down. Whereas dividends is merely distribution of profit without impacting the base of the company's capital. Taxability as per new provisions, the entire amount paid by the company becomes taxable. In case of dividends, only the profits. Uses, therefore, buybacks could have been used for scaling down. Dividends are not used for scaling down. Dividends are merely by way of distribution. Now, in case of dividends, the company remains free to issue securities further as well. But in case of buybacks, the company becomes liable not to come with any fresh capital issue over the next 6 months. Now, 115 QA has existed, versus section 222F, which is sought to be inserted now. The tax is supposed to be paid by the shareholder. Taxability tax rate will be as per the rate applicable to the shareholder. Under the earlier provision, there was no question of any capital loss or capital gain by shareholder. Under the new provision, shareholder will be allowed to claim the cost of the shares as capital loss. And of course, the scope of applicability, earlier provision referred to buyback under any provision of law, whereas section 222F refers to buyback under section 68 only. Before moving to the next provision, let me just quickly talk about some lurking questions on buybacks. First question, when will the provision be applicable from? As the finance bill very clearly says, this provision would be applicable from the 1st of October. Now, this applicability, is it based on declaration or decision of the company to buy back or actual distribution of money by the company? In our view, if the language of the law remains the same, I'm almost sure the language will not remain the same. And I cannot be forecasting this, but legitimately, reasonably, the provision will go for some tweaking for sure, because as it stands, it's extremely inequitable. But the provision remains the same, then because the taxability is on payment made by the company and the date is 1st October, therefore, as long as the payment is received by the shareholder before 1st October, it would be taxable under the earlier scheme. From 1st October, the payment received by shareholder will become taxable under the new provision. Does redemption of preference shares also come under the provision? This has been a lurking question quite earlier. People have quite often argued that redemption of preference shares is also one way of buyback. And therefore, why would this not be covered by section 68? Or why would this not be covered by section 115 QA? In our view, I think, and the provision is now quite clear because it refers to section 68 specifically. Redemption of preference shares does not happen under section 68. It happens under section 55 of the Companies Act. 68 is question of buyback. Redemption is simply redeeming. The preference share was redeemable. It's redeemed. Means it's paid out. It's not a case of buyback. Buyback is for something which wasn't supposed to be redeemable. I buy it back. I cancel it by buying back. Redeemable preference shares are redeemed. That's merely a satisfaction of the obligation to pay money out. Not a case of buyback at all. So the doubt about potential applicability of section 115 QA to preference shares does not persist, does not apply in case of section 222F as proposed to be added now. Next question, can companies now, given the fact that the companies still have roughly about 2 months, can they still quickly finish a buyback and still escape the new provision? In our view, the answer is very clearly yes, because you have 2 months still to go. And if everything is done in good time, an unlisted company can finish buyback in couple of 2 to 3 weeks time. Listed company can still do a buyback in less than about 1.5 months time because it will need shareholders resolution. You can probably speed up a postal ballot, take shareholders resolution. The entire process can still be done so as to finish the buyback before end of September. Another question which is quite significant is rest of the scheme of section 222 talks about distribution. Section 222, I'm sure as you understand, is relating to deemed dividends. What can the company distribute as dividends? Obviously the profits. 222A to E all talk about distribution. It's only the new clause F which talks about payment by the company. Distribution means what? When the company has distributable profits, it does distribution. Distribution of something which is distributable. But remarkably, section 222F talks about payment, and the government has also given an illustration in the memorandum explaining the provision, where the government itself clearly says the entire amount paid by the company will be taken as dividends. So one cannot read the provisions of clause F in light of the rest of the provisions of section 222 and limit it only to the profits. It would be applicable to the entire money paid. So this, as I mentioned, is a provision which can be singled out as something which is complete, which stands out of the entire scheme of the budget. Let me now quickly come to some other provisions which might be of interest. Let's first talk about the internship scheme. This was talked about by the finance minister. It's been talked about ever since the presentation of the budget. It seems to be an extremely benign, innovative, visionary idea of encouraging companies to take interns. These interns are employed in companies. They work for companies as interns. Companies get good young people to work for companies as interns. The best part is 90% of the cost is paid by the government. Now imagine the extent to which the government is committed to spend money. 90% of the cost of internship is paid by the government. How much do we pay to the intern every year? We pay 5,000 per month. So we pay 60,000. Plus we pay an additional joining fee of 6,000 rupees. 90% of both. That would be out of the entire thing, roughly about 60,000 is paid by the government and only about 6,000 rupees is paid by the company. The interns obviously work for the company. They are trained in the company. Details of scheme are yet to be, some details are available, for example, who can qualify to be an intern. Those details are there though. But rest of details are still work in process. Of course, it will be out only after the budget is approved. But the government is talking about top 500 companies. Now, look at the data and try understanding how does the maths work. We're talking about 1 crore jobs over 5 years. For a minute, assuming that we divide 1 crore by 5 equally, it's definitely not going to be equal because the annexure to the bill also talks about phases, phase 1, phase 2. It's not equal therefore. But for a second, let's take it equal. 1 crore divided by 5 is 20 lakh. How many companies participate? 500 companies. So assuming every company takes equal number of interns, we're talking about how many? 4,000 interns each company. Virtually impossible. But I can't think the biggest of the companies in the country engaging 4,000 trainees in a year. And for 1 year, remember. It's not going to be a 1 month internship. It's not going like 15 days internship. It's going to be 1 year long internship. 4,000 new interns over a year, almost an impossibility. I'm not sure how is the maths works. We don't know. Now, the best part is that the government has targeted. What is the government's budgetary allocation on that? The government is targeting 19,000 crores over 2 years. If you look at the annexure to the finance bill, it's talking about for the first phase, which is year 1 and year 2, 19 crores of budget allocation. By way of the government's 90% contribution, government will be incurring 19,000 crores. Rest of the money, which is paltry 1/9 of that, just about a smaller portion of that, that would be incurred by companies. And that amount also companies may take it from the CSR fund. Now, the irony here, and see, this is ironical, extremely benign, innovative scheme, but there is something probably missing somewhere in the construct, unless you're missing some details. A, taxpayers' money, your money and my money, to the extent of 19,000 crores is spent by the government. For whose benefit? The interns work for who? The interns, of course, that's extremely, I would say, developmental. 1 crore young students get jobs. Very good. So we are giving jobs at taxpayers' cost. That's perfectly okay. But who are the interns working for? They're working for the likes of the biggest companies. They're working for the top 500 companies. They work for companies. Companies pay 10% of the money. 90% is paid by Ridhima Bhatia and Vinod Kothari. So is this a good use of taxpayers' money? That's the first question. Second question, given the fact that companies have been permitted to use CSR funds for this, to my mind, the best and easiest way would have been the entire cost of internship. If the government permitted the CSR funds to be employed for the internship scheme and opened the scheme to all companies which are liable for CSR. How many companies are liable for CSR, by the way? Not less than 5,000 companies. Probably number would be more. I don't have ready data, but not less than 5,000 companies are liable to spend on CSR. Where do companies spend the CSR on? I mean, the companies go spending on all kinds of stuff. They spend it on cattle. They spend it on building some houses for the police, etc. They spend on weird things. If companies were permitted to use CSR funds for engaging interns, companies will be happy. Interns would be happy. The country would have generated employment, and we would not be burning a hole on taxpayers' pockets. So this is something which might need to be reviewed. Though I would say the scheme as such is quite benign and benevolent, but then something missing somewhere. I'll very quickly talk about some of the other provisions that wouldn't take me very long time. I know the marathon has been very, very long for you. Variable capital companies. This was talked about by the finance minister. Variable capital companies versus fixed capital. Every company by definition is fixed capital company. The companies that we have currently are not variable capital. They are fixed capital companies because once you introduce capital, other than the buyback that I talked about, there's no other way to reduce the company's capital. companies have fixed capital. LLP is a variable capital. Every LLP is by definition variable capital entity. Variable capital companies exist in many jurisdictions, particularly the so-called light regulated jurisdictions. Variable capital companies, for example, exist in Singapore, they exist in Mauritius, they exist in several lightly regulated jurisdictions. Their use basically is for forming what is called special purpose vehicles. Currently, because companies have fixed capital, and if we use the company form of SPVs, like in case of most real estate companies, we have SPVs holding properties. The problem with SPVs is once you introduce capital, the capital becomes fixed. It can't be withdrawn. We can't draw the capital out. A variable capital company will have two features. Number one, it will have multiple cells within a company. Multiple cells in a company. Therefore, it's one entity with multiple cells. You can see the picture on the right hand side here. One company with sub fund 1, sub fund 2, sub fund 3. There are various funds or various corpuses, various corpi within the company. Each of the corpi are mutually protected. Therefore, these entities are also called what is called protected cell company. They are also called protected cell companies because every cell is protected against the other. The uses of some protected cell company means that each cell is protected against the other because the assets and liabilities of each cell are distinct. Unlike in case of companies where everything gets commingled into a single entity, in case of PCCs, protected cell companies, every cell is mutually protected. That's part one. Number two, the capital is variable, which means based on conditions, the capital can be withdrawn too. This structure has been suggested by Dr. M.S. Sahu at the instance of IFSCA. The report of Dr. Sahu's committee is available on IFSCA website. Anyone can see it. And incidentally, Dr. Sahu has talked about VCCs today as well. So in a sense, I'm expecting that VCCs will be introduced out of IFSCA, out of IFSC. I'm not expecting variable capital companies to be introduced within the rest of the country. It probably would stay limited to IFSC. And given the fact that it's limited or intended for IFSC, quite likely it would be relevant only for investments outside India. If it's money coming into India, it probably would be taken as money coming by way of from non-residents. Given the time, I would very briefly say that there's the subvention scheme for educational loans. This is again a very, very benign, extremely innovative idea. The PM has been talking about this. Why do we send students overseas when we have world-class educational institutions in the country? Therefore, up to a limit of rupees 10 lakhs loans for studies in domestic educational institutions to a limit of rupees 10 lakhs, the government will provide 3% subvention. Currently, the government is paying 3% interest rate subsidy under home loans as well, under the so-called Prime Minister Awas Yojana PMAY scheme. Similarly, for educational institutions as well, for studies within the country, educational loans. So who are the beneficiaries? Students, of course, are biggest beneficiaries. Indian and educational institutions would be the beneficiaries. And of course, educational loan companies, companies which grant student loans, they'll also be benefited. There are two provisions for small and medium entities which are extremely relevant. Number one, a self-financing scheme for guaranteeing SMEs. Currently, SMEs are guaranteed by SIDBI. SME guarantees, banks giving loan to SMEs are guaranteed by SIDBI. But the government is proposing a self-financing scheme. From whatever details are currently available, the structure might be something like this. Several SMEs contribute a guarantee fee to a particular structure. This structure now forms a particular corpus. From this corpus, a lender, which is giving a loan to SMEs forming part of the structure. This is what you call a pooled structure. So everyone forming a part of the pool will be benefited by the guarantee. The guarantee will be given by the guarantee fund from out of the monies collected from the SMEs itself. Becomes a kind of self-finance. It's almost like a mutual scheme. It becomes a kind of mutual scheme because insurance also started as a mutual scheme. Similar idea of several SMEs contributing their guarantee fees to a scheme, and the scheme then gives guarantees to a lender, which is giving a loan to SMEs. Very quickly, the government is also proposing that if SMEs, because of difficulties, were tagged as what is called special mention account. Special mention account is something which is not a non-performing account, something which is up to 89 days of default. The SMEs, small and medium businesses tagged as special mention account may also get a guarantee from a guarantee scheme to be launched by the government. So when it comes to funding by SMEs, there are several benign schemes currently prevailing. There's also a TREAD scheme under which receivables can be funded on TREAD's platform. Loans granted by banks to SMEs are mostly unsecured. The banks get a guarantee from SIDBI to the extent of 75% of the loans. In addition, NBFCs giving loans to SMEs also get similar guarantee from what do you call CGT SME, CGT SME, CGT MSE. So these are guarantee structures currently prevailing for funding to SMEs. Just a very, very quick provision about gifts by companies. There was a provision in section 47 Roman 3 which talked about gifts. Earlier gifts were not considered as transfers. Now the exemption from transfer would be available only in case of gifts by individuals, not by companies. Companies normally don't give gifts, but sometimes gifts may be given or transfers without consideration may be done by companies as a part of schemes of arrangement. So if at all a company is giving any transfer without consideration as a part of a scheme of arrangement, this will no longer be exempt from definition of transfer, and therefore it might be considered as transfer. If it's taken to be transfer, the question of taxation at fair value of the transferred asset may come, because then section 54D might capture this kind of a transfer. Finally, fund management entities in IFSC. IFSC has two types of fund management entities. A so-called mutual fund, which we know in the country we call it mutual fund. Under IFSC, it's called an FME. It's called retail FME. A mutual fund becomes a retail FME. Similarly, an exchange traded fund also, so ETF also becomes a retail FME in the context of IFSC. That apart, the non-retail, like similar to AIFs we have within India, the non-retail FMEs are called category 1, category 2 or category 3 AIFs within IFSC. Now, presently, there was no clarity about mutual funds and ETFs out of IFSC. Several banks have already formed fund management companies out of IFSC, and they're just about to launch mutual funds. This lack of clarity was hurting. The proposal now is to grant clarity and say that retail FMEs, that will be mutual funds and ETFs, will be taxed as category 3 AIFs, and category 1 and category 2 of course are taxable in the hands of the taxpayers. They're taxed in the hands of the contributors or the beneficiaries. End result of this exercise is that in case of Cat 1 and Cat 2, the tax is paid by respective unit holders. Unit holders may either be Indian residents, because now Indian residents are also permitted to invest based on the liberalized remittance scheme. One can remit money to IFSC and invest as one would have invested outside India. So if there is Indian resident investing, whereas the investor will pay tax. If foreigners are investing, well, the tax will be paid by the respective shareholder in the respective jurisdiction. As far as the FME is concerned, retail FME is concerned, Cat 3 as well as mutual funds and ETFs, tax is payable on the fund, but that there is a provision to exempt 10 out of 15 years as per the normal scheme of taxability of entities within IFSC. So as regards category 3 institutions as well as retail FMEs, 10 out of 15 years their income will not be taxed. At their choice, they can choose 10 out of 15 years, either the initial 10 years or later 10 years. They can choose a block, and that's how the taxability of FMEs will work. So the entire structure of the budget, I would say, is backed by vision, backed by long-term thinking, barring some provisions which are little, odd. They are difficult to understand. So that's how our analysis of the budget provisions is. Rizima, this is all from my side. It's been a very, very long day for you as well as for the marathoners. And
thank you so much.
Absolutely. Is there any question at all for me?
So there were a few questions. Just 1 second. So one is, so this is something which has been in news also. maybe controversial. So do you think that buyback provisions would impact ESOPs granted to techies and startups? Because I've seen this buyback is a way for promoters to exit, right? So do you think that it will impact definitely, and this was brought into specially to put on a hold on such practice? Is that so?
No. First of all, ESOPs cannot be granted to promoters. As per SEBI's ESOP structure, ESOPs cannot be granted to promoters. ESOPs can be granted to persons other than promoters. Number two, as per Companies Act Section 68, buyback provisions of Section 68 are applicable to buyback of ESOPs also. ESOPs are normally not bought back. ESOPs are exercised. The resulting shares may be bought back, but sometimes companies buy back ESOPs as well, even before the options get exercised. In which case, it's covered by Section 68. Taxability, however, under Section 222F as proposed, it very clearly talks about buyback of shares. ESOP is not a share. ESOP is just an option. So if at all a company buys back ESOPs, or a company buys back, like I mentioned, CCD, compulsorily convertible debentures, those buybacks would still not be hit by the proposed Section 222F, as they are anyway not hit by Section 115 QA also. Ridhima.
Correct. Got it. So there is one related to IBC. Should I take up?
Please do.
So how will changes in IBC and the establishment of additional tribunals speed up the insolvency resolution process?
That's a very good question, and maybe because of dearth of time, I didn't get into IBC, because this is more like a motherhood statement right now. We exactly don't know what will be the shape of IBC changes. The FM talked about two things. Number one, she said she will ease out the process of insolvency resolution by making appropriate changes to IBC. We don't know what the changes would be, but as and when the changes are available, we'll probably talk about that. Second, she said to declutter the NCLTs, which are extremely cluttered as of now, because there are common benches. They deal with Companies Act provisions, they deal with IBC provisions as well. And anyone who's dealing with IBC will probably know that during a day there are 60 matters listed, out of which the bench barely hears 10, then rises, and rest 50 are deferred. Commonly, one matter is deferred 50 times. Now, this extremely long list of cases before NCLTs. The experience is no different from how it used to be in courts. Date pe date, tarikh pe tarikh. Sunny they will recall. Tarikh pe tarikh. That's what happens in NCLTs too. So we hope that with additional benches and some benches dedicated to company law matters, because after all, company law matters also go to NCLT. Particularly, let's say operation mismanagement, these matters go to NCLTs. Currently, they don't have time at all. So maybe with dedicated benches handling company law matters, the tarikh pe tarikh may become a little less tarikh oriented.
Yeah, correct. So there has been a lot of buzz in our YouTube comment session where everyone is like, buyback amendments must be withdrawn, representation must be sent to all by government. What is your take?
I am almost certain, Ridhima, like I mentioned, that there will be some buyback of the buyback provision. There will be some rollback. Probably there'll be some rollback, because if it stays the way it is, someone will challenge it in court. And I think a court will not take a long time to strike it down, because this is going against fundamental principles of taxation. You can't tax a person without earning income. You can't tax a person on his own money.
That is absurd. That is truly absurd.
Absolutely.
So let's hope that soon, maybe by the mid of the next month, we'll get an update on that.
ख्वाहिश तो ऐसी है.
Yes, let's see. So I think that's all. And thank you so much, Mr. Kothari, for an extensive and a thorough session. This was a much needed session to end it on a truly high note. Thank you so much.
So very thankful to everyone, particularly the marathoners. Thanks, Taxman. Thanks everyone. Bye-bye.
Thank you so much. So today has been truly enlightening and educational. I would like to extend my heartfelt thanks to all our speakers. Daksha Baxi, Tarun Garg, Mr. Mukesh Butani, Brenden Saldanha, Raghav Bajaj, Deepak Bhholusaria, Darshak Shah, 𝐊𝐞𝐲𝐧𝐸, Dr. Manoj Fogla, Mr. Suresh Kumar Kejriwal, Mithilesh Reddy, 𝐂𝐻𝐿 Christopher, and Vinod Kothari. So we truly appreciate you to taking time from your busy schedules to share your valuable insights with us. Also, a big thank you to all attendees for making today's event a success. Special thanks from all of us at Taxman, and a heartfelt appreciation to my team at Taxman for their incredible effort in making this event possible. As I sign off, I leave you all with a thought from Albert Einstein. Education is not the learning of facts, but the training of mind to think. Thank you so much. See you all in the next edition.